So good morning, everyone. It's a great pleasure to be here today and welcome you to this year's and 7th ECB conference on financial stability and macroprudential policy. And the organization of this, as in the last years, is a collaboration between the ECB's Department for Macroprudential Policies and Financial Stability and our research department. As you may have seen, this year's conference is split into two parts. The first part, which is taking place today, will focus specifically on issues that are related to non-bank financial institutions. And this part is jointly organized between the ECB and the colleagues from the Federal Reserve Bank of New York. And hence a special welcome goes to our guests and co-organizers from New York. This day already constitutes the third New York Fed ECB event on non-banks that we now have annually, and we alternate the locations between Frankfurt and New York. And I very much appreciate this joint collaboration with our two institutions, and I hope that we will stay in touch and continue organizing on this important subject. Moving then to the second part of the conference that will take place tomorrow. This part will cover broader questions related to financial stability and macroprudential policy, ranking from banking sector policies and regulation, systemic risk and financial crises to financial stability aspects of real estate markets. Obviously, our conference takes place at a time of rapidly shifting geopolitical environments, and while we haven't seen bigger accidents so far in markets, neither on the bank nor non-bank side, I think this environment could easily test financial stability in Europe and beyond. And let me briefly highlight some of the risks that we currently see. First, there's a risk that we will experience further sharp adjustments in financial markets, and these could become disorderly, particularly if the declining liquidity of non-banks amplifies price swings. For example, today's session on fire sales, as well as the panel discussion later today, may give us further structural insights on how to think about these issues. Second, if trade tensions were to escalate, this could challenge both firms and households, translating into credit risks for banks and also for non-banks. And many of the sessions, actually, on both days of the conference consider the resilience of households, of firms and financial intermediaries, as well as the appropriate regulatory and macroprudential responses. And then finally, structural challenges such as low growth, population aging, and higher fiscal spending needs, including for defense, could put public finances under pressure with adverse effects also on private sector funding costs. Higher productivity growth is urgently required as part of the solution to these structural issues. And tomorrow's keynote, touching upon the role of regulation for competitiveness, including of the financial sector, may give us some answers on how to rekindle fair and broad-based growth. So with that, let me conclude. Let's get to our very first session. I hope that we will have insightful and exciting conference days with a really good and fruitful exchange. And let me now open our first session, which is termed Non-Bank Lending to Firms, and I would like to welcome the presenters and discussants to the podium. Please. So we have two papers in our session. The first is called Who Needs Banks? And the presenter is Sabrina Ben Said from the University of Wisconsin-Madison, and then followed by the discussant Giorgia Piacentino from the University of Southern California. So please, Sabrina.
So it's really a pleasure for me to be here today. I'm going to present you a project with my advisor, Erwan, and with Cyril from University of Bern, Who Needs Banks, and I'm looking forward to your comments and feedback. So today I'm going to talk about loan to non-financial corporation in the US. And what we do here and what motivates us to start working on this project is that loan from non-bank to non-financial corporation in the US is more important than loan from banks. So what we do here, we went to the flow of fund, and in the flow of fund, we can have a decomposition on loan from depository versus non-depository institution. And what we see, for instance, from the left-hand side, in total amount of standing, in 1950, the share of loan from non-depository institution was 15%. Today is 2/3. On the right-hand side, what we do is that we want to take into account the size of the corporate sector. So we take as a ratio of the value added, and same conclusion. Loan to non-financial corporation by non-bank is more important than the one from banks. And from going to the data and seeing this long historical transition where non-bank loans from non-financial corporation has grown so much and becoming more important than banks, we wanted to understand what's going on. And here in this paper, we are interested in one specific channel, which is the difference in cost in the underwriting process. Bank and non-bank offer different type of underwriting process, which have different costs. And what we think about cost of underwriting process is the time it takes to get verified, the time it takes to get screening, all the paperwork. So when we go to different surveys, and this one from the Baker-Friedman Institute is an example, we see that usually the different explanation why this firm go to non-bank is of the speed of execution, the certainty, the less covenant, the high probability of being served. So here in this survey, they asked to private debt manager in Europe, but also in the US, what do you think is the main reason to go to non-bank? And the main reason explained and delivered is about certainty and speed of execution. So this is really what motivates us in this project, is to try to understand the transition that I was showing you in the data and try to think how this difference in the cost of the underwriting process explain this transition. So what do we do? So it's a theoretical paper. It's about a model. What we do is that we model an environment when we have heterogeneous type of borrower and heterogeneous type of lender. And the lender differ in their underwriting process. How long does it take to verify? And in our environment, we have fast and slow lenders, so in terms of time of verification. And what we show is that actually in equilibrium, they both coexist. There is a juxtaposition. It's optimal to have fast and slow lender. This juxtaposition, it's good for welfare, and it's increased aggregate outcome. In equilibrium, we have different type of borrowers that they differ in the level of riskiness, and what we have is that actually the safe borrower, they want to be served by the lenders that take time to verify, that are really safe and slow verification. But the risky borrower, they are going to opt for fast lender. So we have a really like a risk segmentation in this model that is explained by the different underwriting process that are offered by this different type of lender. We also do in this project, we go to the data to verify the prediction of the model, and then we can use the model to talk about policy. Having an environment when we have both this fast and slow lender can help us to talk about policy. And for today, I'm just going to talk about one quantitative experiment that we do, is that going back to the first graph that I'm showing you with the data when we see this long transition about the non-bank going more important to the bank, we want to use the model to see, okay, so what's the difference in the underwriting process? What's the difference in duration? What's the difference in time of the verification from bank versus non-bank per se, all else equal, that could explain the transition that we see in the data. So for now, for today, I cannot really go into the math, so I'm just trying to explain you the model, the environment, and what are the main trade-offs, so you have an idea of what's going on. So we build a model when we have heterogeneous type of borrowers and heterogeneous type of lender. The borrower, they are different in their level of riskiness. And the way we model that is that they have a project that they want to realize, and they have different probability of success. And what happened in this model is that their level of riskiness is a private information. So the lender don't know the type of the borrower, so there is some screening that is going on. And the different lenders need to screen and verify the type of the borrower. The lender, on the other side, they are going to have a large mass of lender, and they are going to have a choice between different menus. So we are going to consider different option underwriting process. This underwriting process has different intensity in the how much are you going to verify the type of the borrower. And the way an underwriting process works is that if you are going to spend a lot of time to verify the borrower, to ask a lot of information, a lot of documents. The screening is going to be more and more precise. You are going to know and reveal the type more precisely of the borrower. So this is going to be costly in terms of time, but in return, you're going also to have access to cheaper funds. So that's the trade-off. The lender can have access to a really strict underwriting process that's going to be really costly in terms of time, but it's going to be really precise in terms of how do we really reveal the type. So in this environment, so what's a bank? The way we think about a bank, it's a lender that are going to have really strict underwriting process. They are going to ask you a lot of paperwork. It's going to take a lot of time, but this is the lender that are going to have access to the cheapest fund, and we are thinking about deposit here. And on the other hand, the non-bank, they are going to propose to offer more fast underwriting process. It's going to be faster to get verified, but they will access to more expensive funding costs. So there are two things we think about, is that banks and non-banks differs on the time of verification. So there is a difference in the time of verification, how fast non-bank can verify the borrower compared to banks. And they also differ in terms of cost of funding. Banks can have access to cheaper funding compared to non-banks. So with this model, we can use it and solve it to find for equilibrium, and we can try to understand about what are the conditions such that we are in an economy where we only have banks? What are the conditions such that we are in an economy when we have banks and non-banks? And then we can also use this model, and this is what I'm going to show you today. Well, show you, just describe you how do we do. We want to understand the transition that I show you in the first graph. How do we go from an economy with only banks to an economy when we see banks and non-banks are more important now than banks? So we're going to use this model and to do some quantitative experiment to understand this transition. And the way, the one that I'm going to show you is with n is equal to 2, so 2 underwriting option. So in the paper, if you're interested, you can generalize, then we have n option, but the one that I'm going to show you today, think about 2. So the idea what we can do by using this model, we can use it to start with an economy when there are only banks. And we can wonder, okay, what are the conditions such that we have only banks in this economy? And this happens for two reasons. Either banks have really cheaper cost of funding compared to non-banks, so it's so expensive to the non-bank to enter the market. Or the underwriting process, the duration, is not, the difference in the duration between banks and non-bank is not that high. Non-bank don't have that comparative advantage to fastly screening the borrowers, so the difference in the underwriting is not that high. In this, under this parameter, we have an economy with only banks. And what we are interested in is to see, okay, let's start with an economy where we have only banks. What happens now if the cost of funding decreases, the difference in cost of funding decreases? Now it's cheapest to non-banks to get funding. What happened? So we're going to start with this economy with only banks, and then we're going to reduce the difference in cost, and non-bank going to start to enter the economy, and we are going to solve for the new equilibrium. So we are going to study the transition to this new equilibrium, and in the new equilibrium we are going to find, and this is equilibrium we find by calibrating by parameter that we observe today in the data. We observe that we are going to go to a new transition with banks and non-banks, and the non-banks are more important than banks. And by studying this transition, we want to ask the question, okay, so what is the minimum duration, difference in duration in the underwriting between banks and non-banks, such that we observe the equilibrium with non-bank being more important today? So that's the exercise that we do. So here we solved, so we start from an economy with only banks, so that is why on the left-hand side at the beginning, we see that there is only banks being funding, and we are going to reduce the difference in cost of funding. Non-banks are going to enter. We are going to have a transition and slowly going to go to a new equilibrium when we see that non-banks are more important than banks. So we calibrate in the way we have what we observe in the data. And we are going to wonder, okay, so what's the difference in the duration in the underwriting process such we transit to this economy? And we find that the difference is only 2 months. What does that mean? Is that if non-banks offer an underwriting process when the time of verification is 2 months faster all else equal, it's enough to have the transition and this new equilibrium when we see that the non-banks are more important than banks. Here it's an exercise, we do all else equal, so we let all the regulation, we let all the other factors that can explain the rise of the non-bank, and we want to see how just the difference in the underwriting process can explain that. And this is only 2 months. So we solve for the equilibrium. So we go to we have a transition and we go to a new equilibrium. How is how is characterized this new equilibrium? We find that actually, so I told you, the borrowers are heterogeneous in their level of riskiness. So the way we model that is that they have a project that they want to realize and the probability of success is P. The borrower with a high probability of success, so the safe borrower, they are going to be served by banks. The borrowers that are going to be between P higher bar and P lower bar, so the middle, a little bit risky people, they are going to be served by the non-banks. And the high-risk borrower, they are not going to be served at all. So we're going to have, in this model, a risk segmentation, and the borrower by themselves, they are going to choose the underwriting process based on their type, based on the underwriting process that's going to reveal or not their type. What we are going to see also is that it's going to be cheaper to be served by banks than non-banks, something that we can easily see in the data as well. And we are going to use these two equilibria that we resolved. So the first one was bank only, and the second one was bank and non-bank. And we are going to compare. So we can compare, do some comparative statistics to compare how was the equilibrium when in an economy where there were only banks, and how is the equilibrium in an economy when you have banks and non-banks. And what we can see is that actually, compared to before, the fact to add these non-banks, the fact to add this underwriting option that is faster but less revealing in information, actually we're going to see that there are more projects that are being realized. So there are more borrowers that are going to be served. So this goes with the idea that adding this non-bank on the market complement the credit market. There are new projects that has been realized that could not be served earlier by banks. And we are going to see, we can also compare the sample of borrowers that were served before by bank and that are served now by bank in this new equilibrium. And what we see is that, okay, bank market share decrease. Okay, this is because we have new lenders, but the default rate decreased. The sample of borrowers that banks were serving before compared to now, the sample now is less risky in average than before. So the default rate decreased, and the charge-off rate also fall. Conclusion. I went a little bit too fast. It's okay. So what do we do in this paper is really about, we want to understand the difference in time of verification. We think about the different, we have different lenders that have different underwriting process, and we think about the cost of the underwriting process as time. There are some lenders that are going to take more time to verify you. The verification is going to be more precise, but also they are going to have access to cheaper funding. On the other hand, we have some lenders that going to offer really fast underwriting process, but they will have to be to get access to more expensive funding. And this idea is that it's really about how do we reveal information. So we have different borrowers, and their type is private information, and we think about this new lender as providing a new underwriting option with information loss. What we see is that actually in equilibrium, when we solve for equilibrium, and the way we solve is that we calibrate for what we see in the data today, we have that it's optimal to have a coexistence of these two types of lender, the fast lender and the slow lenders. And actually, when we use also the model to understand how do we go from an economy to only banks to an economy with banks and non-bank. And what we see is that with the use of the model, all else equal, a difference in the time of verification of only 2 months is enough to generate the transition we observe in the data. For now, today, I only talk about the ingredient, the environment of a model. I didn't talk about macroeconomic shock. I didn't talk about aggregate shock. And that's also why I conclude that, okay, it's good for aggregate activity, it's good for welfare. It's just the idea that, okay, there are more projects that are being realized, so it's good for the output. But something that we are thinking to do is that, okay, we have this environment when we can think about the juxtaposition of these two types of lender. And then with this model, what can we do if we start adding this type of shock? How can we use this model to talk about policy? How do we should, for instance, regulate the banking sector, but also the non-bank? And how do we think about optimal policy? So an avenue for this paper is to really think about policy on the bank and the non-bank, and to think about what's happened in equilibrium, what happened in terms of welfare. Thank you.
Thank you very much. For a very clear presentation, even though you went a little bit ahead of time. A great title, by the way. So, Georgia, please.
Thank you. Hi, thank you very much for having me. Let me just launch into a word of motivation. Back in 1950, bank lending was about 6 times non-bank lending. And now it's about half. So there's a 12-fold change. So the question that the authors want to ask is why? And the answer is that there is a trade-off. Banks have, on the one hand, low cost of capital. That's an advantage. On the other hand, they're highly regulated, and that's a disadvantage. It comes with some costs. The results that the authors give is that there's market segmentation. So safe borrowers use banks, risky borrowers use non-banks, and this is in line with the data. And on top of that, they show convergence to steady state that captures this rise of non-banks. In what I'm going to do in the discussion, I'm going to start with a simplified model. This is just going to be one slide. I'm going to capture all the results, and then all my comments are going to be based on this model. Hopefully, it's going to be easier to see the comments. So this is the model. There's going to be 2 types of players. There's going to be borrowers. They're going to raise $1 for a project that pays off Y, P, and P depends on the quality. I'm going to have just 2 qualities, either high quality or low quality. If I'm a high quality borrower, the project pays off with probability PH. If I'm a low quality borrower, it pays off with probability PL. If the project fails, it's just going to pay 0. And the probability of having a high quality borrower is going to be P. The other type of player are lenders. They don't know the quality of the borrower, so they don't know P, but they can screen. And screening costs lambda. And finally, at the market, lenders post contracts and borrowers choose lenders. If the lender screens, then they can do contingent pricing. So basically, they can post a rate QH for high-quality borrowers. You can imagine that rate in equilibrium is going to be lower, okay? And then they can post a rate QL for low-quality borrowers. That's going to be higher in equilibrium. If they don't screen, they just lend at a rate Q bar. They cannot differentiate among the quality of the borrowers, so it's just going to be Q bar. A definition that, in the paper is that a bank, what's a bank for the way the paper thinks, is a lender that screens. And the idea here is that regulation imposes some costs, and this is going to be basically the cost of screening the lambda. So this is the model. Now let me go to the results. I'm going to start with a benchmark, just like Sabrina did, just with only banks. So if there are only banks, remember, banks have to screen. That's the definition of a bank. So they're going to post this menu, QHQL, these rates depending on the quality of the borrower. They're going to screen at cost lambda. They're going to lend 1. So then they have to break even. And so what's the break-even condition? The break-even condition is they lend 1, and in exchange, they know that from a high-quality borrower, they're going to get the rate QH with probability PH, but they also have to pay the cost lambda. Okay, so that's the first break-even condition. And the break-even condition for lending to the low-quality borrower is very similar. They lend 1, and they expect to get QL, the rate, with probability PL, but they have to pay lambda. And this gives me immediately the equilibrium rate, QH and QL. And you can immediately see the QH, that's the rate to the high-quality borrower, is going to be lower than the rate to the low-quality borrowers. Now let's go to the paper, which is the presence of banks and non-banks, where the difference, remember, is just the non-banks lend. They are not screening so that they lend at a rate Q bar. Okay? And I forgot to say in the model, these rates are endogenous, as you saw. I'm going to look for a separating equilibrium. So that's an equilibrium in which banks lend to high-quality borrowers, and non-banks lend to low-quality borrowers, okay? So in this equilibrium, what's the pricing? So the rates for the bank, that's the QH and the QL, are as in the previous slide. But notice that QL, so that's QH is just 1 plus lambda over PH, and QL is 1 plus lambda over PL, but that QL there, that's the rate that the bank will lend to a low-quality borrower, that's off equilibrium, because I'm looking for a separating equilibrium in which low-quality borrower is just going to non-banks. The rate Q bar is the non-bank rate, and that's just 1 over PL, okay? The non-bank knows that it's just lending to low-quality borrowers, and that's the denominator, the PL. And remember, the non-bank is not paying the cost lambda, and that's why the 1 in the numerator. And now, in order for this to be an equilibrium, it has to be incentive compatible for the high-quality borrowers to go to the bank and for the low-quality borrowers to go to the non-bank. So let me look for the incentive compatibility condition. For the high-quality borrower to go to the bank, it has to be that the rate, QH, has to be lower than the rate Q bar of going to a non-bank. And you can see that really immediately from comparing QH and Q bar, and that's true as long as lambda, the screening costs, are sufficiently low. And the other incentive compatibility is that the low-quality borrower must prefer to go to a non-bank than a bank. That means that the rate from the bank QL has to be greater than the rate from a bank, from the non-bank Q bar, and that's really immediate, you can see it. And this captures the result of the paper. So the first is the structure of the equilibrium, in which high-quality borrowers are going to banks and low-quality borrowers are going to non-banks. So this kind of assortative matching, if you want. It captures that bank borrowers have low rates and high profits. That's just by the incentive compatibility of the high-quality borrower. And it captures the banks enter as long as the screening costs are sufficiently low. Okay, it cannot be super high, otherwise they're not going to enter. And with this, I'm ready for my comments. I'm going to have 6 comments. My first comment is about the role of the cost of capital. So the author, in the introduction, they say that the results are due to a trade-off. On the one hand, banks have a low cost of capital, and on the other hand, that's an advantage. On the other hand, they're highly regulated, and that's a disadvantage. But as you saw in my model, in my simple model, screening is sufficient for the results, for this matching, for the separation, for the separating equilibrium, if you want. And indeed, in my model, you saw that the lender is deep-pocketed. There's no role that the cost of capital plays whatsoever. I think, so the question that I have for Sabrina is why not motivate all of the results, especially in the introduction, and derive the results via screening only. And I think this matters because in some sense it determines whether the paper is about banking per se or just in general about screening, and it applies more broadly. So my suggestion here is to zero in on the theory forces and align the motivation more with the way that the model thinks. My second comment is about the role of screening, and it's really going to be the flip side of my first comment. And again, the authors say in the introduction that the result is due to this trade-off, cost of capital versus regulation. In my previous comment, I said everything is driven by regulation. But in a paper that Jason, Anjan, and I have in the JF, we actually show very similar results, this rise of non-banks and this kind of assortative matching separation with different projects that banks and non-banks fund, just with the cost of capital channel. So what we show is that the cost of capital is indeed an advantage for banks, but very surprisingly, it turns out to be a disadvantage for banks as well, so it plays both roles, and that's what allows non-banks to rise, and we explain a very similar pattern in the data. So the question is, what is the main channel in the data? Is it screening or is it cost of capital? It matters because it's about the difference between banks and non-banks in this model is predicated on screening. So is it screening or is it cost of capital? So my suggestion is to take a stronger stance that the results and the facts are indeed about screening. So how could you do that, for example? Is there evidence in the data that banks are screening more than non-banks? I think there are some people that work in venture capital that could, for example, think the opposite. I don't have I don't have a stance here. My third comment is really related to this last one, which is about empirical content. So the authors stress how the model captures non-banks funding riskier projects. But you saw I talked very little about risk. I talked more about quality. So in fact, this fact is an artifact of the assumption that high-quality borrowers are low risk. In some sense, these two things really go hand in hand. Here there is screening on quality, and it turns out that the high-quality borrowers are also low risk. And the question here, what if the high-quality borrowers were instead high risk? For example, again, VC is a case in which venture capitalists are investing in high quality, but very high risk. This matters. Could it flip the prediction? So then the screening would be on high quality, and then you would have banks investing in actually riskier projects, because the screening is on the quality, is not on the risk. And so suggestion is to allow for a richer space of projects, or in the end, or back up the assumption that quality and risk go together. So high quality is safe. My fourth comment is what drives the transition. So a lot of the paper is about this transition. Is this one? The authors motivate and match the transition from banking to non-banking. But I feel like in the paper, this transition, the source of the transition is never spelled out. So there's a lot about this in the data, in matching the data, but what is the root cause of this transition? This matters because this is what the paper is about. So just suggestion is then take a stand more on the economics and not just on this transition part, which is super interesting. My fifth comment is a bit funny, which is, are banks dead? So the author's paper is called Who Needs Banks? And I want to take one more minute because she ended up early. So people keep asking this. Boyd and Girdler had a paper in 1995 asking, are banks dead? And it turns out that people continue asking this question because this pattern has been going, of this decline of banks, have been going on for a very long time. It turns out that banks remain alive and well, and with 12.5 trillion in deposits in the US. So the question is, why is this time different? Every other time people said banks were dead, kind of they were wrong. They continue surviving and staying around. So just a suggestion is to zero in on what's unique this time. My sixth and last comment is about sequential rationality. So the author's mechanism is about screening. And in equilibrium, only the high-quality borrowers go to banks. But once the banks knows that, they're also going to, then at that point, they might as well not screen in the first place. They can save the lambda. So the question is, why would banks screen after borrowers have self-selected? How do the authors get around this? With commitment. So this matters because the equilibrium could unravel without that. So my suggestion here is to analyze the model without commitment as well. So the conclusion, this is a very elegant paper on a very, very important topic. My comments, this is just the 6 comments. I'm going to leave them there in case the authors want to remind the author about what they are. Thank you very much.
Thank you, Giorgia. Would you like to respond a bit before we open? Or? Yeah, so would you like to respond to some of the issues raised before we open the floor to the audience?
So I think we can talk about that
Absolutely.
More later. But yeah, no, I completely agree with all the comments. And for the characterization of the equilibrium, when you were like showing like the really simple model, we start by that. But because we're very interested in the transition, so that is why we need to add more complexity in the model. I really like your comment about what's risk, and actually like we think about, like we saw some paper talking about actually there are some firm borrowers that are dual, and the way we talk about risk is about the probability of success of the project, but so it's risk at the project level maybe, and we don't really go into the detail on the quality versus the probability of risk, so that's interesting. And about commitment, it's true that we ruled out because it was but thank you for we will think about that.
Okay, so we can open the floor for some questions. I see a hand over here, please.
Great presentation and discussion. Thank you.
And could you please state your name, your affiliation?
DC. So I have 2 comments. So the first one is that I'm not overly comfortable with treating non-banks as a homogeneous group, especially over such a long period of time. I imagine that in the 50s and the 60s, you probably have a lot of finance companies, which on the lending side function very similar to banks, but then they don't take deposits and they presumably face less, supervision and regulation. And then more lately, the emergence of private equity and fintech, right? Very different players than traditional finance companies. And again, they'll be facing different incentives, and I'm sure they do screening, but maybe they do it somehow differently. Mm-hmm. And a related comment is that the composition of borrowers might have changed a lot. In particular, there is a transition from borrowers who can offer physical collateral, and this is sort of bread and butter of banks, and I think Camille can say more, to borrowers that sort of basically have no hard assets. We're talking about something very intangible, which makes for banks not the right lenders for this kind of stuff. So kind of take into account that there's homogeneity in non-banks and that the composition of borrowers can change a lot over time, I think is very important for this kind of analysis. Thanks.
Okay, there's another question over there. And again, for our online audience, could you state your name?
Yeah, Livio Stracca, ECB. So, very interesting paper. So I would have several questions, but 2 questions. So the first is about quality, as also the discussant mentioned. So you could think that, the space of potential borrowers, so you have, as you posit, so the high risk, high return, and low risk, low return. This is how I understand. But you could also have like, borrowers who would just take the money and leave. So the kind of fraud, or I don't know. So are these borrowers present in the model? And this is where it comes a bit to quality, right? So you want to prevent people walking away from the borrowing. And the second question is what is the rationale of why banks have this, monitoring kind of restriction? Is it that the banks have deposits and liabilities, so therefore the regulator imposes it because of different liabilities? But then the cost of funds comes into play, because in a sense, the banks have low cost of funds at deposits, and therefore the regulator imposes a restriction, while the non-banks, they don't have this deposits liability, but they have a higher. So reply to the discussant. So this is actually a key feature of the model, because it drives the assumption on the lending technology. Thank you.
Yeah, exactly.
I'm going to answer to all the questions before I forget. So about the heterogeneity, yes, we are completely aware of the heterogeneity of the non-banks. I showed you the first graph with the flow of fund, but we can go to the decomposition and we see, as you said, before it was a huge importance of the finance company, then we have syndicated loan, then you have CLOs. So we are really aware of this heterogeneity, and that is why in the model we consider N option and N underwriting option with different intensity. And so which means that one non-bank versus another non-bank, they already differ in their time of verification. And we don't go in the micro foundation of why, for instance, fintech are faster. We don't say that, okay, fintech are faster because they have access to machine learning and big data and technology. We don't go to the micro foundation, but we say that, okay, we have heterogeneous non-banks modeled by N option of underwriting process. So we are aware of the difference. It's just that we step back a little bit, and what we are interested in is to see that, okay, the difference between bank and non-bank as a group, but within the group, they are already heterogeneity. So we take that into account in the model. In terms of the type of borrower with time, I think the model takes this into account too, because like in the transition, each time a borrower, like it's a continuous time model, and a borrower can die and leave, and then there's replacement. So this we take into account also. What was the other question?
Just these two.
Okay, so yeah, okay. About the risk and cost of funding. Yeah, so the way we think about the fact that it's, okay, banks must verify you and take a lot of time. It's by their definition of bank, by the regulation, and this is in return to get access to cheaper funding. But this is not because they have cheaper funding that in equilibrium we have the non-banks that get more important than banks. We also did the model when there is no comparative advantage in funding cost, and we find again this more importance of the non-bank, but we decided to consider this difference in the funding cost, because we want to say that even though banks have access to cheaper funding, even this, that we still find that the non-bank become more important. So we decided to focus on the regulation part, because that's the definition of bank, but this is not the main driver of the model. It's more decided that banks and non-banks are offering different underwriting options with different time of verification.
Okay, we can take 2 more questions. I saw Philip over here, and then Michael.
Thank you for the nice
Please state
paper.
your name. State your name.
Philip Hartmann, European Central Bank. Thank you for the nice paper and the nice discussion. So I understand there's a very clear question of this paper and there's a very clear answer to it. So banks will hang on. So somehow they will not disappear over time. Now, obviously, some of the broader issues are particularly on the mind of people. But let me start with your figure 1. So one salient feature is not there anymore, but I can tell you what you see on it, is that actually it's not the transition from the reversal of the lending is not only a gradual process, it's also a gradual process, but there was a key crash, say, of bank lending in the late 90s, early 2000s, like, which actually created the reversal, which then afterwards, with some volatility, stayed constant. So it's very important to understand what that is in terms of, because it seems to be, I guess must have been some regulatory change in the US. That's my first point. So what explains that? And the second is obviously, and that's not in the model obviously, but it's what we really are interested in is the additional innovation that NBFIs allow justified by potential additional financial stability risks? That is the real trade-off. And so I would very much encourage to broaden and develop these type of frameworks also that were mentioned in the discussion in this direction, because then we get closer to policies. And if you have a view right now in this direction, that I would be interested to hear.
And over here, please.
Thank you. Patrick Montagnier, ECB and Supervisory Board, so being only a micro supervisor, so coming far from my colleagues here in the room. Thanks a lot for this study, because it was, for me, at least to hear that the cost of capital is lower for the banks than for the non-banks. For me, it's a huge event, because when facing the banks, they complain quite the opposite, saying that they have too much cost of capital. But of course, the US example is very interesting, because they have developed for decades now a large securitization market. The originate to distribute has also been probably the cause of this huge development. In the EU, it's a little bit different, but we can see that even with a lot of late time, we just try to follow that. But I would like to go back to your main idea to say that the length of the screening is something which is very important between bank and non-banks. So does it mean, when we are talking in terms of regulation, that if we are withdrawing, for instance, all regulation related to non-financial topics, such like, for instance, having a huge risk assessment through risk officers, very strong, with a very various steps of checks within the banks, etc., internal control, blah, blah, blah. At the end of the day, it's non-financial by itself, it's more qualitative. Banks are complaining a lot about this qualitative aspect, and it's part of our rating. It could be called camels or SRAPE in the EU, but at the end of the day, that's part of our rating. So does it mean that if we are withdrawing these non-financial requirements, which are mainly focused on this kind of internal control, and it is which is partly the cause of this length of the screening, we could have the same behavior between the both banks and non-banks? Because of course it's not an innocent question, because we have a lot of pressure coming from the banking industry to say you need to withdraw these rules because it's a lot of cost for us. It's not a cost of capital, it's a cost of efficiency.
Over to you.
So I completely agree with you, Philippe. We should check about what happened in the 1990s and 2000s, and about policy on bank and non-bank. I really think this model can be used. Of course, we need, as I said in the conclusion, we need to add more shock, because for now the conclusion is that non-bank is good for welfare and great activities. But after adding shock, this model can be used to talk about policy. It can be used about talking about how we should regulate bank when taking into account the existence of this non-bank, and also can be used to to do some quantitative experiment of what will happen if we start regulating non-banks. So yeah, I completely agree with you that it's a direction that we are thinking, and the model can help you to do some quantitative experiment with that. About the difference in time, so yeah, the bank are really, the way we think about bank exactly is that they have to do all this verification process that is really more strict, and the way we model that and think about is that we have, like, as I said, an option of underwriting process, and the bank will have the one that are the more intense. If we rank them, the bank will take the one that are more intense because they are forced to. And the way we think about in the model, we think more about what happens if we have non-bank that are verifying more or less, but we can do the same exercise with what happens if non-banks are verifying more or less, but we can do the same exercise with banks. What happens if banks verify less, take less time? So the model can be used to answer to your question. And actually, when we are resolving the equilibrium in the economy where we are only thinking about banks, this difference in duration is really important, and non-banks should not be that fast enough compared to banks to have only banks. But we can think also about what will happen if banks are not that slow enough to only have banks and non-banks. So this is a direction that we didn't really investigate that much because we are more thinking and playing with the non-bank intensity, but we could think about that. And it's really interesting. It's just by regulation, we were just thinking, okay, the banks are the ones that have high intensity underwriting process, but we could think about the opposite. And my guess is that we'll have bank and non-bank that don't really differ that much at the end if we allow to do that. Yeah, in terms of screening. Yeah.
Okay, thank you very much. Then let's move on to the second paper, Zombie Lending to US Firms, and the presenter is Camilla Minuy from the Atlanta Fed, and then our discussant is Christian Kubica from the ECB.
Thank you so much. Thank you so much for having me today and for welcoming this paper to the program. So I'm going to talk today about zombie lending to US firms, and this work is joined with Giovanni Favara and Ander Perez Orive from the Federal Reserve Board, so the usual disclaimer applies. So we're motivated to look into the question of zombie firms because zombie firms are, have important consequences for the real economy. We think of zombie firms as unprofitable firms that tend to stay afloat due to loan evergreening, a form of creditor forbearance by which lenders continue financing low-performing borrowers and shy away from writing off losses on non-performing loans in an attempt to hide the true financial health of the borrowers. We worry about zombie firms because they tend to lead to congestion effects. They crowd out lending to productive firms, stifling innovation and economic growth. Now, there's an academic debate out there to which we want to contribute. And the academic debate concerns itself with the question of what are the drivers of loan evergreening to zombie firms? Why does this phenomenon exist? And in particular, what's the role of bank incentives to evergreen loans, especially insofar as capital regulation is concerned? So there are two main prevailing views in this literature. The first one is that bank lending incentives are distorted by capital regulation. That is, that capital regulation increases the cost of loan loss recognition. And so this is particularly costly for low capital banks that have lower capital buffers. They would see capital erosion from recognizing losses, and so they shy away from that. Evergreening, on the other hand, the second prevailing view, is that it is unrelated to lenders' capital positions or regulation. So this view posits that evergreening, pretending and extending, is just an intrinsic feature of financial intermediation. Lenders just do it. It's how financial intermediation is done. And so in that view, evergreening will depend on lenders' overall exposure to the firm. Lenders with higher exposure, with more skin in the game, will be more incentivized to evergreen loans. So we want to shed light on this debate, bring some new evidence to bear, by assessing whether capital regulation or the lack of such regulation fosters zombie lending. So let me be very clear from the start, we're not going to be talking about the impact of capital regulation or regulatory arbitrage on credit migration overall from banks to non-banks, but I'm going to focus specifically on zombie credit. We will study bank and non-bank lending policies to zombie firms and how these lending policies vary with capital regulation. We have two spaces here. We have the banks, for which we have cross-sectional heterogeneity in capital positions as impacted by regulation. We'll use that heterogeneity to say something about the importance of regulation for bank lending incentives. And then we also have the space of banks versus the space of non-banks, with non-banks being unregulated. So again, we'll be able to speak to the idea of regulation. We'll bring data on bank and non-bank lending to firms in the United States, and the reason we focus on the US is that non-banks have risen as alternatives to credit quite tremendously in that context. So to preview our results, we have two or three main results here in the 4 bullet points. The first one is that banks, especially lower capital banks, tend to tighten lending to zombie firms. We find no evidence of zombie lending at banks. By contrast, non-banks are more likely to offer new loans to zombie firms, and those loans are cheaper. They seem to offer overall more lax lending terms to non-financial firms. Bank capital requirements seem to be associated with zombie credit migration to non-banks. And finally, zombie firms that borrow from banks invest relatively less. They perform more poorly and are more likely to file for bankruptcy. So the main takeaway of our work will be that capital regulation does not appear to distort US banks' lending incentives, but does appear to foster the migration of zombie credit from banks to non-banks. It does appear to support the proliferation of zombie lending in the non-bank space. So the main data sources that we'll bring to this largely empirical exercise will be twofold. We're going to use the US credit registry and a lot of lending data, granular lending data from banks and non-banks from the syndicated loan market, specifically DealScan. I'm sure you're all familiar with the US credit registry, otherwise known as the Federal Reserve Y14 data. We observe commercial loans from large stress-tested banks to a very large cross-section of privately held and public firms, covering 2/3 of US corporate sector debt, and we see 3/4 of outstanding loan commitments in the banking sector. We do not see small bank lending to small firms. So before I dive into the identification strategy and the results, I want to just show you a couple of charts on the rise of non-bank participation in the syndicated loan market. These two charts are for the 2012 to 2017 period. For reasons that will become apparent in a second, this will be our sample period. So on the left-hand side, we see the rise in loan volumes in deals with non-bank participation, and we also see the share of deals with non-bank participation, the red line, going up as well. And this trend is much more general. It extends, since the global financial crisis, it extends all the way to today. And although I'm not going to speak particularly to the importance of the rich ecology of non-banks we have out there in the financial intermediation landscape, I do want to take up Victor's earlier point about how diverse these non-banks are and show you a breakdown of the non-banks lending in syndicated loan market. And so here we have about, I think, 15 to 20,000 non-bank lenders, and we do a lot of manual analysis, a little bit of help from ChatGPT in order to understand the business models of every single non-bank lender in DealScan. And we come up with 3 main categories: specialized finance and credit. Now, this category includes finance companies, the financing arms of large manufacturers, etc. But it also includes BDCs, business development companies, and some private credit type shops. All the publicly listed BDCs are, for instance, here, like Blue Owl and Heirs Capital, the usual suspects. And then the blue area are the private equity and asset management firms, and those are, think of the largest asset managers: BlackRock, Carlyle Group, and Apollo Management will be in there. Now, private credit will be spanning both red and blue areas here. So let's go back to zombie lending. So what's our identification strategy? We're going to bring 2 sources of exogenous variation to this exercise. First, shocks to the status of firms. We're going to send firms into zombie status exogenously. And for that, we are going to use the oil price decline of 2014-15. So this is an exogenous oil price shock that will allow us to focus on ex-ante financially distressed firms. And here we're taking a view of zombie firms that is common in the literature. These are high leverage firms that struggle to service debt. They have ICRs, interest coverage ratios smaller than 1. And the oil price shock will send them into economic unviability by making them less profitable. So this is a quasi-random profitability shock, which induced by the oil price decline that basically sends ex-ante financially distressed firms into zombie status. The second source of exogenous variation will be to bank capital. Here, we're going to use the Basel III capital surprises that arise from the very peculiar, from the idiosyncratic features of the US implementation of Basel III. I'll give you a little bit of detail on both sources of exogenous variation. Let me show you or remind everybody about the 2014-15 oil price shock that we use as a source of, like I said, quasi-random profitability shocks for firms to give us exogenous variation in zombie status. So this is an event that happened in mid-2014, the dramatic oil price drop of about 70%. You see, not only it's dramatic, but it's also sustained over a number of years, which was driven by global forces, excess oil supply, and declining demand. Now, this shock put severe stress on oil-producing firms. It generated a tremendous revenue shock, and oil-producing firms, stop innovating, stop investing. So the industry was very negatively affected. The identifying assumption here, and you can already see that I'm sort of setting up in my mind like a diff-in-diff kind of framework, is that the oil event will have to be exogenous to firm fundamentals, on lender capital positions, and here we're going to use capital shocks as well, and on the characteristics of borrower-lender pairs that may be non-randomly matched in the loan market. For instance, there's some evidence risky firms match assortatively with risky low-capital banks, and so we don't want those kind of considerations to confound our results. Hopefully, the oil shock is exogenous on that. Now, the second source of variation, like I mentioned, are the Basel III regulatory capital shortfall shocks that arose thanks to the idiosyncratic features of how the US implemented Basel III. In particular, the US departed from the international implementation of Basel III in a number of ways that surprised banks. You recall there was an increase in the baseline level of capital, but also bank-specific, there were bank-specific features to this implementation. And what the US did was to require higher risk weights for high volatility CRE loans. So if you had those kind of loans as a bank, you were more exposed, you had to raise more capital, past due loans as well, and then a whole different system of risk weights for mortgages. The average, at the 25th percentile, banks have a shortage of 4 percentage points of capital relative to the regulatory standard that is compliant with Basel III. This is as of July 2012, right before the oil shock, so we're going to use that cross-sectional variation. We see a lot of cross-sectional variation across banks in terms of how far away they are from where they are supposed to be. So our baseline analysis will essentially be a triple diff-in-diff. We're going to look at the lending outcomes, a number of lending outcomes in relation to a triple diff-in-diff firm. So we're going to ask what kind of lending outcomes are financially distressed firms in the oil and gas sector experiencing before and after the oil shock, in particular after the oil shock relative to themselves before the oil shock and all non-zombie peers. And of course, we're going to use also heterogeneity in bank capital, like I mentioned, and our window of analysis is one of 2 or 3 years around the oil shock. So I'm going to take you now through 5 tables with all of our results. We're going to look at bank lending to zombie firms, non-bank lending to zombie firms, credit migrations from banks to non-banks, and 2 tables on the real performance of zombie firms. So the first table shows that banks, if anything, they reduce their exposure to distressed firms that transition to zombie status. We see from columns 1 and 2, on the right-hand side, we have this triple diff-in-diff. We see that banks they reduce lending amounts by 13.4%, and they raise the pricing of loans. Loan rates go up by 24 basis points to ex-ante distressed firms in the oil and gas sector that received this profitability shock during the oil price decline, so our zombie firms. And then in the second set of columns, we see that if anything, low capital banks actually tighten their exposure or reduce their exposure and tighten lending terms even more than high capital banks. Both types of banks retrench from zombie lending. So this evidence is inconsistent with the idea of zombie lending at banks. How about non-banks? And I promise this is the only quadruple interaction I'm going to show. So to look at non-bank lending to zombie firms, we have to rely on deal scan. And in deal scan, as you know, we see loan origination, so we have to change a little bit the analysis. Now we're going to look at the probability of new loan origination as well as the all-in drawn spread, the spread on new loans that accounts for all the origination fees, all the fees that go to all the syndicate participants with some important role in the origination. And what we see here is that non-banks are more likely to originate new loans than banks to zombie firms, and they charge relatively lower spreads. So this evidence suggests that they do increase their exposure to distressed firms, transitioning exogenously into zombie status, unlike banks. What about credit migration from banks to non-banks? So first, let's establish a baseline. Let's look at the odds of non-bank participation in relation in deals to zombie firms, so in relation to firm status. The first two columns show that zombies are more likely to be lent to by non-banks. So non-bank participation increases by about 17, 18 basis points relative to in deals to zombie firms as opposed to deals to non-zombie peers. And moreover, in the cross-section of deals, non-banks are more likely to participate in deals with little bank capital. So we see this from the two spline terms, where we split the sample by deals with low versus high capital of participating banks, and we see that the deals with non-bank participants are more likely when, in the same deal, the non-banks have less capital. And this evidence is suggestive of zombie credit migration from banks to non-banks. So my last two tables are about the real effects of zombie lending. What happens ultimately to these zombie firms? What is their performance? So on average, in the context of our analysis, on average, zombie firms tend to underperform. They experience worse real outcomes than other firms. We see here that their ability to raise financing decreases, their investment rates decrease, their balance sheet growth declines, and they are more likely to exit through bankruptcy than other firms. So they are weeded out eventually, on average. But does it matter if they are more dependent on bank versus non-bank financing? It should matter, because we saw non-banks being more lax in their lending standards to them. And indeed, if we split the sample into zombie firms that are highly reliant on bank debt versus non-bank debt, we see that the ones more reliant on banks suffer more. And the ones not reliant on banks but reliant on non-banks actually perform better, which is consistent with the more advantageous financing they get from non-banks. And we see that these results are very consistent across a number of real outcomes, including bankruptcy, which is available for the larger firms in our sample. So to wrap up, I would like to highlight a number of additional results, which I think are important in this kind of empirical analysis. So many things could be going on, and we want to rule out a number of alternative explanations. So the first one is that zombie firms don't appear to increase their demand for bank credit, neither to decrease it in the wake of the oil price shock. We look at credit line utilizations, and we do not see any differential effects in credit line utilization for zombie firms, neither on average nor vis-a-vis low or high capital banks. In addition, high and low capital banks lend to similar firms, so this could be a concern if we thought that there's selection, like I mentioned earlier, of riskier firms into partnering up with higher risk banks, lower capital banks. We do not see evidence of this kind of selection in the data in our sample. Importantly, the results are not driven by low capital banks being more likely to renegotiate loans. Everything that I have shown also bears in a sample of new loan originations. And everything that I have shown also holds up when we control for ex-ante default probability, so in risk-adjusted terms. So to conclude, Our main findings are that low capital banks tighten lending terms to zombie firms, which is inconsistent with the idea of zombie lending at US banks. By contrast, non-banks offer zombie firms more loans at easier terms. Zombie firms that are more dependent on non-bank financing have better performance and exit through bankruptcy less than their non-zombie peers. The implications of our work are as follows. First, bank capital regulation does not appear to affect banks' zombie lending incentives, so there's no distortion of incentives associated with higher post-GFC capital regulation. And at the same time, zombie lending seems to arise nevertheless in unregulated lending environments, such as the ones of non-banks, and I think that that has important financial stability consequences that surely the conference will speak a lot about. Thank you.
Thanks very much. Christian, please.
Hi, everyone. Thanks a lot to the organizers for allowing me to discuss this paper by Camelia, and because I'm at the ECB, the usual disclaimer applies. The background of this paper is, as we've heard now a couple of times already, this big migration of credit supply from banks to non-banks. So here it is again in a different figure taken from a recent paper. In yellow, you can see the share of syndicated term loans originated by US banks, and the rest is basically non-banks and a small share of foreign banks. You can see the share declining over time. And then very, very important question for academics, for policymakers out there is whether that's efficient. Is it good? Are we in a world where non-banks are simply better at supplying credit? For example, they have better monitoring or screening technology, and then this could be efficient, a good thing. Or is it that banks are better at monitoring and screening, but this in this case, this migration would be inefficient? Right? This paper takes a step at answering this question by focusing on zombie lending. So lending to firms that are essentially zombies that shouldn't be there. And the key message is that these zombie firms, this zombie lending is nurtured by non-bank credit. So essentially it says this is bad. Okay, this is a bad trend. So what exactly are zombies? Camelia proposed one definition. So here's another one. They're all very similar. It's essentially firms that shouldn't be alive, but they are alive because they are subsidized by cheap credit. And there are two hypotheses in the literature essentially on the origins of zombie lending. One is that it's driven by bank regulation that gives incentives to banks not to recognize impaired loans because that would increase their capital requirements. A second hypothesis is that zombie lending is not driven by bank regulation but is inherent to financial intermediation, essentially because lenders gamble on the chances of debt repayment. This paper proposes to distinguish these two hypotheses by comparing bank and non-bank lending. And the key results are that tighter bank regulation lead to less credit supply from banks to zombies, suggesting there's no zombie lending by banks. But at the same time, we see an increase of credit supply to zombies by non-banks. And so the conclusion is that non-banks and not banks keep zombies alive. Still, at the same time, there's some evidence that zombie firms borrowing from non-banks perform better, which hints at some differences in lending technology, and I will come back to that later. In general, the paper is very well written, the methodology is state-of-the-art. I don't want to talk about identification because I'm pretty convinced by it. So that makes my job very tough because Camelia's wish was for me to be very, very tough and try to anticipate what the worst referees of the world could say about it. Okay, so I try to challenge a bit the interpretation of the results and the overall story. Let me start by, I guess, a simple question, simple challenge that always comes up. What exactly is a zombie and how do we define a zombie? And there are various criteria in the literature, like firms that fail to cover their interest expenses with their cash flows and so on. What this paper recognizes, and what I very much like, is that, of course, zombie status is not exogenous, right? It doesn't fall from heaven, is very endogenous. For example, endogenous to bank lending, right? And so what this paper proposes is three criteria, essentially, for a firm to be a zombie, namely a firm that has low interest coverage ratio, high leverage, but then is also hit additionally by a cash flow shock. And the assumption, the reasonable assumption that this cash flow shock coming from oil prices is exogenous to the firm then justifies looking at causal effects of zombie status on lending decisions. So the paper proposed there's a transition from essentially distressed firms, which are before the cash flow shock already have low interest coverage ratio and high leverage, and then they transition to zombies with the oil shock. And I guess the head scratcher here is, why are distressed firms not zombies already? So what my proposal is to think less of zombies in binary categories, is like, this firm is a zombie, this one is not. To me, this just looks like this oil shock intensifies essentially the zombiness of firms. There's a continuum of how zombie-like you are, and then, you know, at the very end, if you're hit by all of these shocks, you're pure zombie. Okay. So that was my first comment. The second comment, so this is mostly on terminology. And the second comment is a bit more substantive about the regression that the authors run. So this is triple diff and diff. We heard about quadruple diff and diff, so very sophisticated stuff going on in this paper, which I generally like. What I'd wish for a bit is more an economic motivation of why doing this triple diff and diff interaction. You could think of various other specifications that are simpler to run. And my suggestion for an explanation is the following. If you think about firms, healthy firms and distressed firms before the oil shock, right, and then comes this oil price shock, the healthy firms, think of them as AAA rated firms, firms with a super low probability of default, this shock will have very little impact on the loan terms because repayment is very, very likely, right? You will not see the loan rate shift a lot because of this oil price shock for healthy firms. But firms that start out as being distressed with a high probability of default, when they are hit by the oil price shock, the probability of default is very sensitive, right? So you can think of sensitivity to information is very high for these firms. Okay, and then the beta coefficient here simply tells us this loan supply is more sensitive to cash flow shocks if they hit distressed firms relative to healthy firms. But does it apply that banks do not lend to zombie firms? And that's the key thing I want to challenge. And so far, a positive beta here only implies that banks lend less to more zombie-like firms. Okay, so I think there's an opportunity a bit to clarify in the paper. The headliner is US banks do not do zombie lending. What this says is they do less zombie lending, which is a slight but maybe important difference. And staying with this zombie lending result, what is really zombie lending? And is it evidence against zombie lending that zombies receive less credit when banks are more constrained, essentially when their capital requirements become larger? And there's a debate, a very recent debate in the literature about that, that says not necessarily. And the reasoning is the following. If you think about a frictionless loan market, right, then the loan rate should be the expected repayment, should be equal to the expected repayment in order for banks to break even. And that, of course, varies with borrower performance, right? So if borrowers are very risky, expected repayment is low, then the loan rate should be higher. So it should be actually an inverse relationship, but never mind. So a measure for the markup or subsidy should be something like the loan spread, the difference between the rate and repayment. Okay, so if you try to compute this, and I did it here on the slide in a very simple model, so you think about probability of default, loss given default, and then this break-even condition for banks here, you can back out the rate. And this would be kind of the competitive benchmark loan rate that banks should offer. You can see the higher the probability of default, the higher is this rate. And actually, this very simple equation gives you is very reasonable when you think about the sample that Camilla has in her paper. So in her paper, the average probability of default is 4%. The loan rate is 2.8%. So if you put this into this equation, you can back out the loss given default, 68%. Seems reasonable to me. Okay? So we can use this equation and think about what's the derivative of the loan rate to the probability of default. So that's very similar to what this regression does, right? You increase the probability of default, you make firms more zombie-like, right? So that's the derivative. That's the change in the competitive loan rate implied by a change in the probability of default. Now, in the paper, Camellia estimates that zombies have a 7 percentage point higher probability of default. What loss given default would imply, that requires an increase in the competitive loan rate according to the y-axis, okay? So the y-axis is the change in the competitive loan rate in this benchmark. What the paper estimates is that the loan rate increases by 24 basis points. What the simple exercise implies is the loan rate should increase by 5 percentage points. Okay, so what this says is, for this very simple model, zombies are much more risky, so the loan rate should be 5 percentage points higher. What the authors estimate is the loan rate increases by 24 basis points. So the difference between two is essentially a 4.75 percentage point subsidy to those firms. The loan rate increases by much less than it should increase, according to this benchmark. And this looks to me like zombie lending. Okay, so the question really is, what is zombie lending? And is it enough what the authors show, or do we need to go basically one step further? Okay, final point is about the non-banks. And I think there's two potential stories one can tell with the results. The first story is that non-bank financial institution, non-banks, they create those zombies. As you can see that when banks retrench, the non-banks increase their credit supply to zombies. In this case, we would expect a lower productivity of the weak borrowers of non-banks compared to those of the banks. But this final result in the paper I found very intriguing, because the paper shows actually the opposite, is that weak borrowers that are borrowing from non-banks seem to be more productive than the zombies that borrow from banks. And that speaks potentially to an alternative story, which is story B here, the one that maybe banks engage in zombie lending, not because of capital regulation. I am very convinced by this result, but still banks might engage in zombie lending because of evergreening. Non-banks, they sort into the weaker borrowers, especially when the banks retrench, but they have better monitoring technology. And so we observe a higher productivity of the weak borrowers if they're borrowing from non-banks. I think this is also consistent with the results, but it suggests a very different interpretation of the results. It suggests that this is not inefficient. And I think that is what we eventually want to get at. Is it efficient or non-efficient, this migration of credit supply from banks to non-banks? And if we observe zombies to become more productive when they borrow from non-banks, it seems to be good. Okay, some minor comments. I'm out of time. This paper provides an excellent deep dive into the allocation of bank versus non-bank credit supply across firms and helps pushing our understanding of the consequences of this credit migration. And I hope my discussion provides some suggestion on how to rethink terminology, but more importantly also entertain alternative interpretations of the results, thinking more about efficiency, I guess. Very strongly recommend to read it, and thanks for the opportunity to discuss it.
Thank you very much. So, Camellia, would you like to reply to some of the
thank you so much.
The tough points?
Excellent points, and tough indeed. So I did appreciate you raising, just 2 points. I appreciate you raising the issue of how we define zombie firms. So the literature takes sort of two views, a balance sheet view, where you just look at the number of weakness in a number of profitability metrics, leverage, inability to pay down debt, and poor sales growth. And then there's another strand of literature that takes the view, like the Caballero and Acharya type papers, that takes the view that zombie lending is lending not only to unprofitable, sort of economically unviable firms, but it's lending at cheap, subsidized rates. And so we do not adopt that other definition because we sort of want to let the data speak to us. We want to see what happens to the price of lending as firms are sent exogenously into zombie status. And we find that banks indeed actually raise prices. So that's sort of inconsistent with the idea of zombie lending in the sense of subsidized cheap credit. But another way to look at the data is to count the zombies according to the Acharya definitions, for instance, or the Caballero definition. And in the US data, you see absolutely, you see zombie rates, the number of firms that receive credit that are not investment grade firms and receive credit at investment grade prices, at the rates that investment grade firms receive credit, is extremely low. The rates are like 0.5 to 1% of firms in any particular year. So that's why our language is a little bit stark, but I do take your point that maybe we should not be as stark and always interpret our results in differential terms as opposed to more absolute statements such as that there's no zombie lending. And on lending technologies being different between banks and non-banks, absolutely, there are many factors that are driving potentially this migration. We don't take a view on what is the main factor. Lending technology could be one. Maybe there are distortions such as non-banks search for yield more than banks. There may be many factors, but we don't take a view on that. And I think it will be interesting to speculate a little bit in the paper.
Thank you very much. So we can open the floor for discussions. I have Javier here.
Thank you very much for the presentation. Javier Suarez from CENFI. I welcome very much Christian's points on efficiency because I recognize as a banking theorist, I feel a bit nervous about this notion of zombie firms. In the sense that the other side of relationship lending could be to temporarily grant credit at apparently unprofitable terms to firms with which you keep a relationship. So they look weak in flow terms, but might be fundamentally viable in stock terms. But that's just my initial consideration. On the other hand, according to, again, theoretical considerations, it will be extremely hard to justify why non-banks, if not enjoying safety net warranties or the like, why should they get involved in the bad zombie lending? So I really don't see what would be the logic to be supporting totally unprofitable lending. And then on your particular exercise and its contrast with the usual perception of what might be driving zombie lending by banks, perhaps what happens is that you have a very salient shock, which takes me to the view that probably what you are detecting is banks not getting more involved than non-banks in lending to firms that are observationally low performing when suffering an observable bad shock, whereas probably the theory of zombie lending is about non-observationally weak firms that you use as a gamble when hit by possibly not such a salient shock that will take supervisors to pay very careful attention to what is going on with your lending to those firms. So I would like to hear your reactions to this view. Thank you.
Over here, please. We take 2 questions. That's okay? Yeah.
Hi, Nicola Cetorelli from the Federal Reserve Bank of New York. So a question is for Camilla, but I think I could have asked the same question to Sabrina earlier. I think there is kind of a common notion that is, it combines the 2 papers, which seems to suggest that banks and non-banks are following some sort of parallel tracks, and they experience their growth and evolution somewhat driven by separate processes. An alternative view instead is that actually their growth and evolution is heavily intertwined. So to Camilla's paper now, I don't dispute at all the results of the paper, but I'm going to offer perhaps a challenge to the interpretation, or at least maybe suggest an alternative interpretation. So you are saying that banks are in fact not exposed to the zombie borrowers, while the non-banks are. One important stylized fact that is not in your paper, and it should not be because otherwise it would be too big of a paper, is that while it is true that the lending of banks may have decreased over time, and then again, that's the point that Sabrina, I guess, was making as well, that the discussant was also mentioning this migration. What is also happening is, in fact, banks are increasingly lending to non-banks. And it's not just balance sheet support, it's mainly off-balance sheet support. So you don't even see it on the balance sheet of the banks. And it is support in the form of credit lines. So it's, again, it's support to the very basic role that these non-banks are providing as lenders. And so this is related to Javier's point a second ago. How do they do it if they don't have the safety net? In a way, a possible interpretation is that they are actually getting a chunk of the safety net that banks receive from taxpayers, and banks can do it. It's actually profitable to do it, perhaps because, and I go back to maybe regulation, perhaps because regulatory costs on banks have increased over time, and so for banks becomes more profitable to actually shift their activity toward the non-banks. So it looks like the banks are not exposed to this type of risks, but perhaps indirectly they are, because if something goes wrong eventually in the credit sector and the non-banks are not going to be able, well, they will have to, at that point, use their support from banks, that risk will migrate on the balance sheet of the banks. Sorry, very long question.
Camelia, please.
Yeah, I think this is a great point. So maybe I'll go in reverse order. So to Nicola's point, so the rise of credit lines that offer liquidity backstop to non-banks is tremendous, and it's really, really important. I think a somewhat underappreciated fact is that these credit lines are not posing just liquidity risks. Should there be like aggregate drawdowns, imagine a recessionary environment or some stressed economic environment and an aggregate shock that leads a lot of non-banks to draw down credit lines from banks. I think little appreciated is that this would not only pose huge liquidity risks, but also capital risks. So there's a huge capital erosion when these credit lines would be coming onto the balance sheets of banks. They have regulatory treatment, capital treatment that is very advantageous. It's 5 times cheaper to hold those credit lines to hold the exposures off balance sheet than on balance sheet. And when they come on balance sheet and you have to provision capital, they bite a lot. So I completely agree. This is there's no direct exposure according to our story, but there's indirect exposure to zombie lending and then all the risks associated with that indirectly from banks via credit lines to backstop to non-banks. And then to Javier's points, we don't really speak to questions of efficiency. So, I mean, if we think that zombie lending is a capital misallocation, then in a world with a lot of, with non-banks supporting these kind of firms, we would see capital misallocation. And this is not something that post-GFC bank re-regulation ever kind of intended. So we do want to flag that these weaker firms are supported in what looks like evergreening by non-banks. We don't have any work on real effects, so I'm going to stay within the confines of empirical work because we don't have a model in the paper, but within the confines of our empirical work, we do not have, so we try to do a little bit of work on real effects at the local, sort of regional level, and some of the firm level outcomes or negative real effects that I highlighted do carry over to like industry, county, sort of aggregated data. So there's some evidence that the negative performance of zombie firms it carries over at the more local level, more aggregated level, but we would have to do a lot more to maybe speak about the real aggregate effects of zombie lending with any sort of credibility.
Thank you. We're almost out of time. There was a question over here, so if you promise to be short, and over here also, please.
Yeah, thank you. Heather Gibson, I'm from the Bank of Greece. I wanted to ask about the shock you're using. It's an oil price decline, which clearly is an exogenous shock. But I was wondering, have you looked at, who are these zombie firms? Because I would have thought that if the oil price shock had been an increase in oil prices, you would have got a broader effect across industry. Mm-hmm. Okay, so therefore, you know, the zombie firms would differ by industry, whereas an oil price decline, you know, how do you account for the fact that it's not just an industry effect rather than a zombie effect? Thank you.
And very quickly over here.
Thanks. Divya Kirthi, International Monetary Fund. Two quick questions. One, you know, I shared some of the thoughts that the discussant had and was wondering if you could kind of say something about how your effects relate to how distressed the borrowers are. And I think that would help with some of the questions in the room and also the discussant's questions. And something that might be relevant for future work, you did this really nice thing, you know, to figure out which lenders, you know, what's underlying that and who controls them. You know, I wonder whether the same kind of work on the borrower side for future work could be interesting. So you know, and in your shock specifically, you know, for example, did the oil firms that had PE sponsors look different? But more broadly as well, that could be interesting. Thanks.
These are great questions. On the really good question about the nature of the shock, so obviously there are interlinkages in the sectors of the economy. So this oil shock is affecting not only firms in the oil and gas industry, but also upstream, downstream. There are multiple effects. And so at some point in our analysis, we were sort of, you know, imparting this shock based on the beta of the industry to the oil shock. And we abandoned that strategy, but what we have right now is that the zombies that are created in other industries that are connected to the oil and gas industry would enter the control group. So they would contaminate the control group, and so in that sense they would work against us finding results, because everything is sort of premised on differential effects. But that's definitely a point well taken. The whole economy is affected by the shock. How distressed are the borrowers? So we'll definitely talk a little bit more about bilaterally to make sure I understand. We have some evidence in the paper showing that the oil shock is very consequential in terms of like producing zombies. And you can count the zombies using some definitions in the literature, or you can just look at their path of sales growth subsequent to the shock, and you see them suffer, like the oil and gas industry particularly suffers greatly from the shock itself. So, but I agree that some distressed, according to any metric in the literature of zombiness, some ex-ante distressed firms, which is our exposure measure, if you will, and that's Christian's point, will become zombies, and others will not become zombies, and they will all be in our treated group. So I take that point seriously. Yeah.
Great, excellent. We are also out of time. So thanks very much for excellent presentations, very good discussions. And let's break for coffee now. And I don't know actually when we have to return, but let's stop with a round of applause. Thank you. 11:10.
Welcome back to the second session on fire sales of the conference. My name is Simone Manganelli. I'm the head of the Financial Research Division here at ECB. And we start with the first paper by Gabor Pinter from the BIS, Fire Sales and Safe Assets.
Thank you very much. And thank you to the organizer for inviting this paper. This is joint work with Emil Siroardani at Harvard and Danny Walker at the Bank of England. So this paper looks at the 2022 LDI crisis of the United Kingdom. I'm sure most of you have read about that episode, which was partly driven by a surprise fiscal announcement by the Liz Truss government, and partly it was driven by frictions within the financial system, particularly amongst liability-driven investment funds and the pension sector in general. So these two explanations, on the one hand, the fiscal shock and the forced sales by LDI and pension funds, these two explanations need to be disentangled, and this is what this paper is trying to do. It's trying to basically give you an estimate of the relative effect, the relative contribution of these two forces. In particular, we're asking three questions. Question number one, why did the LDIs, these liability-driven investment funds, sell gilts? Question number two, what proportion of the gilt price fall was due to LDI selling versus the fiscal announcement? And question number three, where were the other buyers of gilts? Were alternative liquidity providers such as hedge funds unable or unwilling to buy these gilts? And let me just give you straight away the answers to these three questions. So why did the LDIs have to sell gilts? You might have read about this explanation related to lash risk, liquidity after solvency hedging, by Laura Alfaro and co-authors, and they emphasize that these pension and LDI funds entered into derivative positions in order to hedge solvency risk, and these derivatives needed topping up. Margin calls were hitting these positions when interest rates moved adversely. Now, liquidity or these margin call related risks indeed contributed to the crisis. We acknowledge that as well. It's a necessary but not a sufficient explanation for why we experienced the gilt market crisis. And one very strong argument is that the insurance sector, as I will show you, experienced roughly the same amount of liquidity shock that the LDI sector. Yet we did not observe any fire sales by insurance companies, unlike LDIs and pension funds. So that's not the full story. Was this about solvency by the pension sector as a whole? No, we find that pension investors in LDIs had enough assets to fully repay LDI debt. And the story that we're putting forth is that it's about balance sheet segmentation. So these LDI funds had a separate balance sheet from their pension sponsor, and that segmentation prevented from these pension sponsors to recapitalize these LDI funds in a sufficiently short period or time window. And I will tell you more about this. So question number two, what proportion of gilt price fall was due to LDI selling versus fiscal policy? So based on our econometric results, we find that selling caused price discounts of about 700 basis points. So this is an enormous magnitude, given that these liquid markets typically exhibit bid-ask spreads about 1 basis point on a normal day. And in terms of the relative magnitude, we find that fiscal policy roughly can explain roughly half of the fall in long-dated gilts, with the other half driven by the fire sales by LDIs. And the answer to question three, which is about understanding why other clients, such as hedge funds or other asset managers, didn't seem to buy these gilts straight away. And as I already alluded to that, we're trying to disentangle the inability of these hedge funds to buy the gilts from their unwillingness to buy the gilts. And that's notoriously difficult to disentangle ability from willingness. In the data, nevertheless, we find strong or suggestive evidence that it was their decision to delay entry to time the bottom of the market. So hedge funds were very good at buying these gilts when they hit the bottom, and they were waiting for prices to keep dropping before they came in to provide liquidity. So to leave you with the answers, basically, if I were to stop this presentation now, then the takeaway for you would be that the LDIs had to sell because of contractual frictions or balance sheet segmentation. The relative effect was roughly 50-50, so fiscal policy is roughly 50% responsible for the drop, but the remaining 50% driven by forced sales by LDIs, and other buyers of gilts strategically delayed their entry. Now, in the rest of the talk, I'm going to give you a bit of color, and I'm going to give you more background about how we arrive at these results. So first, let me give you a timeline of the events along with the dynamics of yields. So the first vertical line marks the announcement of the mini budget. So that was the 23rd of September. That was a Friday in 2022, after which yields spiked. And note that that increase in yields over that 4-day period between the 23rd and the 28th of September, that was enormous. So that was like 150 basis points. So these days we get jittery when US Treasuries move by 20 basis points. So COVID or even the great financial crisis was peanuts compared to what we experienced in 2022 in the gilt market in terms of price movements. So the second vertical line marks the intervention of the BOE. So the mini budget was announced on a Friday. Going into the weekend, we observed yields continuing to rise. And then Wednesday morning, the Bank of England came in to announce a targeted and temporary intervention to provide liquidity for the market, essentially to buy gilts for about 14 days till the 14th of October. So after that, yields collapsed. According to one narrative, it's because markets thought that this is basically the restarting of QE. And then we're observing that second hump converging to the second hump of yields when markets kind of learning that this was indeed a temporary and targeted intervention, which would come to an end on the 14th of October. The third vertical line marks another historic moment because that's when the purchases were extended to buy index-linked bonds, inflation-linked bonds, as well as conventional bonds. Prior to that, the Bank of England never bought index-linked bonds, not even when they started QE after the great financial crisis. So after the third vertical line, so that was a Tuesday when they announced that they're going to buy linkers as well, then we observe a gradual sort of consolidation of yields. And the last vertical line marks the end of the intervention. So as I mentioned, there are broadly speaking, two explanations: the fiscal event of the 23rd and the forced sales by LDIs. Before I get into the actual econometrics, let me just give you one slide on LDIs. So what are LDIs? So basically, defined benefit pensions in the UK invest in LDI funds while separately holding riskier assets such as equities. So LDI is essentially a hedging strategy for pensions. It ensures that the value of pension assets, the investments, moves in tandem with the value of their liabilities. So the pensions, and these liabilities are the contractual liabilities. These are the pensions that pension funds promised. So LDI funds predominantly hold gilts, and they use leverage via repo and other derivatives such as interest rate swaps to increase their exposure to gilts. Now, as I mentioned, we have three questions in this paper. Why did the LDI sell the gilts? So to answer that question first, it's very instructive to observe the amount of leverage that's in the system. So, and that was kind of revealing to us that if you look at the entire pension sector's leverage levels, debt levels were not excessive at all. So this is from the consolidated, basically, we're trying to construct a consolidated balance sheet of LDIs and the pension sector. So on the liability side, as I mentioned, you have contractual liabilities. So the size of the balance sheet is roughly 1.5 trillion pounds. Net financial debt is very tiny, it's about 77 billion. Relatively speaking, it's not a big number. Yet, when we check where that net debt is concentrated in, almost entirely that red shaded area is held by LDI funds. So just by looking at the level of leverage in the system, you may not see the fragilities. So that's kind of one of the lessons from this paper for policymakers. You have to look at how leverage is structured, because just the level of leverage itself may not reveal financial stability risks. You have to see how leverage is structured and where it is concentrated in the system. So in this particular example, that red shaded area is predominantly held or managed by LDI funds, who are roughly 2 times leveraged and hold mostly gilts. Again, even within the LDI sector, leverage was not that excessive, but it is sizable. So when gilt prices experience a 20–30% drop, then that sort of 2 times leverage can actually lead to problems. And these problems manifested themselves in deleveraging following the announcements. So the black vertical line marks the 23rd, so the fiscal event after which these LDI funds, they were reducing the leverage by essentially selling gilts and liquidating their repo positions, which were backed by these gilts. So it amounted to about 30 billion pounds of sales. Now, why did the LDIs have to delever? Because I mentioned, so this is a period when interest rates are rising. So pension funds in this kind of environment are better off, not worse off, right? Because the present value of their contractual pension liabilities are falling. And indeed, they fell more than the value of their asset fell. So pension schemes were better off, not worse off in solvency terms. So solvency cannot explain this. So this chart shows basically the insurance funding ratio for insurance companies on the right, the secondary axis, and the pension funding ratio on the left. For the UK in red, and for the Netherlands in blue. So we see as interest rates were going up, funding ratios got better and better. So is this about liquidity? As I mentioned, the Lash risk paper by Laura Alfaro is emphasizing liquidity issues. And this is probably one of the key pictures to rule out the explanation that liquidity mismatch can fully explain this crisis. Why is this picture so revealing? Is because it shows that insurance companies who had they have a similar business structure, so they're using repo and interest rate swaps to duration hedge, they experienced about an increase of 70 billion pounds in 2022 autumn in terms of margin calls. So that was roughly the same magnitude as the amount of margin calls that LDIs faced, yet in the data we don't see any fire sales by insurance companies as opposed to LDIs. So liquidity shocks themselves cannot explain why LDIs sold and insurance companies did not. So the explanation we're putting forth is, as I mentioned, balance sheet segmentation. So let me give you kind of a thought experiment. Here, I'm going to present to you 2 balance sheet structures, one where segmentation problems do not arise, and the second, which will mimic the kind of LDI structure. So if you have this sort of balance sheet, which kind of resembles qualitatively the pension sector's balance sheet, you have basically assets on the left and liabilities, margin debt, and portfolio equity on the right. And the second structure, whereby you're removing basically a lot of that debt from your balance sheet, and you will ask, as a pension fund, you will ask, let's say, BlackRock or someone, I don't want to So this is just an example, but BlackRock would set up an LDI fund for you, and BlackRock's LDI fund will manage some of your duration risk, whereby the pension fund now would invest into BlackRock, so that the green area would be your investment into BlackRock's LDI fund, but BlackRock's LDI fund would then use a lot of repo and other form of instruments to manage your duration risk. So if you have these two balance sheets, and if you observe a 20% fall in gilt prices, in the first example, you don't have any problems. In the second example, the LDI fund is wiped out. And this is exactly what we seem to have seen in the data, that you have these relatively highly levered LDI funds who, when they experienced a 20% drop in their assets, they were desperate to get cash to meet these margin calls, right? And the sad story here is that the cash was in the system. So the pension fund has, as I mentioned, pension funds as a whole, they were better off, not worse off. But as the Anil Kashyap kind of gave this story, that these pension funds, they meet once a quarter, they are in a golf course, it's going to take them 2 months to come back and have a meeting, and these LDI funds experience margin calls from Friday to Monday. So when, as I mentioned, the interest rate rise was unprecedented, 150 basis point increase in gilts. It's something we've never seen before. So going into Monday and Tuesday, they got wiped out very quickly. So they were very desperate to raise cash. The cash could not come in time, so they were forced to sell assets in order to get the cash needed. So that's the answer to the first question, and that's roughly the kind of stylized story that we're trying to tell to answer that question. Now, did LDI selling lead to lower gilt prices? And here, basically, we do a very simple diff exercise. We're going to sort gilts into two buckets. One bucket of gilts that were predominantly held by LDI funds before the crisis hit, and another gilt which was held by other investors. So we're going to make sure that these two buckets of gilts are of the same maturity. So we try to control for preferred habitat kind of effects. But ultimately, we're going to then try to keep track of the price dynamics of the bucket of gilts held by LDIs before the crisis and the control group. So that's the kind of diff exercise that we try to do to arrive at the second set of results. And we see basically a 7% larger drop for those gilts on average that had been held by the LDIs before the crisis. So that's sort of, sorry, this is a drop in prices. So the additional drop in prices coming from fire sales is basically this differential price movements, with the remaining effect plausibly coming from the fiscal event. And that 50% number or result that I mentioned at the beginning of my talk, basically we arrive at that by plotting the difference in price dynamics along the difference coming from this diff and diff kind of estimate. So on the right axis, you see that the cumulative return was about 15% after 3 days negative, and the differential effect from those gilts that were not held by LDIs versus those that had been held by LDIs, that was about 7%. So 7 against 15, that's roughly half the magnitude of the total price drop that can be explained by the forced sales, with the remaining driven by fiscal. So these are just summarizing the headline numbers. And where were the other buyers? That was question 3. Why did the hedge funds not coming in time? And the kind of revealing, and this is my last picture of the presentation, so this shows the cumulative buys of hedge funds in red, and 0 marks the intervention of the Bank of England. So here the punchline is that so hedge funds did come in and buy these underpriced gilts, but they bought most of it at the very last, basically, hours before the BOE intervened. And just to highlight, the kind of effect we're talking about here. Before the BOE intervention, a 40-year index-linked bonds was selling at about £48 in the morning, and after the BOE intervention, the 48 jumped to about £82. So in about 4 hours, you would have made a 50% return if you buy 2-3 hours before the BOE intervention. And in the data, we can actually see hedge funds buying the 48-pound gilts 7, 8 o'clock in the morning. The BOE intervention came about 10 o'clock in the morning. So they were really good at timing the bottom. And that's pretty much it. And I look forward to the discussant's comment. Thank you.
Thank you, Gabor. The discussant is Veronica De Falco from Imperial College.
Hello. Thanks, everybody, for inviting me to this conference to discuss this great paper on fire sales of safe assets. So let me start with a quick summary of the paper. So clearly, this is about the UK gilt market turmoil of 2022. And the market turmoil, this drop in prices that you have seen in the graph before, was mainly due to two components. One was this mini budget announcement, which you can think of as the fundamental shock, and another component, which is the amplification driven by fire sales of investors. And I think whenever you are in a setting with fire sales, there is somewhat agreement about, yes, there has been, some fire sales, moving prices, but the challenge is really, quantitatively speaking, how much these fire sales matter. And this is where I see really the paper coming in and bringing contribution in highlighting how these liability-driven investment funds were responsible for the fire sale component. And so the main contribution in my view of the paper is to quantify how much of the drop in price is coming from the forced selling of LDIs. And then the paper goes after questions around the mechanism of why did we have this persistent dislocation of the market. So you've seen that the prices didn't basically normalize until the BOE intervention. And so the paper is after kind of 2 points. One is why these LDI funds were selling in the first place, and the view of the paper, this is due to this delay in recapitalization coming from the pension fund sector, and two, why was nobody there to buy these bonds? And so the point is about, who are the counterparties that would naturally pick up these bonds, and I'll have a few comments about that. So my overall comments are that I really like this paper. I think it's really worth reading it, and I really like the draft because in some way I think the draft is simple and there's a simple story that the authors are trying to get at, and I think this is a great feature of the paper, and I totally recommend reading it. My comments are going to be about 3 specific aspects. One is this quantification of fire sale externality, which I think is really one of the main contributions of the paper. Then I'll discuss a little bit LDI counterparties and finish up with some more general takeaways. So regarding the first point, as I said, there's a kind of a clean and very simple identification strategy in the background, simple diff and diff. You take 2 gilts of very similar maturity, and the kind of identifying assumption is that they're both affected by the fundamental shock, which is this fiscal announcement in a similar way. And then you compare the ones more in the hands of LDI funds, and you attribute the relative change in price to these fire sales coming from the LDI funds. And the magnitude that I want to highlight is that they attribute half of this drop in price to fire sales, which is a relatively large number. Overall, I think I really like this. I think it's very much in line with what has been done in the literature in different types of settings. I think my main point is about providing maybe more evidence on quantities. So you have seen this graph where there's this diff and diff estimates plotted, and I think it would be nice to have a kind of counterparty of that on quantities to have a sense of how much the LDIs were selling and link in some way the quantity sold to the price impact, to have a sense of how much do we, was the market subject to sales in order to get this extra amplification effect. My second point, if the big question is like how much of these drop in prices was really driven by fire sales, I think, it's an even bigger question to understand why were there no buyers in this fire sale? And so the authors point to a bunch of points. Hedge funds seem to be a natural counterparty because they come into the crisis with short positions, so they could have taken the other side of the market. And they seem to be timing the bottom, so they really wait until the Bank of England is entering the market. And the authors also show that the market is quite concentrated. So even when they come in, the hedge funds in the end are really a handful of hedge funds. And so I think here is where maybe the paper could provide more information about the counterparties. My understanding of the data is that they can see who is buying from the LDIs when the LDIs are selling. And so I have a few suggestions about, there's one time series plot that you've seen of how much LDIs are selling over time. It would be nice to have a sort of counterparty flows of LDI sales to understand who are the counterparties that are buying these bonds. And at the bond level, to get to this point of, are the hedge funds really timing the bottom or are they timing the Bank of England? I think you could test at the bond level whether the net purchases by investors, how do they depend on the bond price dislocation by using your previous estimate. So they have this estimate of how much the price drop is driven by the amplification rather than the fundamental shock. And also to get to this point on coordination, whether, if you test whether the probability of a hedge fund buying is correlated to the probability of other hedge funds buying, I think we could learn a bit more about coordination. And I think there's one point to be made about why were not other investors also entering the market, and I think it would be nice if the authors could comment on this idea that potentially banks that are subject to regulation nowadays might be less able to absorb kind of short-term shocks compared to kind of a world without regulation. I want to point out that the paper is really trying to identify what's the specific mechanism and the specific fragility for which we had these fire sales. And so you've seen this idea that pension funds themselves were solvent, but because of this segmentation in the balance sheet, the LDIs started selling the bonds in comparison to UK life insurance that were subject to similar shock but didn't sell. But I think this is not kind of the first time, and I want to point this out, that the pension funds had an important impact in the UK gilt market. And so here I'm just taking two plots from Greenwood and Vaiano's paper of 2010, where they show the UK pension reform of 2004 set incentives for pension funds to buy long-term bonds. And so that's the graph on the left. So you see kind of the growth in long-term bonds holdings, and that had a strong impact on the term structure of interest rates in the UK gilt market, and subsequently the government started issuing more long-term bonds because of that. And the reason why I'm bringing this up is that I think the paper is very interesting, but it's important to sort of think through, okay, what are the lessons that we can take away from this gilt market dislocation? And I think there are a bunch of more general ingredients that I want to sort of summarize. One is that the investor base was highly concentrated. So the reason why I think LDI funds ended up, quantitatively speaking, to be so important is because they did hold a large ownership of the long end of the yield curve of these UK gilts. And as you've seen in one of the balance sheet graphs, they also had a balance sheet that was highly concentrated in these gilts. Then there were these elements of leverage, but leverage was not enough. It was leverage plus the segmentation. And this is, in more general terms, an idea of having internal slow-moving capital. Second, we have this idea of who is selling, who is buying when the LDIs are selling. And so this idea of a counterparty limits, and here I think the paper is very much highlighting the strategic point of hedge funds really kind of trying to time the bottom. But that could also be, more generally due to regulation if we want to think about when do we expect these kind of dislocations to be happening. And one of the lessons, I think, also for policy was that the Bank of England has recently done a kind of system-wide sort of stress level testing, which is called the SWES. And LDIs were indeed heavily covered in this part of the stress test operation. So just to conclude, I think this was a really important paper to have in the literature to understand better the LDI crisis. They provide convincing evidence of the fact that fire sales were indeed important to understand the price drop in gilts. And I think it's highly relevant for financial stability policy, and I think it would be also nice in the draft to have a bit more of these kind of general takeaways for policy. Okay, that's all I have. Thank you.
Thank you, Veronica. Do you want to quickly reply?
Thank you very much. Wonderful discussion. Just 4 quick responses. Your point is taken about the quantities. In this draft, we may not have shown a lot of results on quantities and flows. In the previous working paper, I showed that basically 3 LDI companies were responsible for the majority of the sales by the sector, we can recycle some of those results, which also highlights the second point you mentioned about concentration. So it's quite remarkable how concentrated these markets are, not just the LDI sector, which, as I said, is basically dominated by 3 firms, which also raises questions about, is this a macroprudential issue or a microprudential issue in terms of policy implications? But the concentration is not only pertaining to the LDI sector, but it's really about the hedge fund sector as well. So the UK hedge fund market is basically driven by 3 companies, and also 3 asset managers. So if you take like 9 firms altogether, that pretty much covers the activity of LDIs, hedge funds, and asset managers. Regulation, good point. That's a big question why these banks, the dealer banks or other banks, could not have substituted the hedge funds in providing liquidity for the LDIs. Just to give you an accounting, so there were about £36 billion of sales. The Bank of England bought 19 of the 36. Hedge funds bought about 9, and 9 billion was an increase in dealer inventory. So it's quite amazing that, and these dealers were clearly constrained. We know when we talk to them that they have inventory costs that are quite sizable. And this market is a 2 trillion market. So if you think about this, that a 36 billion pounds of sales could almost wreck a market of 2 trillion, that raises questions about the market structure or the ability of market and the dealer sector to absorb these liquidity shocks. And yeah, I think we can discuss very good points. We're going to take them on board. Thank you.
No worries.
Right, so question from the floor. If you could stand up so that the camera can see you, state your name and affiliation. And we have first question here in the front, second row. Oops.
Hi, Divya Kirthi, International Monetary Fund. Nice to see you, Gabor. So I had 2 related questions, which I think are kind of amplified by the quantity numbers that you just said, which is, so you're saying that kind of half of the impact is this amplification from the behavior of the dealers. And I was wondering, what would you expect if there was an exogenous wave of selling? So something had forced the LDIs to start selling, but there was no fiscal event. What do you think would happen then? How do you think that these results relate to a situation like that? And which I think relates to the point you just mentioned, which is very, very little going on with quantities, but a really big price impact. And I wonder if part of the reason that the hedge funds were so reluctant to come in, one explanation you offer is kind of strategic timing, but I wonder if another was kind of waiting to see how the authorities would react in a situation of actual fiscal uncertainty.
Let's collect a few questions here.
Victor Stabunos, the Federal Reserve Board, Washington, D.C. So it's an excellent study of the anatomy of the mini budget episode. Really enjoyed it. I have 2 questions. So the first one is about the decomposition of the decline in gilt prices by contributing factor. So I understand correctly, have a clean way of measuring the impact of LDI sales, and everything else is basically catch-all kind of bucket. And you attributed that to the initial fiscal impulse, if I got it right. In my understanding, the mini budget worsened the fiscal trajectory for the UK just a little bit, somewhat. So how come that the effect of that little fiscal impulse might have been so big? I feel like there might be some other amplification mechanism sort of built in there that you're not really capturing in your analysis. And then the second question is about the hedge fund strategy. Is it common for hedge funds to be able to time sort of purchases so well? It just sounds fishy. Thank you.
Here in the front.
Maria Assunta Giannetti, Stockholm School of Economics. I also want to pick on this interpretation of timing the bottom. I don't think it can be an equilibrium in presence of many hedge funds because each one would try to buy first. The way in which I interpret non-buying when there are fire sales is that the Sharpe ratio is not high enough because the variance of returns in the absence of the intervention of the Bank of England was too high.
Another one here.
Thank you, Robert, Swiss National Bank. Two questions there, but first, that really is very interesting. I mean, to this kind of deep dive into a topic where a narrative has been developing shortly after the crisis, and I think that only covered part of it. So thanks for that. Two questions. One about that timing dimension again. I mean, the impression really is that there was an information advantage for the hedge funds being able to time it a few hours before the Bank of England intervened, and that, I mean, would be a crucial. I mean, as you first mentioned that dimension of timing the bottom of the market, I thought, okay, that is a strong sign that the Bank of England should not have intervened, because then just let time work and hedge funds buy, and then the market would have recovered. But what I see on the chart is a different kind of story. So I would be interested to hear your views about what does it mean about, I mean, implication? Was it necessary for Bank of England to intervene or not? Or can you say something about that? And the other point was about the mechanics of what has driven that deleveraging. You've mentioned on your charts that there was a 2-to-1 ratio, more or less, for the LDIs between the assets and the equity. In your stylized example, then, you had a slightly different ratio. And for me, it makes a big difference because you were mentioning about 20% shock. And with a 2-to-1 ratio, that would not have erased the equity. And still, the mechanic took place. And there I was wondering if going deeper into the micro of it, there was some of the LDIs that had higher leverage ratios. And that would be important also from policy perspective to understand, okay, what was the weak point there to understand really also regarding policy implication on the regulatory level. Thank you.
Thank you. I have 1 minute. Oh, okay. Very good questions. Thank you. I have only 1 minute, so perhaps we can discuss it in the break, or most of the answers I would have. A recurring theme about the hedge funds timing the market. Yes, it may not actually mean that it's insider information. I would strongly agree that it might be evidence for informed trading. It could be equilibrium, by the way, that some hedge funds were special who bought these underpriced gilts. And actually in the data we see that the hedge funds who bought the gilts were the hedge funds who had a very strong relationship with the dealers who absorbed the selling pressure. So those hedge funds who were on the periphery of the network, they indeed could not disentangle whether it's a fundamental shock to the gilt market, i.e. now the UK is becoming Argentina, or these bonds are cheap because indeed it's a fire sale happening. So most of the participants we talked to indeed suffered and struggled with this information or signal extraction problem. How much of the price dynamics is driven by the selling pressure, how much of it is actually a change in the regime. I would disagree with the point that because the fiscal measure was tiny, it was actually quite big. Larry Summers, I think, called it like fiscal stimulus on steroids in real time. And then they doubled down on it as the weekend happened. The Chancellor of the Exchequer on Sunday announced new measures of tax cuts and capping and other measures. So they kept adding to the unsustainability of the package, which then financial markets we're pricing in instantly. But yeah, I don't want to use time of the next speaker, so I'll
continue
happy to
the break with the discussion. Thank you very much. The next presentation is by Diane Perrier, University of Luxembourg, on similar investors.
Right. Thanks to the organizers for including our paper in the program. So first, to clarify the title, our investors are similar because they hold similar portfolios. Their portfolio composition is similar. And while it's an empirical paper, it is primarily motivated and inspired by a large and an extended theoretical literature that model the liquidation value of assets endogenously based on the constraints and more broadly the characteristics of the investors that are most likely to sell and buy those assets. And in this paper, we specifically focus on the possibility that liquidation costs increase with the portfolio similarity of asset holders. These asset holders who have similar assets in their portfolios are exposed to correlated losses, and the assets that are held in such similar portfolios are going to be exactly and specifically difficult to liquidate when the similar investor needs liquidity the most, as opposed to a non-similar investor who can wait for the asset value to recover. So this paper is about the question whether investors internalize this risk of higher expected future liquidation costs from holding an asset that is held also by other similar investors. Testing for endogenous liquidation costs is generally challenging empirically because it entails separating the part of the liquidation value that comes from fundamental characteristics versus the part that comes from characteristics of asset holders. Now, to do that, in our paper, we're going to focus on a specific lab, which is US money markets. And our investors are US money market funds that invest unsecured in security issuers in the form of certificates of deposits and financial commercial papers. And these security issuers, most of the time, are banks. Why we think this is an appropriate lab to study this question? First of all, money market funds are susceptible to runs. They are not covered by deposit insurance, which increases market discipline and gives them incentives to monitor such risk and monitor liquidity risk. They face difficulties in liquidating assets to meet redemptions. They are constrained by regulations in the type of assets they can invest in, which shrinks the pool of available possible assets and mechanically increase the overall level of portfolio similarity in this market. And then, importantly, for empirical strategy, due to post-crisis regulations, money market funds can observe the portfolio compositions of other funds since they are required to disclose their portfolio composition on a monthly basis. So while the theory could hold for any investor in an asset, we are here concentrating our empirical study on money market funds that invest in security issuers in the form of certificates of deposits and financial commercial papers. What we do in the paper, we construct a granular measure of portfolio similarity. Then we test whether investors, the funds, react to portfolio similarity. Do they divest from assets that are held by similar investors? To abstract from considerations about the quality of the collateral, we focus on unsecured funding, which centers our analysis on prime money market funds. We have about 200 funds investing in 300 security issuers, and these security issuers half of them are banks. Also to abstract from considerations about the fundamental characteristics of the issuer, we're going to compare several funds investing in the same security issuer at the same time. And then at a more aggregate level, we aggregate similarity, portfolio similarity at the issuer level and explore the consequence of being
so borrowing from investors that have similar portfolios on issuer and here banks funding fragility. So we're going to look at several outcomes at the issuer level, correlated withdrawals, funding outflows, and the cost of funding, so yields. So the theoretical background for this paper is primarily based on a model of Wolf Wagner, who highlights this trade-off between diversification and diversity that investors face. And we try to illustrate with a simple example here of two funds that can invest in three different types of assets, three different issuers. If the funds fully diversify, they will end up with the exact same portfolios. Now the paper tells us, well, without frictions affecting liquidation costs, this is the optimal strategy. But once you have frictions like joint liquidation costs that are systemic, which means they're going to be disproportionately higher when multiple funds liquidate at the same time, then investors start deviating from full diversification and start having a preference for holding more different, diverse portfolios. So our results, hopefully, speak to this model. First, at the fund level, when we compare several funds investing in the same security issuer at the same time, we find that the most similar funds are the ones reducing the exposure to the security. We interpret that as similar investors divesting in anticipation of higher liquidation costs. Now, it's important to point that it's an ex ante concern about liquidation costs. It doesn't mean that liquidation costs have to realize ex post, but if they do realize ex post, that means the ex ante concern were probably right. And we expect that the result of that portfolio of similarity has an impact on the divestment decision is stronger in those cases. And this is exactly what we find, that the response to portfolio similarity is greater if the security is reported as illiquid in the next month. It's also greater when the fund is more exposed to liquidity risk. So this is our link with liquidity. We interpret as a fund decision to divest, and so this is a bit similar to standard studies of credit supply, except that here we don't have a bank lending to a firm, but a fund lending to a security issuer. So to further corroborate this credit supply effects, in addition to our empirical strategy with saturated fixed effects, we analyze the differential response between retail and institutional funds, knowing that institutional funds are more actively managed. But the retail and institutional funds in our setting, in our analysis, are both prime funds, so they don't invest in totally different assets. And we find indeed that the response to similarity is driven by institutional funds, suggesting that monitoring portfolio similarity is part of active management. We also, to address endogeneity concerns, have an instrumental variable strategy where our instrument captures the variation in portfolio similarity that comes from changes in the portfolios of other funds due to their idiosyncratic redemptions. We speak to the trade-off between diversity and diversification, as we find that the effect of portfolio similarity depends on the initial level of portfolio diversification of the fund. If diversification is low, portfolio similarity is not the main driver of portfolio allocation decisions because diversification benefits are still large, so the funds will seek additional diversification. But it's when diversification, the initial diversification level of the portfolio is high, then that's when we see the effect of portfolio similarity and exposure to liquidation costs being a concern. Then at the issuer level, we find that there are consequences for the funding fragility of the issuer with more correlated withdrawal, funding outflows, and higher yields for issuers that are exposed to similar investors. So in the rest of the talk, I'm going to try to explain how we construct our measure of portfolio similarity. Then I will describe the result at the fund level and then at the issuer level. So similarity, first of all, comparing the portfolios between two different funds, we use a Euclidean distance on the portfolio shares between Fund F and another Fund Phi. Now, when Fund F considers its decision to roll over funding or to divest from a security issuer, the Fund F will look at the other funds that are exposed to this security issuer. And so we're going to average the pairwise distance of Fund F with the other funds, with the weighted average, where the weights are given by how much the issuer relies on the other funds for its total funding. So this is a measure that is both fund and issuer specific, because we have these weights that describe how important are the other funds for the issuer. And it's fund specific because it's the similarity of the Fund F to the other funds investing in the issuer. We also remove issuer I from the portfolio shares here to avoid concerns about reverse causality. So this is a distance. It tells us how different the portfolio of Fund F is to the other funds investing in issuer I. We rescale it into a similarity measure, which is going to be 0% for the least similar funds, and 100% if Fund F has the exact same portfolio than the other funds investing in issuer I. So our results at the fund level, as I said, we're comparing several funds investing in the same issuer at the same date. So we're going to look at the effect of portfolio similarity on outcomes, which is the probability to divest and the percentage change in the exposure of Fund F to issuer I. Now, as I said, this is similar to standard studies of credit supply, except that it's not a bank lending to a firm, but a fund lending short-term to an issuer. So instead of firm time fixed effects, we have issuer time fixed effects. So this is a Quagmire style regression. As usual, there's an underlying identifying assumption to it, which is going to be violated if a higher portfolio similarity of investors is systematically accompanied by decreasing funding demand from the issuer. And I'm going to come back to this in 2 slides. So our results show that in column 1 for the probability to divest and the column 5 for the percentage change in exposure, we have here the effect of a 1 percentage point increase in portfolio similarity, which we translate in a 1 standard deviation increase in portfolio similarity that is going to increase the divestment probability by 0.7 percentage point, and the fund exposure will decrease by 0.87%. It seems small in percentage terms, but in dollar terms, this effect corresponds to more than 3 times the unconditional average divestment between a fund and an issuer. Now, as I said, to link this to liquidity risk, we are going to look at securities that are going to be illiquid exposed. These are ex ante concerns, so we don't expect this to only happen for securities that are indeed illiquid, but when the security becomes illiquid exposed, the ex ante concern was right. And we find there that in terms of economic magnitude of the effect, we have much larger effects. So we compare here the average effect, which was on the previous slide, to the effect of portfolio similarity when the fund will report the security as illiquid in the next month. You see that the 1 standard deviation increase in portfolio similarity increases the probability to divest by 24 percentage points, and the exposure decreases by almost 11%. Coming back to my identification assumption, what if the fund portfolio similarity and the issuer's funding demand are correlated? So to speak to this result, to push back on this violation of the identification assumption, we have 2 sets of results. First, we compare the response to similarity of institutional versus retail funds, and we find that this response to portfolio similarity is only and exclusively driven by institutional funds. It's not there in retail funds, which is something we find reassuring when you have actually a result that is not there when it shouldn't. So we interpret this as institutional funds being more actively managed and the monitoring of portfolio similarity being part of this active management. We have these additional results with an instrumental variable, which I don't have much time to explain in details, but basically we're going to look at the variation portfolio similarity that comes from shocks at the other funds. So this instrument is a Bartik style instrument, a shift share style instrument, and the shifts here are the exogenous part. These shocks are redemption, idiosyncratic redemptions at the other funds. We find the results also hold there. Then about the trade-off between diversification and diversity, as I already mentioned, there is this effect of portfolio similarity will be muted if the diversification level of the portfolio is low to start with. When the diversification of the portfolio is low, diversification benefits from additional diversification is still the primary motive of investors, such that we find that this effect of portfolio similarity disappears for concentrated funds with an HHI of 40%. Now, at the issuer level, if I have a little bit of time, I see I have a bit more than 3 minutes left. Now, when we look at the similarity of the funds that invest in an issuer, we're thinking here about another layer of concentration risk. You can basically try to diversify your liabilities by resorting back to multiple funds. However, if all your funds have the exact same portfolio, it's like basically borrowing from only one fund. And so this is what we try to show in this last part, that after controlling for other measures of diversification, like HHI of the issuer's liabilities or the number of funds the issuer is borrowing from, there is an additional effect of the portfolio similarity of the funds of an issuer. We look at different outcomes, which are access to funding, so the percentage fund flows to the issuer, correlated outflows, the fraction of funds divesting from the issuer, and also the cost of funding for the issuer, so the average ex-ante yields on the securities issued by the issuer. We find that conditional, so controlling for other measures, classical measures of concentration risk, the average fund similarity of an issuer predicts fund outflows and correlated outflows for financial firms mostly. And on the cost of funding for the yields of this issuer, we find that there is actually no effect of portfolio similarity on the yield in general. However, when there is aggregate stress in a crisis, portfolio similarity is accompanied with larger yields for this issuer, and it is particularly the case when the level of aggregate systemic risk is high, as measured by popular measures of systemic risk here, as so S risk of Bromley and Engel, delta Kovar of Adrian and Runemeyer. When these measures are high, this is when portfolio similarity drives higher average yield for the issuer. So this is the paper. We show that evidence that investors internalize the risk of future low liquidation value of the assets that are held by similar investors. These similar investors divest in anticipation of higher liquidation costs. The response is greater when the security will be reported as illiquid in the next month. and the fund is exposed to liquidity risk in general, has a low ability to sell assets, and it's driven by institutional funds. We have this trade-off between diversification and diversity, where searching for diversity and the exposure to future liquidation costs is a concern for investors that are already diversified. And finally, we show that there are implications at the issuer level in terms of access to funding and the cost of funding. Thank you.
Liliane. The discussant is Andreas Rapp from the Fed Board.
Thank you very much for having me. This is an excellent conference, perfectly organized, so I'm enjoying it a lot. I also enjoyed reading this paper a lot. It has been around for a while and is extremely polished. It has also been discussed by many excellent discussants, so I tried to give my best to find points of criticism, and I might be overly critical, but I'm trying to be that nasty referee that was earlier referenced. So the paper in a nutshell. The research question essentially is one, those are my own slides actually, but that's fine. The research question is one where we ask, the authors ask, do investors divest from assets when their portfolios are highly similar to those of other investors because they anticipate higher liquidation costs? And this is based on a theoretical paper that's actually tested here, where investors prefer to hold diverse portfolios because they reduce the likelihood of joint liquidations. Where is this coming from? If we have similar portfolios and everyone's selling at the same time, but there's not enough cash in the market, then the prices will collapse. So there's a trade-off between diversification and liquidation risk from holding similar portfolios. And investors preemptively choose, diverse portfolios. In the US, we'd say unique now, to avoid this. Relevance of the paper is one where portfolio similarity amplifies fragility because investors are crowded in similar trades. And this is particularly relevant in the case of money market mutual funds because they're prone to runs. And what the paper does is it highlights an endogenous source of systemic risk, funding supply shocks due to similarity. What is the data and empirical approach? So they use US data from the period of 2010, late 2010 to 2014. This is unaffected by any reforms in the money market space, but it falls into the euro area debt crisis. And I'll be going back to this point a little in the future. They focus on unsecured debt that is held by these funds, by prime funds. So we're looking at CD and CP. And what they try to do is they try to measure the similarity between mutual funds at the fund issuer level with a novel approach, with a novel measure, and then they try to identify the investment behavior in response to similarity. This is based on sort of a high-dimensional fixed effects regression. The identification assumption is one where we have funding supply shocks due to similarity that need to be orthogonal to funding demand. And then they tackle, various indigeneity issues carefully. I think they look for, reverse causality. They control with a lot of fixed effects, and they have the Bartik instrument. So overall, it's carefully done. What they find in the end is that higher similarity indeed predicts higher issuer outflows. We see divestment, and we see sort of reducing the amount that you hold in the investor that are sizable. Effects are sizable. And then there's also interesting heterogeneity in the paper where they compare different subgroups. So let me get to my first comment. The identification assumptions. So what they're essentially arguing is that changes in MMF's behavior due to portfolio similarity are not systematically related to changes in the issuer's desire to borrow. But the issue is that the Moody's rating that was issued in June 2011 that actually sparked the entire episode with massive redemptions is a shock to both entities, which I find difficult. Because mutual funds are shocked because suddenly investors are worried about the issuers they're holding. And they're especially saying we're withdrawing our money from you because you hold these European banks. The European banks, on the other hand, their perceived credit risk has increased. So what they're thinking about now is, all right, if my unsecured debt is at risk or is perceived as being at risk, then why not go with secured debt, right? So I think this shock essentially leads to issuers potentially halting their demand for unsecured debt, but increasing their demand for secured debt. And that is confirmed if there's sort of a report that came out in 2015 from Fitch that was arguing, yes, what we see is that suddenly these money market mutual funds are primarily borrowing repos from banks. So what I'm arguing is that I think the funding supply and the issuer's funding demand are endogenously correlated through that shock, at least in that short period of time. And you might say that the period of time in that sample is not long enough to make this systematic, but I think it's something that the authors could potentially tackle. And what I'm thinking is maybe a test where you look at the second half of the sample period and exclude the first half of the sample period will do, because as you say, your paper is about anticipation of liquidation shocks, not so much about the realized liquidation shocks. So yeah, what I'm arguing is, so what we might be seeing is that the inverse observed divestment might not be because it's a pure supply-side driven shock, but also demand-side driven shocks, because banks are suddenly they're reducing their unsecured debt, they're not issuing that anymore, and they're issuing their secured debt. The shock or the test where they compare institutional to retail investors is also one where I'm a little bit critical, because if you look at the outflows, the redemptions from institutional to retail funds, then what I see here is that it's primarily institutional funds that were affected, not so much retail funds. So with lack of redemptions, more passive management, and less exposure to European funds, there's just not that much required divestment needed from retail funds. Also, the lack of inflows does not allow them to step up and fill the gap that institutional funds have posed. Also, given the limited size that retail funds have, I think they're not in a position to actually change the issuer demand response that will focus on issuing secured debt to institutional money market funds. So we could consider, I think you should consider both forms of debt, not just one. The next comment is about fire sale mitigation. So the redemptions are driving, in my opinion, key parts of the results, and their impact is not entirely accounted for, in my opinion. So there could be the idea that minimizing liquidation costs during the redemption period may supersede the portfolio decision-making that you have in place. And there's negative spillovers, and they're worst if there's pro rata disinvestment. An example how we could mitigate this is just using cash, for example. So I would ask the authors to potentially control for outflows in a scenario where we have an interaction term between outflows and similarity, because that would allow you to pinpoint the pro rata disinvestment and then the one that's actually driven by similarity. Also, one thing, I really like the test that you do with the illiquidity instrument, but then what I don't like that much is that you call the WAL and WAM measures liquidity ratios, because to me they're primarily about interest rate risk and maturity risk, and not so much about liquidity risk. The actual metric that the regulator had in mind, DLA, also daily liquid assets and weekly liquid assets, is not used, maybe for good reason, but I'm wondering why you're not using the actual liquidity ratio at the fund level to potentially control for this. The second comment is about, the third comment, sorry, is about similarity and reach for yield. So with these type of studies, there's always the concern that what you're picking up is not so much similarity, but just similar investment strategies. So what I have in mind is one where we have reach for yield, where faced with actual redemptions, this story sort of ends. You're investing out of the crowded trade, and we see disinvestments. So if we contextualize what we know about money market mutual funds in crisis, then it is that they react to risk-taking opportunities. What we have is European banks offer high yields. They have a performance flow relationship, which suggests that there could be a reach for yield, and higher credit risk and illiquidity is a consequence of this. We have fund flows that are highly responsive to fund yields. So we have roundable clientele, and we typically find that the money market mutual funds that suffer the strongest outflows are the ones that have the highest risk-taking. If we then go to the summary stats, then I'm thinking the similar versus non-similar funds seem to be going into this direction. So what I would want the authors to do is first to potentially also provide a split where we have similar split into institutional and retail, just to better understand where this is coming from, but then to also account for risk for yield controls, What matters is not the raw performance, is what you have in the regression right now, but the relative performance. And I would want two measures. One, where we potentially compare the yields that the fund gives relative to the industry, and then the yields that the fund gives relative to the family. Because what I have in mind is ultimately is that within a family, managing liquidity risk is easy, but within across families, it becomes difficult. And you might have, for each family, you might have one fund that is showing risk for reach for yield behavior. And it's these funds that are showing this risk for yield behavior across the families that are ultimately ending up as the similar funds. And the last comment about issue of funding vulnerability, I like overall how where this direction was, or the paper is moving there. There was an updated version of the paper last week where the yield analysis has been taken into account. What they do is they link the vulnerability to stock performance. I don't like that too much because I'm thinking there's lots of other things that are affecting stock performance, especially in this period of time where it's centered around the European debt crisis. Why not link this to alternative funding of debt? And that's what they're doing, right? They're looking at yields. We could also look at the composition of debt. How is it changing within the funds, secured versus unsecured, and how that potentially not within funds, within the issuer, and how that potentially affects the cost of capital. And the last point is then I'm going to wrap up because I'm a little bit over time. European banks were hit hardest by the loss of dollar funding, and the key is the dollar in that sentence. And it would be very interesting to look at the dislocations that they face because of their dollar exposure and link this to the vulnerability at the issuer level. And you could try to do that potentially at the country level with this paper from the BIS, where they quantify certain countries that have higher debt exposure, or you could do that also by the uptake in the facilities, because the facilities were also opened up and there was uptake in the European, the Federal Reserve Board and ECB facilities for liquidity swaps. And you could take that into account to potentially differentiate periods of funding stress in the dollar markets. Thank you very much.
Thank you, Andreas. Diane?
Well, first of all, Andreas, thanks a lot for the thoughtful discussion. There are very good points. I'm not sure I'm going to have time to answer all of them, also because it was sometimes a bit quick. But the first point on the identifying assumption, I think one thing that might push back this is that actually a lot of the results at the fund level also, they hold for US money market funds that were not exposed to Eurozone issuers. So maybe this would also help rule out the fact that this is just the European crisis, and the redemptions caused by the exposure to European issuers that are driving the results, because these US money market funds had actually not exposed to Eurozone, didn't have the same redemptions. Also, it's not, while the yield results, so at the issuer level, are sensitive to in which periods you measure those, so it's primarily about an aggregate, stress period. The result at the fund level is not sensitive at all to the crisis. So it is there all the time. It is there during the crisis, but it's also, so there's no differential effect of the European sovereign debt crisis. But I should mention that maybe more in the paper. I will look at the suggestion. I also appreciate a lot that this is not only critical comments, but there is also a lot of suggestions on how we can deal with that. And I will look at other measures of liquidity risk. So concerning the reach for yields, well, there is a little bit of the control for issuer risk that is taken care by issuer fixed effects. But also we show that, and this is in appendix results, but that the effect of portfolio similarity is stronger for riskier issuer. So it's not only about issuer risk, but there's also this interaction which makes it stronger. Then I think I should stop so we can also take
So again,
questions.
if you could stand up and state your name and affiliation. We have one here, next, and here in the front.
Christian Kubica, ECB. Thank you so much for the great presentations. I have one question to Diane. I might have missed it, but you're talking about, or you're defining similar investors purely by their portfolio holdings, right? And then you relate to Wolf's paper about the fear of joint liquidations. And what's in the background is, I guess, the similarity that comes from similar outflow patterns, correlation in redemptions, right? Because in the end, as a money market fund, you liquidate when there's outflows. So if the other investors that are similar to you have purely uncorrelated outflows, I also don't care much about them. I only care, or I only fear joint liquidation risk when there are other investors that hold similar assets and their outflows are correlated to mine. And that might give you another layer, actually, of heterogeneity, because you can easily look at the correlation of outflows of those funds. And this should intensify the effect that you find, I guess.
Russ Warmers, University of Maryland. There was a natural break in 2009 or 2010 where institutions versus retail investors were more strictly segregated in money market funds. I'm wondering if you can look at that as a potential shock to look at as well. Before that period, in my paper in the AER in 2016 with Larry and Alan, they were pooled together, and we found that retail investors provided a buffer. They were slow-moving capital. Afterwards, it would be interesting to see if this afterwards, this effect is intensified.
Thank you.
Victor Stebanos, the Federal Reserve Board at Washington, D.C. I appreciate that you tackled a very challenging question, and I might sort of complicate the story a bit more, maybe not. I was sort of wondering how the contemporaneous divestment costs factor in this analysis. So, for example, if I run a fund and I'm exposed to like a particular issuer of a commercial paper, it's very easy for me to basically get rid of this kind of exposures. I just wait a night and I'm done, right? But when I think about being a fund and being exposed to this undesirable issuer with longer term instruments, I guess we're talking about like 360 days or something like that. Do you really want to sort of dump this exposure to loss? Or not. So how sort of contemporaneous divestment exposures kind of costs may sort of factor into your analysis? Thanks.
One last one very quick, because you're out of time.
Yeah, Christoph Basten, ECB, just a brief one. Have you computed the similarity at different granularity? I'm thinking US government bonds with the same maturity might be nominally different, but might be practically the same.
Diane?
Okay, well, thanks for the questions and suggestions. So about portfolio, so the similarity that comes from portfolio holdings versus correlated outflows, I think that you're right, that the liquidation costs will happen, will realize when both are together. Now, what we are here, the results are about an ex-ante concern. So you try to, should redemptions happen, you try to become less similar in your portfolios to avoid large liquidation costs. That's more or less the story. But I agree with you that we could also look at correlation in redemptions. Russ, thanks a lot for your comment. I will look into it. I don't want to speculate about what the result should be and if I can apply this in my sample period, because we also only observed starting in 2010 this portfolio composition because of the post-crisis regulation. About divestments, these are actually the divestments are most. It's about not rolling over an exposure most of the time. So this is how the ex-ante manage to reduce the portfolio similarity. And talking about similarity at different level, I should look at more
about different other levels. What we did is to look at similarity at the fund family level. So that's unrelated to your question, but when you ask the question about different levels, we look also, and it holds also at the fund family level. So it's not that there are substitution possible between the different funds of the family here. Yeah, I think I'm over time. Thanks a lot for all the
So
questions.
we now have a lunch break. Lunch is served downstairs. Just follow the crowd, and then we resume at 1:30 for the first panel discussion. But let's first thank the speaker with a round of applause.
All right, this is exciting. Just received the go to start with the panel. Welcome back, everybody, after lunch. My name is Nicola Cetorelli. I'm the head of financial intermediation at the Federal Reserve Bank of New York. And by way of advertisement of this event, I'm also a co-organizer of this MBFI event. And just so that everyone knows, for those that don't know, maybe people on the live stream, a reminder that the ECB and the New York Fed co-sponsor this annual conference. We take turn hosting. Last year, it was the inaugural event in New York. This year here. Next year, we hope to continue this tradition. The goal is to bring together every year academics, policymakers, practitioners to follow trends, discuss what might be the hot topics related to non-bank financial institutions and the overall evolution in financial intermediation. Today, I'm also playing another role, that of moderator of this panel. We are extremely lucky that we have an outstanding panel today, an amazing lineup. What I'm going to do, I'm just going to very quickly introduce the panelists in the order in which they will give their remarks, and then after that, they will give their remarks, and then it will be open discussion. And so, without further ado, the first panelist to speak is Itai Goldstein. Itai is the Joel Ehrenkrantz Family Professor and a Professor of Finance at the Wharton School of the University of Pennsylvania. He is one of the most well-known academics, experts in the area of corporate finance, financial institutions, financial markets. Some of his papers by now are recommended, required reading, I think, in probably in many PhD classes. And some of his contribution at this point, he may have reached that level of notoriety where I guess he's not even cited any longer. When some of his, accomplishments are just, mentioned by others. And so we are very excited to have him here. The second to speak will be Douglas Elliott. Doug is a partner at Oliver Wyman in New York. Doug focuses on financial institutions and financial regulation. What brings to us is a very wide and very deep range of perspectives. Before entering in the global consulting management at Oliver Wyman, Doug was a fellow at the Brookings Institute in DC, and before that, for 2 decades, I think, he was an investment banker. So he can play many different roles related to these important topics. Last, but definitely not least, my old friend, Maria Assunta Giannetti, the Katarina Martinsson Professor of Finance at the Stockholm School of Economics. She's also a CEPR Research Fellow and a research member and Fellow of the European Corporate Governance Institute. Maria Assunta is another extremely prolific scholar, very, very influential, and she covers a very diverse range of topics in the broad areas of corporate finance and financial intermediation. So I hope you will all enjoy the next 70 minutes or so. And so with that, we'll start with Itai. The lectern is yours.
Okay, thank you. It's great to be here in this panel. I learned today that there is a level of notoriety where you're no longer cited, so now I know what I should look forward to. And I will give some remarks on fragility of non-banks, something that I've been working on for many years, give you a bit of my journey on that and how I think it connects to some of the things that we see today. People told me before the panel that they don't know what the panel is about because the program did not have a title for the panel. So I thought the title of the panel is probably the title of the conference, which is broadly about non-bank financial institutions and fragility. And I think this is what we will all talk about. It's kind of strange to talk about non-banks because It is defined by what it is not. So in order to understand it, we have to start by thinking about a bank. And the two pictures that you see here are from the Nobel announcement of the prize a couple of years ago that went to Diamond Dybvig and Bernanke about the theory of banking and bank runs. And I think, you know, I use it in my MBA classes as well, kind of showing what banks are supposed to do. In the upper picture, you see that people put money in the bank, the money is sort of traveling around the economy, but they are kind of ready to take it out whenever they want it. And of course, the problem with that is this is liquidity transformation that is very valuable. But as you see in the bottom panel, it is also prone to panic. So if everyone at some point thinks that everyone else is going to take their money out, you want to do it before them. And this is where we see these moments of panic. So my journey with non-bank financial intermediation we started writing the first paper about mutual funds actually in 2007, was published in 2010. But it came as we started thinking that you know, some of these things, this liquidity transformation and fragility, are starting to show up also in other financial institutions. And we focused on mutual funds that over time became more and more prominent. So I'll briefly just show it to you with three pictures, kind of a highlight picture from each one of the papers, just to kind of highlight how it evolved and how it became more and more prominent and significant over time. And then I will talk about some of the implications that I see for today. By the way, if you think about mutual funds, the basic story is people can take their money out at any moment, and what they're getting is the current value of the asset. But then the fund is going to start selling, and all the liquidation costs are going to be imposed on those who stay. And this is why we have this liquidity transformation that we see with banks. So, you know, back in 2010, we looked at equity mutual funds, and you see that it was there in the sense that the sensitivity of outflow to bad performance is stronger in funds that are holding more illiquid assets. So when you have this liquidity transformation, people are more prone to take their money out. The sensitivity is higher for illiquid funds than for liquid funds. You see that it's there, but then you also see that in terms of magnitude, it's not as big as you would expect, because even the most illiquid equity funds are still not that illiquid. Things have progressed since then a lot, and the 2017 paper that we wrote, we focused on corporate bond mutual funds. And there, what you see, if you compare those two graphs, one is for equity funds, one is for bond funds, you see that the famous convex flow to performance sensitivity that people always talked about for equity funds disappears when it comes to corporate bond funds, and then the sensitivity of outflow to bad performance is much bigger. And that is a result of the fact that these funds started investing in much more illiquid assets, namely corporate bonds. And then finally, this is the paper surrounding the COVID period. What you see there are outflows from corporate bond mutual funds during COVID. In the upper panel, this is a long-term perspective, sort of a decade before, when you can see how big of an outlier the COVID period was. And then what you see in the bottom panel is the evolution over time. Eventually, I think it is the Fed announcement that they're going to intervene that helped calm things down and reduce the extent of the panic. But certainly an unprecedented event in terms of outflows from corporate bond mutual funds. So it kind of, I think, over this decade moved from a smaller phenomenon in equity fund to a much bigger phenomenon in corporate bond fund, and then something that looked more like a full-fledged crisis during the COVID episode. So putting it all together, when I'm thinking about the fragility of mutual fund, and these are also the features that I will look for when I will think about other non-bank institutions, I would point to two mechanisms, two forces that are generating fragility. One that I emphasized so far is the liquidity transformation, the fact that you're holding illiquid assets, but you're promising investors a high level of liquidity. And that is the thing that traditionally we thought was generating fragility in banks, but is also generating fragility in non-banks, and in particular in mutual funds that I looked at. And I want to connect it to another feature that I didn't talk about so far, but I think is important when we are thinking about the overall fragility of the system. And this is interconnectedness, the extent to which different funds are connected to each other, different institutions are connected to each other. This could be because they are holding positions in each other, but it could also be because they are investing in the same assets, and then you have fire sale externalities and so on, like a couple of the papers previously were describing, okay? So it is really this combination, liquidity transformation and interconnectedness, that what we should look for when we are looking into fragility and the overall implications for the system, for the financial system. You know, following the events with mutual fund fragility, there has been a lot of discussion over the years, thinking about regulation and policies, how to mitigate this fragility. You know, I will say my very brief take on it is the progress has been fairly limited, and a lot of it came because it was hard to balance the interest and the views of different players in the system. And in the end of the day, I think the mutual fund sector is still fragile as it was a few years ago. And I don't really think there has been a lot of progress in terms of reducing that fragility. So this is all about mutual fund. I think I have maybe 2 or 3 minutes about that. What about other types of non-bank financial institutions? ETF is a close cousin of mutual funds, and they are meant to make things a little less fragile. This very complicated figure that you see here is showing you how ETFs work, and given that I only have a couple minutes left, I will not be able to say much about it. But I will say, when it comes to ETFs, investors are not pulling money out directly from the fund, but rather they're selling their shares in the market. And then there will be the authorized participants that are kind of intermediating between the fund and the investors, and they are the ones who could potentially take money out of the fund. And basically what this is doing is it reduces the liquidity that investors have, so liquidity transformation is a little lower, and this is meant to absorb the shocks and potentially make things less fragile. We did see during COVID that the ETF sector was more resilient than mutual funds. However, I will say a lot of it depends on the liquidity of this sector of authorized participants, and a lot could happen there, and people have written about that. So I think there is still a great amount of doubt on how resilient this could be going forward. Thinking about hedge funds, another big non-bank financial institution, they're doing much less liquidity transformation. So they are attracting investors who are more sophisticated, richer, are willing to take more risk, willing to give up liquidity. So in that sense, the risk that they imposed on the system is lower. However, their level of interconnectedness is high. And we saw many of the crises that happened in the last couple of decades involved hedge funds one way or the other. You know, the global financial crisis, in the beginning you had the failures of hedge funds that kind of helped ignite a lot of what we saw. Take the recent failure of Credit Suisse, also affected by the failure of a couple of hedge funds. So the problem here is that they are interconnected, they're connected to other financial institutions, and this is how they potentially impose a risk on the system. And finally, the thing that is really growing fast is private credit, and I think it will come up more in the conversation. When it comes to private credit, I will say, again, this is mostly not open-ended, so investors do not have the ability to take their money out whenever they want. And in that sense, you have less liquidity transformation. This picture, by the way, is from the IMF report, kind of talking about the different types of private credit institutions that we have. What worries me here is, first, we have a trend whereby there is more open ending going on in private credit. And it's not that surprising because in the end of the day, investors have demand for it and financial institutions are finding ways to do it. I would expect to see potentially more liquidity transformation, more open ending, and as a result, potentially more fragility on that dimension. And the other thing about private credit, again, is the interconnectedness, that they are connected to a lot of other institutions that are doing liquidity transformation, and this would be a channel through which they could put a threat on the stability of the system. So just to conclude very briefly, I would say non-banks are increasingly and have been increasingly over the last 2 decades taking activities that banks used to do and are providing liquidity transformation and are highly interconnected. They present a risk for financial stability because of that. And just maybe throwing one thought about the current period. I think the current period looks fairly risky because of 2 things. One is that the financial system is changing a lot. And we see, for example, private credit going very fast. And it kind of looks very different now than it looked a few years ago in several dimensions. And then, of course, we have all the external risks, in particular geopolitical issues that are evolving. And that could be a perfect storm in the sense that when you have other risks that are hitting the system and the system is different and people don't understand exactly how the system works, this could be something that could lead to a major event. In some sense, that kind of what we had before 2008, in the sense that we had a financial system that was hard to recognize, and then all these other risks building up at the same time. So I'll stop here.
Thank you. So I hope that Itai is not going to be cited for his last prediction. And Doug, please.
All right. Thanks very much. It's an honor to be here with a conference sponsored by 2 such distinguished institutions and to have Itai as my warm-up act. So thank you for that. So many of the remarks I'm going to make today draw on a paper I co-authored back in October called Rewiring the Financing Machine, which is available on Oliver Wyman's website. So I will, in the interest of time, I'll keep my comments fairly high level. A core idea we put across that I certainly believe in strongly is you have to look at, for example, what I focused on, corporate credit. You have to look at it as an ecosystem. If you look at There's always a danger if you look at, say, just what's happening in private credit or just what's happening in banks or just what's happening in hedge funds, that you miss the interconnections Itai was already talking about. And when you think of corporate credit as an ecosystem, it's a really diverse one in a lot of ways, in that you've got many and quite varying borrowers. You've got many and quite varying instruments for those borrowers. You've got many varying originators and types of originators. And of course, many times they're ultimately passing on the credit risk to someone else, and the ultimate holders of debt differ quite a lot as well, as we've already seen in some of the papers we discussed earlier today. So what we tried to do in the paper was to look at it with this ecosystem perspective. And there are a lot of factors that have been transforming the corporate credit sector. Some of those are regulatory changes. Now, those have been particularly strong with banks and have tended to make it tougher for banks to do much of their traditional lending business. And that's part of what's been pushing business in other directions, but certainly not the entirety. there also the overall macroeconomic and rate environment was very important. In many ways, my own guess is private credit, and I'll keep coming back to that despite saying you have to look at the ecosystem because there's so much focus on private credit. I don't think private credit would have grown nearly as much in the US if it weren't for low for long, because low for long negated three advantages that banks had. One was they could get money very readily in the form of deposits. They could get money very cheaply. And of course, ultimately, they had support from central banks and other bodies. But during low for long, anybody could get money easily. Anybody could get money cheaply. And the third part probably didn't seem to people to matter that much, the potential support that was there. I think this is one of those things that's path dependent. Some of the forces at work would have pushed in these directions anyway, but I think low for long accelerated that. Another underlying trend is growth of capital markets in general. Now, this isn't as evident in the US because capital markets got big quite a long time ago. But if you look at particularly Europe, but other parts of the world, growth of capital markets meant there was more room for non-banks to operate, more liquidity, et cetera. And also a longer running trend that we've seen accelerate is just the increased availability of data and analytical tools. It's possible now to find out a lot about potential borrowers without having to do anything particularly fancy. Whereas if you go back a number of decades, a classic big advantage of the banks was they had private information. And it was expensive to gather that private information. And so that allowed them to charge rates which made up for the cost that they had. But you go back to the rating agencies when they started rating railroad bonds in the 1920s, I think it probably was, more or less then. You've seen changes since then, and of course with big data and AI, you have far more data available now. Now, one of the things I keep getting asked, and I'm sure all of us keep getting asked, is about the growth of private credit taking away business from the banks. As I said, I do think a substantial part of this is due to regulatory differences. Now, that regulatory differences it's not synonymous with regulatory arbitrage. There can be very sensible reasons for different regulation. There is also probably, though, a certain amount of over-regulation of the banks in this area and probably under-regulation of non-banks. Though, by the way, I'll pick up on one thing Itai was saying. I end up using the term NBFI, but I hate it. It's a little bit like taking manufacturing companies and dividing them into auto manufacturers and non-auto manufacturers. There's a massive diversity among NBFIs, but lacking another way of talking about it, I will keep using that term. But the growth isn't just regulation, it's also there are real business model differences. Part of what happened with the private credit funds is there was a realization from these entrepreneurs that you had investors, mostly insurers and pension funds at that time, who were looking for something like corporate credit, something with that range of risk that was longer term than many of the investments they could make, and that they didn't have great access to similar investments. And so finding a way to pull this together, package it, and provide it to them provided a genuine service to them. And then there are just business model differences anyway between running a bank, which is a pretty expensive thing to do, and running a fund where you can operate with significantly lower expense. I'll go back as well to something Itai was saying, which is banks and private credit firms have a lot of ties. They're, I'll use the term, they're frenemies. Some of them are friendlier than others, and some are more inimical, but there are a lot of ties, and increasingly so. And we need to keep those in mind. Now, I'll throw out one provocative thought, and we'll see if it turns out to be true. But in the US, where so much of the private credit development has happened, I think there's at least a possibility that banks will win back some market share. To the extent that a key driver has been the regulatory differences, it's clear the US is going to be cutting back on regulation and the burden of supervision on the big banks, banks in general, but the big banks are the key players here. So if you have, if right now you have a very high level of regulatory burden on the banks, and pretty low one on the non-banks, but the non-banks aren't going to change much in terms of regulatory burden, but the banks are going to significantly see a reduction. It changes the competitiveness of the two sectors versus each other. So we'll see how important that is. We'll see the extent to which it happens, but I'll throw that out. Now, we are at a public policy institution, so let me talk a little bit about the public policy perspective here, as again, Itai had foreshadowed as well. And I'm going to oversimplify just because of time constraints, but I really believe that the initial core activities that private credit started with provided a real public service. It provided it in two ways. I think it actually reduced systemic risk. And I'll take an argument that the Apollos of the world make that is a little bit of a caricature, but there is an argument in which you say, why would you want an important segment of the financial system like corporate credit to be supplied by highly levered firms that get most of their money on a daily basis, that is, it could be withdrawn at any time, are so fragile that we have an elaborate system of government support to keep them in place? Obviously, I'm talking about banks. Why would you want them doing the corporate credit business if it were possible to have funds that had basically liabilities that were 3 years plus? A lot of corporate credit is about 3 years. And that generally weren't particularly levered. And I do think there is a chunk of this business that naturally fits very well with insurers, pension funds, et cetera. Also, banks had been pulling back from lending to SMEs, and the private credit funds have picked up a lot of business. I mean, it's the higher end of the SMEs, but it is still a somewhat neglected sector. So initially, I think it was very largely positive. This has turned out to be a very lucrative business model, though, and as Itai was talking about, it's been expanding rapidly in the US, and expanding rapidly in other countries as well, though from a much lower base. So as you've had that expansion in the US, they've needed to change where they get the money from, because there's only so much desire by insurers and pension funds to own these instruments. So they've started looking at wealthy people, and then a number of them are looking at how to package this in a way that retail could invest. Certainly retail, but even wealthy people in general, while maybe in theory they could hold this for very long periods, they don't actually want it to be that illiquid. So as Itai was talking about, there's a demand for liquidity, and so you're seeing a reduction in the requirements for people to keep money there, and they're taking money from folks who are more likely to want to withdraw it faster. So you're seeing that. You're seeing types of investors, types of borrowers. They're expanding the range of people they lend money to be riskier. There's tranching, again, something that we saw in the run-up to the global financial crisis. So we clearly need a lot better data because this is a pretty opaque sector. And I think we'll ultimately need a changed regulatory environment. But I'll end with one sort of parable, which is I'm very pessimistic that absent a crisis, we'll actually get much movement by policymakers on non-bank financial institutions in general. So let me tell you this parable to illustrate. So the underlying point is that in most jurisdictions, the people who want to put the additional regulation, which are generally central bankers and bank regulators, want to see sort of a more level regulatory playing field. In most cases, they're already using all the legal powers they have. So which means they have to go to the finance minister and say, listen, I need you to do something you're not going to understand. I need you to do it even though it's going to be quite painful up front because you're going up against vested interests. You have to do this because there could be a crisis. It could be that what we're proposing will keep the crisis from happening. It might happen while you're still finance minister. We might not rescue you like the central bank always does. We think there's a really compelling case for action, and we've got to move now.
Thank you, Doug. So Doug doesn't like non-bank financial institutions, so we may have to change the name of the conference next year. Maria Assunta.
Okay, so thank you for having me, and I have a bit of a hoarse voice, so I hope that I can go on. I am a contributing factor of the rise of non-bank financial intermediaries is for sure regulation. And in order to evaluate the regulation, we want to understand how markets have been changing, meaning that we want to understand what are the cost of the regulations and whether markets are resilient. And this has been part of a research program that I have been entertained with different co-authors. In all the papers, we use regulatory data either from the European Central Bank or the Federal Reserve Board, so the usual disclaimer applies. Let me tell you what we find. The first environment that I studied together with Ralph Mesenthal is the secondary market for downgraded loans. So when loans experience a downgrade, the changing regulation imply a higher capital requirements. And of course, these loans are sold. So a concern that we had is that, well, are the non-bank financial intermediaries, that is the mutual fund, the private equity funds that purchase the loan, as good as banks in renegotiating these loans? And our concern was that private information that we consider to be a prerogative of banks could be wasted. This is not what we find. We find that these non-bank financial intermediaries concentrate the loan and then have incentive to renegotiate in an efficient way. However, there are new financial constraints that emerge, meaning that there are periods in which there are a lot of deteriorating loans. And what we observe is that efficient renegotiation is possible only for the loans that are sold at the beginning of a quarter rather than later in the year. And the idea is that these non-bank financial intermediaries meet some financial constraint and also meet some time constraint, and then efficient renegotiation doesn't happen any longer. In many countries, another type of regulation that is being implemented is counter-cyclical capital buffer. Why do they matter? Well, as Doug was saying before, they also make more expensive to lend to small and medium-sized businesses. What do we observe? Well, we observe, using the credit registry of the euro area, that these banks lend predominantly to large firms and decrease the amount of credit that they extend to small firms. Does this matter? Well, our preliminary evidence suggests that these large companies that obtain more loans are becoming more like financial intermediaries, meaning that they extend trade credit to small firms. So this is another aspect in which a non-financial intermediary improves the resilience. And finally, with Andreas Rapp, who is there, Martin Weibel, and Pablo Tikashira, we have been looking at the effect of the leverage ratio in the context of the US bond market. So the leverage ratio among the regulations is the one that is more debated because it gives incentives to banks not to enter in low-risk financial intermediation activities because expanding the balance sheet of a bank becomes expensive. So basically, what has been shown is because of the leverage ratio and other regulation, bank dealers are providing less liquidity in the bond market. So who provides liquidity? Well, we look at the role of the bond mutual funds that Itai was talking about before. I will show you some facts that continue to support this resiliency of the markets and the overall low cost of the regulation, that is, banks are easily substituted by non-bank financial intermediaries. But I will also show that the markets change and are subject to new shocks. Just to make the point again, is liquidity in investment-grade corporate bond in the US is particularly low at quarter ends. Why? Because that's when banks, both in Europe, in Japan, and in the US, report the information about whether they comply for the leverage ratio. Even the banks that report an average over the quarter, at that point, at the end of the quarter, they haven't saved this balance sheet space to provide the liquidity. So what happens if there are some bonds that are mostly intermediated by bank-affiliated dealers? Well, what we observe is that after the start of the leverage ratio regulation, it is a subset of bond funds that are specialized in liquidity provision that enter in this market and purchase the bonds. This is good for them, meaning that these funds experience a positive alpha. We find a nice fact that all the alpha of these bond mutual funds that are specialized in liquidity provision is realized in the first month of each quarter, meaning that they really make money from the regulation. But this alpha is, on an annualized basis, a quarter of a percentage point. So we shouldn't expect a flood of mutual fund to enter in this market. So this is the good side. Markets are resilient, but the way in which the cross-section of bond returns respond to shocks has changed. So existing literature, and Itai in his presentation, and my previous work as well, has emphasized the importance of fire sales. That is, sales of bonds that are sold by mutual funds experiencing redemptions. We control for all of that. But in order to identify the effect of the regulation, we want to try to measure the effect of the missing liquidity provisions. So which one would be the most exposed securities? Well, the most exposed securities are bonds that are typically intermediated by these regulated dealers and that the market is starting to sell during that month. What we show, and you can look at the shaded area on my slides, is that after the introduction of the leverage ratio constraint, this kind of bonds that we call constrained have become more subject to shocks to the liability of the subset of mutual funds that we call liquidity supplying. Basically, what this slide is showing you is that the illiquidity of these bonds increases when the liquidity supplying mutual funds are financially constrained and cannot purchase. So this effect is interestingly stronger, of course, at quarter end, but of course the markets are forward-looking and the effect is always there. We also find that this matters for stock returns. That is, when the liquidity supplying mutual funds experience a larger redemption, these securities that are affected by the constraints experience lower returns. That is, there are no buyers, so the securities depreciate. So this is the evidence that there are new shocks that matter over and above the effect of fire sales that we control for. And we argue that during the COVID meltdown, most of us will remember that the investment-grade bonds were those that experience a larger depreciation. In the cross-section, we look at how much can be explained by the missing liquidity provision. And of course, this complements the effect of fire sales. So bonds that were constrained, since in this period the liquidity supply mutual funds were experiencing redemption like any others, experience a 14% increase in liquidity more than bonds that were intermediated by unregulated dealers. So where does this evidence brings me? Well, this evidence suggests that markets are resilient and adapted to regulation. And the regulation is what we desire if our concern is that, well, the taxpayer must bail out banks that provide payment services, deposits to households, and so on. But we also have to be aware not only about the interconnectedness, but also that securities and intermediaries and corporations become subject to new shocks that affect the liabilities of these non-bank financial intermediaries. And these have the feature of bank runs, but are held by different investors and are different. And these, I think, are facts that we should document more and keep in mind to think of new regulations. Thank you.
Thank you, Maria Assunta. All right, and thank you all three for your remarks. I wanted to start by saying, actually, Itai stole my thunder at the beginning of his own remarks when he was mentioning the fact that there was no title for this panel, and that was actually a choice. It was a choice, actually, for the reason that some of you had mentioned, which is, when you are talking about MBFIs, the space is so vast that it's actually not easy to pick a specific topic. And in fact, picking a specific topic may be, in a way, diminishing the importance of the entire ecosystem, of the interconnection, and so forth and so on. And so my hope was that, in fact, out of 3 uncoordinated presentations from people that have been looking at NBFI-related themes for many, many years, that we could, in fact, tease out a lot of common themes for this discussion. And sure enough, they delivered. The first one that I want to mention is that what I'm learning, I guess I knew, but what I'm learning, what's being confirmed from these remarks is that if we are talking about non-bank financial institution, at the end of the day, really what we are focusing on is liquidity risk, liquidity transformation, the need to manage liquidity needs overall in the system, whether on the supply side or on the demand side. I think that's kind of the key essential element if we're talking about financial intermediation activity, and that's the kind of the way to read the kind of activities that these institutions that are not banks may be involving in. And so the issue of liquidity transformation was in fact touched on by the three panelists. The other theme that kind of is sort of a low-hanging fruit. I don't think I've ever been to an NBFI event and the word regulation was not mentioned. And it's again, obviously an important point. Is regulation a driver of the evolution? And we can talk about efficiency versus regulatory arbitrage. Maybe some people in the audience may have questions related to it. But I wanted to start by asking, maybe by privileges of being the moderator, the first set of questions. I have a follow-up question for Maria Assunta. She is kind of taking kind of a broader perspective. It is liquidity needs, but she's talking about the liquidity of markets overall, right? She's mentioning market resilience, which at the end of the day is the ability of a market to absorb, in this case, sales of assets. And so she is making, and her research has made very important points about the intersection between regulation and the ability of certain type of natural buyers to actually act as such. And the theme of natural buyers came up this morning in on one of the papers as well. And so I think one of the things that Maria Assunta was alluding to is that, for instance, regulation that affects the ability of dealers that are most of the time subsidiaries of banks in the United States, their ability to actually absorb certain type of assets, for instance, corporate bonds, in a way may have shielded banks by potential market shocks. Maybe that's a win for supervision and for regulation, but maybe it has exposed the market to broader, perturbability, the fact that there may be bigger shocks. So the way how I wanted to introduce the question to Maria Assunta is, so some of these natural buyers may be affected, but what about others? Again, after all, this is an ecosystem. After all, a lot of different institutions are in the business of intermediating assets. What are these other natural buyers? What's the role of insurance companies, et cetera, et cetera?
So the evidence that we have is that insurance companies that are closed organizations, that is, they are not subject to redemption. Yes, they purchase, but they purchase during a crisis, and they purchase because the dealer with whom they have a relationship call them to help. Otherwise, they don't jump in. Why? Well, all these intermediaries, they have a trading style. And in order to be a liquidity supplying mutual funds, you must collect data and monitor order flows. If you think of an insurance company with long-term liabilities, they don't have that in place in the current ecosystem. So they might not be interested in providing liquidity in normal time. When I said that the annual alpha is 0.25 basis point. Okay, there must be already some specialization, and these funds that are already specialized, of course, they can become larger, there can be some fund that enter, but all of these is on the margin. The specialization is important. That is, hedge funds have a model, they would change that only if there are large enough trading opportunity.
Yeah, I actually, thank you. To me, this is actually very insightful because, again, now it's opening another common theme related to MBFIs, which is that if you really, when the rubber meets the road, you really have to pay attention to the institutional details. And so insurance companies are not the same thing as a hedge. It seems obvious, but as hedge funds or pension funds and so forth and so on. And that has an implication for the issues that we are discussing. So I have a question, a follow-up question, if you don't mind, Doug. I wanted to go to you. I know you did not say that. You are not part of the Apollo company, but I wanted to see whether you wanted to take that position. The fact that, isn't it great if we can do actually credit activity without actually doing any liquidity transformation? Right? I think that's effectively, what they are saying. So it looks like we have engineered really the perfect model where we have eliminated these risks. This morning already, when Camilla was presenting her paper, there was a conversation about that. So I wanted to sort of pick a little bit you on that point,
Sure.
Whether you think that's a proper characterization of reality or whether maybe it's a little bit deeper than that. Sorry, kind of low-ball question.
No, that's good. I like nice, easy questions, so thank you for that. Look, it's easy in the sense that I'm glad there's a piece of this that exists. I do think it does go back to the natural buyer's idea. And maybe, I grew up in the investment banking business and dealing with markets that way. And it is very clear there are different institutions that have different objectives, constraints, styles, et cetera. So in general, the best thing you can do is match up an investment with the investment approach and needs of the ultimate holder. And I do think there's a chunk of this credit business that for at least a number of years now would have been the best owners would have been the insurers, the pension funds, and the ones who were the initial investors in these private credit funds. As I was trying to say, my worry is as we expand out beyond those, then there's more question. I'm sure that some of the expansion is also still beneficial. I'm positive some of the expansion isn't, and some of the when you create new product categories, which this is in many ways, just as we saw with like credit derivatives, they can be very useful and theoretically very sound, but there's just this natural tendency to keep growing and growing, and you move farther and farther away from where the real benefits are. And so I worry that we either have overshot to some extent or will.
Yeah. So basically, what I'm hearing is that the evolution of this of the private credit lending segment is going toward basically entities that on the asset side will have loans that they originate, and then on the liability side they are going to have increasingly demand liabilities, which when I was in school, we used to call them banks, no? So I think it's...
It depends on the degree you go to it. For example, if what you end up with are funds where a chunk of the money could leave in 3 months, that's very different from demand deposits that could all theoretically leave tomorrow.
I have difficulty with degrees, so it's like a black and white, but no, it's a good point. Can I actually push Itai a little bit on this angle, because you mentioned ETFs, and you were also referring to the development in the PC lending market. So one of the innovation, and again, talking about Apollo, is in fact an ETF, no? That between, it's an agreement between Apollo and State Street, if I'm not mistaken. So what's your view on, basically, on what Doug was mentioning, this sort of evolution toward open-ending the liability side of this segment of the industry?
Yeah. I mean, I think we see an evolution towards open-ending. In the IMF report that I mentioned, they talk about the fact that private credit is mostly open-ended, but they see signs that it is becoming, mostly closed-end, but they see signs that it is becoming open-ended. Fundamentally, I think there are a lot of investors out there who are looking for liquidity, and there are a lot of investments that are illiquid that need to be made. So there is some mismatch at the level of the economy, a big mismatch at the level of the economy. The question is, how do you orchestrate it in a way that you minimize the liquidity mismatch and the fragility that is coming out of that? I think in general what we have seen over time is that it's very difficult to do it because investors keep coming back for more and more liquidity. So I would expect to see more open-ending simply because I think there is a lot of demand for it. ETF is a very clever innovation that we saw years ago now that was sort of trying to go around it by having this other intermediary in between the authorized participant. And, in some sense, I didn't have time to talk about it, but I kind of think about ETF as a mutual fund that has swing pricing where the price is determined by the market. So it's really very nice. But I don't think we have enough evidence on how it's going to work under stress. It did do better during COVID, as I mentioned, but there is also work bringing up all sorts of problems that we see with the authorized participants. So I think there could be issues of liquidity there as well. I would say it's very important to understand why this demand for liquidity is so high at the end of the day. And if there is something that we don't have good answers to in the academic literature, I would say it's this.
I have like another 10 questions, but my role as moderator, I think it's over. I wanted to maybe open it up for questions from the audience.
Can I throw in one question
yes.
to the audience to be answered now or at some point? Just following up on what Itai was mentioning. One of the things that's bugged me for years as someone who's come out of the financial sector is I can't get economists to show what the benefit is of maturity transformation to the economy. I know it's there. I think it's very significant. But until we can figure out what it is, it's hard to know what the right policy prescriptions are. So we have some researchers out there. I'd love for you to get the answer.
It reminds me of the famous case of you will know maturity transformation when you see it. No, it's a good point, and I think it's definitely hard. But if there is somebody here in the audience, this would be a nice, good topic for research. I think I saw Divya raising his hand. The usual thing, if you can stand up and again mention your name.
This time I'll move my stuff.
Yes, thank you.
Divya Kirthi, International Monetary Fund. One question each for Doug and Itai. Doug, kind of drawing on your industry experience, what do you think from a kind of banking industry perspective, if you look at the regulatory landscape now, before any kind of potential easing up as you referred to, which elements of debt does the industry perceive to be most costly? I think it would be interesting to hear your take on that. And Itai, I wonder whether one element of the demand for bank-like liabilities is related to safety or perceived safety. So it would be interesting to hear your thoughts on that.
You guys want to respond?
Yeah, absolutely. And one thing that wasn't mentioned in my brief bio is I was a visiting scholar at the IMF for a couple of years. So I'm always glad to see IMF folks. Okay, in terms of the types of activity we were talking about today, I'd say capital requirements is top of the list because capital is just expensive. Leverage ratio, as Mariassunta was talking about, is a serious limit on some of the types of activity. Basically, for very safe securities, it's a limit there. And then in the background, there's a whole raft of supervisory approaches that either create, well, often what they do is it's almost like quasi-regulation, that the supervisors feel there's certain ways you shouldn't do things. Sometimes those are well-founded feelings, sometimes those are just the prejudices of the supervisors. But the banks often feel that it's limiting legitimate business choices they would otherwise be making.
Yeah, regarding the safety, you know, what's funny about safety is we say that they want to have access to their money at all times because they want the safety, but then at the end of the day, it's not safe. So how do you reconcile it? I think that's a key question. You know, there is the preference structure that we know from the Diamond-Dybvig model, where you give investors an opportunity to take their money out because they might face these liquidity shocks. All of a sudden, they wake up early and they need money now, and they want to have access to it. And I think, you know, this is perfectly consistent, internally consistent, and I think a great modeling device that I've obviously worked with a lot also over the years. My question would be, you know, how big that is quantitatively, if you think, you know, should we really organize the entire financial system around this provision of liquidity transformation? And I think this is the thing that is still hard to tell.
Victor first.
Victor Stebanos, the Federal Reserve Board, Washington, D.C. So I sense we should not hope for any regulation coming for non-banks. So I was sort of wondering whether sort of a different approach where you try to supervise banks more strictly or regulate them more strictly, you know, may be somehow effective to deal with the risks posed by non-banks. Thank you. Question to anyone who would like to pick it. Thank you.
If I could maybe start. That has been the direction of the U.S. bank regulators. I think with the new regime in place, that won't be the direction. I think the new team basically feels that approach has heaped so many burdens on the banks, it's just pushed the business elsewhere. And that's not what they intend to do.
Here in the front.
Did you want to?
Oh, sorry. I'm sorry. Actually,
would make a lot of sense to me.
Oh,
that's.
I mean, I think the problem in that is exactly what we have been saying, that you regulate banks and then the problems move somewhere else.
What do you sort of think about severing interconnectedness or minimizing it between banks and non-banks?
Right, yes. But still, I mean, if the other institutions are starting to provide liquidity transformation, then, you know, maybe the risks are not going to come through banks, but they're going to show up elsewhere.
Yeah, you remember, we kept investment banks outside the safety net. That didn't work because it turned out they were too interconnected.
Thank you, Nicola. Ilya Lingorski, Bulgarian Central Bank. Particularly given what Itai just reminded us again, that you regulate more and then it moves somewhere else. How do you see the potential of the fintech sector and various things which are being called fintech, particularly those who are developing demand liability sites quite smartly, although they're small now, but what would be the risk which may be related to the fact that, you know, it's even not easy to understand what to regulate there?
Well, I have thoughts, but I feel like I'm talking too much if one of you two wants to start.
You can start.
All right. Look, I think fintechs are going to continue to be a great source of innovation. I think there's an awful lot they can do with efficiencies and with coming up with products we haven't dreamed of before. At the same time, for the reasons you're talking about, there are going to be blow-ups. And it's going to be a sector that both has a lot of societal value and destroys a certain amount of societal value. And I do talk to regulators as well as the industry a lot about how you find the balance to try to maximize the innovatory benefits and minimize the harm. Then the devil's in the details, really, so I can't give you a short answer. But I think there's too much promise here to just sort of slam the door, but there's too much risk to not try to figure out how to put some guardrails up.
Yeah, I think we can spend a lot of time talking about fintech. The way I saw the fintech revolution is mostly an attempt to go towards decentralization and kind of get rid of financial intermediaries that are in between and have everything on a decentralized basis. I think in the end of the day, this looks like it's going to be pretty difficult to achieve. And you know, we can talk about different examples, but I think in any application, in the end of the day, you do see intermediaries and large players kind of emerging. So I don't know that this is going to be such a fundamental change.
Luke had his hand raised earlier.
Yeah, Luke Laven, ECB. So, Oliver, you asked a question, sorry, Doug, so to the audience, which is sort of unusual, but let me try. So, when we have a panel like this, we often start and end in the US, but the US is very special as a financial system. So, we have a lot of evidence here at the ECB. When you look at the European banking system, there's a lot of maturity transformation. Banks hedge their interest rate risk. Okay, we give them a tough time with our stress tests and all that, but it looks pretty textbook-like. And I think a lot of confusion, at least in my mind, when we have panels like this, comes from the specialness of the US system, where you have banks that call themselves banks, but they're really not banks, and on the other side of the spectrum as well. So I guess I've sort of two versions of it. One is maybe the US is just different, but also turning this then back to you and others on the panel, what is it really that makes the US then so different? Why do we have, so I think Maria Assunta had some answers to it, and also Itai when you started. Is it regulation? I mean, my starting point is maybe it has to do with the capital markets. So I wanted to sort of have your take on it. What is really so different in the US that we have this market to begin with?
Can I follow up just very briefly on the question I posed to you?
Yeah.
It's fantastic you've got that. If you could tell me, is it worth 25 bips of societal value on the euro? Is it 50 bips? Is it 3 bips? That would be really helpful. And what is it that creates the societal value?
Well, but his preference is, I wouldn't dispute about preferences. If I want to get my money back
sure.
because of a shock, that's a maturity transformation.
Oh, look, I think there's real societal value there. I just would be great to know how much, that's all. But anyway,
I think it is hard to put, I think it is hard, as I mentioned, I think it is hard to put a number on that. And
But is it someone that we don't have that much time? I just wanted to tease this out. Can someone try to answer Luke's question? What is it that drives the difference between the US and Europe? Is it regulation? Is it what?
Well, for sure, capital markets. Is, for instance, the sales of downgraded loans was happening also in Southern Europe, but in the US is a much larger scale, because even the secondary market for bank loans looks like a bond market. So it's different challenges to regulations, but at the end, it's not very different, in my opinion.
Yeah, I absolutely agree too. It's the size of the capital market and the uniformity of the capital market, which is why if you guys could get the Savings and Investment Union done, that'd be good.
But you know, I mean, going back, I mentioned a little bit the geopolitical issue, which is, I think, on everyone's mind. I think part of it was also the position of the U.S. in the global economy, and you know, maybe things are evolving in a different direction. So it's not. So I don't think you can really just disconnect financial markets and banks from the overall prominence in other areas.
Maybe we have time for another question. If I see Sabrina. Yep.
Sabrina Ben Said from UW Madison. I have a question to Douglas. You were mentioning about regulation on big banks, loan to SMEs, and that is where private credits come. But what about the role of banking consolidation? Like, we are having more and more big banks, and usually before we were thinking about small banks lending to small firms, but now maybe that is why we have more private credit. What do you think about banking consolidation in this?
It's a good question because there are trade-offs. Smaller banks do tend, if only because they can't do much else, to focus on smaller, individuals and smaller businesses. That is true. On the other hand, Europe has a very inefficient banking market, partly because you don't have anything like the level of consolidation, at least across Europe. Within some countries, you do.
Well,
it may be.
The United States has 4,000 banks. Is as many more small banks.
Sure, but if you look at the percentage market shares, it is more concentrated in the U.S. when you look at the U.S. as a whole. If you look at the European Union as a whole, sure, France has 3, 4 big banks that dominate France, but if you look at their share of the European market, it's far lower. And since the two economies are of roughly equal size, it does make a difference, I think. So my only point is going to be, it could be that the potential efficiencies and economies of scope from having larger, more consolidated banks would open up opportunities even for smaller business lending.
Any additional comment on this point? I think it's serendipitous that we may be ending talking about banks. Maybe this is a sign. And with that, since we are 4 minutes past our time and coffee is getting cold, I wanted to thank the panelists. I think this was incredibly engaging and insightful. Round of applause.
All right, welcome back. I hope everyone had a good cup of coffee. So we are here with two more very interesting papers. And Ross Wimmers from U Maryland is going to kick us off. The floor is yours, 20 minutes.
Yeah, thank you. Right, I'm going to stand up. Help me to think a little bit better. So thank you to the conference organizers, ECB and Fed New York, for hosting this wonderful conference. And I've learned a lot from it so far and look forward to continuing to learn and speak to people during the breaks. Relatedly, I've been co-hosting a short-term funding markets conference with the Fed board. We wrapped up our 8th version of this. 8 years we've been doing this. And so it covers many of the same topics, but kind of all in one day, where I think this is segmented into 2 days, non-bank, and then bank, I think, tomorrow, if I understand this. So the Fed is a great institution in my mind, and for this as well. So non-bank intermediaries and non-bank liquidity transformation. I just want to say something, and I think Ite made a good point that bond funds can be liquidity transforming as well. I think he studied short-term bond funds. But all kinds of funds can be liquidity transforming if their liabilities have a shorter, a redemption frequency, redemption right, than their assets, explicitly have. So a stock mutual fund could be a liquidity transformation vehicle. So there's just a lot of stuff here I think that's interesting that needs to be. And most recently, the U.S. appears, under the Trump administration, about ready to approve private equity as an investment class for people like me. Even if I don't have, if I'm not a accredited investor, and me into my 401k plan. So this is going to be a major liquidity transformation. So stuff is happening all over the place. In non-banks, and it seems that governments are emboldened by this role of non-banks in doing this stuff because they think there's, no harm can be done. And of course, we know there harm can be done. So this, I think, it's up to today's discussions and papers to see, what harm can be done and what are the potential responses to this. So my role here is to present my paper with Samuel Hempel of the Fed board and Dassel Kim of the Office of Financial Research. And clearly, I'm from the University of Maryland, but clearly the comments that I make are not to be attributed to the Fed board or the Fed itself, nor to the OFR. Okay, these are my comments and my comments only. Okay, so what we got interested in was this secondary market corporate credit facility that was implemented by the Fed. I think it was Fed New York, really, that implemented this, and thanks to the Fed New York for co-hosting this conference. So this SMCCF, as it was called, secondary market corporate credit facility, was put in place shortly after COVID started hitting home. I think maybe you remember where you were on March 13th, 2020. I remember I was just getting done with some expert witness testimony in Atlanta, and I was like flying home, and I was like, I hope I don't get COVID flying home. If I can just do that, then I can just shack up into with my family, and we'll be all safe. But it was a crazy time, right? And crazy times like that, which ended up being even crazier, bring the need for very, very immediate and intense actions. And I think that's what the SMCCF was all about. Okay, ETFs. Why ETFs? Well, ETFs, it turns out that corporate bond ETFs have a very narrow channel that they work their way through. There are 5 authorized participants that handle 90% of creation redemption activity with the sponsor. 5 equals 90%. So you've got a big amount of trading, funneling through these 5, And these 5 and the others, other 10%, at least in bond ETFs, remember I'm talking about that, also deal in corporate bonds. Okay, so there's like this bottleneck here. And if you think about it, it seems ex post, it seems very simple. All you need to do is to make that bottleneck, unfreeze, because corporate bond markets were frozen, quite frankly. Sometime in late March, early April, things were just really nasty. And the federal government was, the Fed was thinking of, Congress was thinking of, should we go out there and just buy a whole lot of corporate bonds? What should we do? And they ended up doing some of that, yes. But then somebody got the bright idea, maybe we should think about these 5 dealers, and how much of the ETF market they control, because a lot of these corporate bonds are being traded because of creation and redemptions of these ETFs, of a bunch of ETFs in America, bond ETFs. So the bright idea was, let's unfreeze the ETFs, and then maybe the bonds will follow if we unfreeze the ETFs, because again, these dealers in ETFs are also generally dealers in the corporate bonds. They trade both things, okay? So they kind of intermediate. They kind of act as a liquidity transformation vehicle between ETFs and the underlying bonds. So, interesting fact, and here's an example where maybe concentration works in the favor of solving a problem rather than creating a worse problem. Okay, so I already made this point. Intermediaries, of course, can magnify shocks when concentrated and constrained, like these dealers are. These dealers are certainly constrained by their capital constraints. And so we're interested in, how do balance sheet constraints, how does an easing in balance sheet constraints affect the liquidity of the underlying corporate bond market? Okay, again, with these ETF dealers, authorized participants, I should say, playing a dual role as dealers in the corporate bonds that support their ETF. Okay, so they have a dual role here. Okay. Already talked about that. And the quasi-natural experiment, like I said, is this decision by the Fed to purchase corporate bond ETFs, even before they purchased corporate bonds. So they made this change, and they allocated a certain number of billions of dollars. I'm forgetting what it was, 10 billion maybe. I think in the end, they ended up buying 40 or 60 billion. I'm sorry, I've forgotten the numbers here. But they bought a lot of corporate bond ETFs, okay? And we wanted to find out, Dassel, Sam, and I wanted to find out, what effect did this have? Did this unfreeze corporate bonds? Did it unfreeze ETFs? I think that the goal of the Fed was not to necessarily unfreeze ETF markets. We think that happened too, but I think they were concerned, they weren't concerned with ETFs, as ETFs are an investor product. They were concerned with the underlying holdings of the ETFs, because this is what funds real activity in America, right, is corporate bonds. So they want to make sure, so we wanted to investigate, what did this do for the liquidity of the underlying bonds? Okay, so what we do is we identify, so what we did, maybe I'll wait on this until I get to the timing slide. So here's what we're interested in, is the intraday spillover effects of these purchases to corporate bond, to other corporate bond ETFs that have overlapping holdings. That's an interesting question. But maybe even more interesting is, what effect does it have on the holdings of other ETFs that are not in this ETF that has been purchased by the Fed? Does it also unfreeze other bonds held by a common ETF? I'll show you what I mean by this in a second if that's confusing. Okay. So let me skip the overview of results so I can show you the results and show you the tests and the results. And I think the only thing to look at here is primary dealer corporate bond inventories. If you take a look at March 2020, you can see that the inventories of investment grade corporate bonds by these dealers, the inventories dropped way down during that time period into April. and the inventories of high yield dropped down quite substantially as well. The other thing you can notice is that these inventories shot back up sometime in April or May, and we think that this might be a reaction to the Fed stepping in and saying we're going to support the corporate bond market, but we'll see. We'll show up. We're not, our tests are not aspiring to solve this particular inventory level issue. Whereas we have much more limited aspirations in our paper. Okay, we just want to see if we can find evidence that it affected corporate bond spreads and things like this, both mainly investment grade, but also high yield. Okay, so here's the timeline. And so March 23rd, the board announced the SMCCF, but they were kind of non-specific about how they were going to implement it, other than it was going to be implemented on a broad, the broad industry or broad sector of U.S. corporate bonds. And they said when we buy bonds, we're only going to buy bonds that have a maturity of 5 years or less and that are investment grade. They were not interested in supporting the long-term financing of corporations. They were interested in supporting the short-term financing of corporations so that the corporations would stay alive and live for the long term, okay? Long-term would take care of itself if you take care of short-term. On May 4th, they announced that they're going to make SMCCF operational soon. On May 11th, they said, we're going to start tomorrow. And by then, they had announced that they were going to also target bond ETFs. And I think they also said, we're going to target bond ETFs first. So they did that. And that's all they did until from May 12th. You can maybe see the first tall bar is May 12th, 2020. And those bars there are the dollar volume of SMCCF ETF purchases in millions. You can see they're substantial, $300 million a day, $325 million a day, $325 million a day, $320 million a day, what have you. So you can see these were massive purchases of these bond ETFs. And they were trying to inoculate the corporate bond economy, corporate bond sector through these really big pushes by buying ETFs. So why buy ETFs? What's that going to do? Okay, so the idea is that dealers are holding, are reticent to buy bonds from the market to hold and then to deliver as a package to the sponsor, right? So that's what they want to do is dealers would like to make some money by buying the bonds in the basket, and they have to negotiate with a sponsor and all this kind of stuff that is interesting too, but ultimately they want to make some money on buying those bonds, packaging them, sending them off to the sponsor, getting back ETF shares, and then they can sell ETF shares. Well, if the corporate bond market is frozen, they're not going to buy the bonds, and so they don't want to do this. They don't want to do this authorized participant activity of creating units, okay? So the idea was to unfreeze this. The Fed would be a customer of the ETFs, pull ETFs from the corporate bond ETF dealers, APs, and this would give capital to the authorized participants. You could say, well, maybe all they did was they went out in the secondary market and they bought more ETFs, but maybe that also, maybe arbitrage activity from that might also have unfrozen corporate bonds. We think that it's also plausible that these authorized participants went out and bought corporate bonds and packaged them together and did that AP creation activity. Okay, so you can see that the first weeks are kind of special because they didn't tell you up until May 29th, you see the green box above, up until May 29th, there was no mention of who and what they did. Okay, they just said, we're going to start tomorrow. They didn't say how much, on each day. They didn't say which ETF, and so on. It wasn't until May 29th, they announced the first week of May 12th through 15th, I guess it was, okay? They announce what they did those dates, okay? All they give in their announcement, you can get this on the Fed's website, just do a search for SMCCF Fed purchases. Okay, you can get this on the website in spreadsheet form. All they said was we purchased LQD, you know, ticker, how much we purchased on May 12th, you know, and that's pretty much it. Okay, they didn't tell you what time of day they purchased. They didn't tell you which authorized participant they purchased from. So there are a lot of data challenges in this thing because the Fed, you know, understandably kept things fairly confidential about you know, who they were purchasing from. Okay, so that said, you know, everything I'm showing you here is a couple years old, actually a few years old, and that's because COVID happened and it's taken us a few years to gain access to better data on these purchases. Now we have access to the actual Fed purchases, who was the counterparty on that day. So we can do a much better job of this now. And you know, we had trouble getting all that through, you know, with COVID and everything else happening. We now have access to this, so apologies. Maybe next year I'll present the updated results. But I don't think they're going to change that much, except be maybe more precise. Okay? So announcement of the first week happened on May 29th. They continued this process. And then on June 15th, kind of the dance ends, because they're still, all the bars show corporate bond ETF purchases, but on June 15th, the dance kind of ends because they're also buying corporate bonds. So now we don't have a clean identification, so we kind of stop there. That period between May 12th and June, whatever it is, 12th, I guess, May 12th and June 12th, is really a special period because it's a period when they only bought corporate bond ETFs. All right, so let me show you some results. I'm already running short on time here. I want to show you data, but you can imagine that we had to identify what time of day. We wanted to do an intraday analysis. We had to identify what time of day did the Fed purchase LQD on May 12th. And to do that, we had to look at an ATF transaction database by Mayfair, and we had to find a matching transaction for LQD that exactly matched the price, the ticker, the dollar amount, okay? And we called that a good match. And we were able to do that with more than half, up 61% of the trades, okay? So because we wanted to do an intraday, so I'm going to show you some intraday results here. Everything's going to be focused on the 60 minutes before a Fed transaction happened, a Fed purchase of ETF, up to 60 minutes after, okay? Everything beyond that is going to be just filled with noise. You know, we could keep going like that, but we just want to see in the real short run, do these transactions have an effect? Okay. Here are the tickers. There are only, I believe, 16 of them. Only 16 tickers were bought by the Fed. Okay, so very highly concentrated. And you can imagine it was BlackRock and, State Street and some other big players in the marketplace. They wanted to focus on the big money players, okay? So a lot of this is just confirming that we have, that the Fed trades are big, yes, but they are not the only big trades that happen on those dates, okay? So we're not getting a selection bias by only getting big trades. We're getting big Fed trades, but there are big non-Fed trades on the same day, is what these things say. Okay, here is who the Fed is buying from. Wells Fargo, UBS, Morgan Stanley, Jefferies, Goldman Sachs, okay? And in terms of APs, okay, the blue bars are APs, the yellow bars are firms that are not APs, but they had ETFs purchased from them anyway, okay? All right, so here's the first thing I want to show you, and I'll probably show you like one or two more results and finish. So time 0, okay, back to time minus 15 and up to time plus 15 in minutes. That's in minutes. Okay, so at time 0, we follow the bid-ask quote. This is from ICE BAML, I think, because they have end-of-the-day quotes. But anyway, in any case, you can see if we normalize at 100, if we normalize the buy price that the Fed bought at 100, you can see that the Fed bought right around the bid price. So here's the bid ask, the bid below, the ask above in red. 100 is what is a normalized price that the Fed bought at. The Fed bought at the bid, okay? So they were able to transact at a favorable price, you know, or you might think of this as a favorable price. The other thing to notice is the upward movement here directly after. The first 15 minutes, you see the price of the thing, and the normalized price go up by 1 bip, maybe 1.5 bips, okay? So it did have an effect on the ETF market. It pushed it up. And this wasn't really the design, but you can imagine if the price of the ETF went up, this might have stimulated, you know, market volume, okay, in that ETF. So I'll speed up. Don't worry. I know. Okay, so let me go and show you. So we did a bunch of things looking at overlaps, and this is kind of cool thing of the paper and something I won't have time to explain much. But we looked at if ETF X is the focus of the purchase, how is ETF Y affected when there is an overlap of holdings? Okay. And in short, we find if ETF X is purchased, ETF Y also shows price effects, even though ETF Y wasn't targeted by the Fed. Okay? Okay, now even more interesting maybe is what if ETF X, Y, and Z have a common authorized participant, and yet there is a Z ETF. The ETF X is the one purchased by the Fed, right? And Y and X have some overlap. We've already covered that case. Z, the ETF Z, has no overlap at all with X and Y. It would be astounding to find an effect on Z, but yet we find an effect on Z. Okay, and this is kind of the smoking gun, that they are making a difference to the authorized participant no matter what the authorized participant holds and deals in. So it seems that this had a broadcasting effect using the APs. And you know, it seems like a really smart, you know, maybe accidental, I don't know. Maybe the Fed, New York and the Fed board knew all this was going to happen, but it seemed to happen really beautifully, and it seemed to broadcast, seemed to have a lot of bang for the buck. So I'm happy to report here at a Fed conference. So I wanted to show, you know, so we test, these are all the tests I just showed you. So let me just show you the underlying corporate bonds, okay? So these regressions show you the first, the independent variable is percent Fed ETF. That's the percentage portfolio weight in an ETF bought by the Fed. And we look at the next day's bid-ask spread versus the prior day's bid-ask spread. And the negative bid-ask in column 3 shows that corporate bonds that were in a targeted fund had their spreads go down. So this was you know, consistent with more liquidity, more trading, and so on. This is more of the same. We actually do high overlap, low overlap, high overlap, same AP, high overlap, other AP. And we get these 3 conclusions. Bonds held by high holdings overlap have larger decreases in spread. High overlap results driven by bonds held by ETFs that have the same AP as the Fed purchase. It's the AP that makes the difference, not so much the overlap, okay? So if you can get that from this talk, and that's all you can get, that's enough. So let me conclude. Sorry, Luke, I took a few extra minutes here. And shouldn't have.
We will send you the bill.
Okay, fine.
And you borrow from a central bank.
I'll pay you in US dollars. I'll pay you in US dollars.
All right.
So anyway, we think this is a really, you know, unique experiment here that the Fed did, and it seemed to work. Okay, it seemed to unlock. And anecdotally, we've talked to BlackRock about this, and you know, they can't disclose everything. BlackRock was the agent for the Fed in New York to implement these purchases. In addition to being an ETF provider that benefited from this, but they, you know, Chinese walled this off, their operation to purchase ETFs from various companies, APs. But BlackRock's comments off the record are that this did unfreeze the market for ETFs. So let me stop there and look forward to the comments. Thank you.
Good. Thanks, Russ. Okay, Russ's paper will be discussed by Florian. Florian was at the ECB when we bought corporate bonds, so a perfect discussant for the paper. Now it's safe.
All okay, right. Thanks, Luc. thanks for the organizers having me. Always a pleasure to come back and having me read this paper. I think my discussion will be highly complementary to what you've just seen. So the basic question, just in case this got lost a little bit, is to what extent do balance sheet constraints of important players in a market contribute to the propagation of shocks? Okay, so that's the essence, and you haven't seen much balance sheet constraints in the presentation, but I'll still tell you what the authors argue and why I think it makes sense. The setting is very nice because it's in the wake of COVID, when in the US there was the feeling and the need that you needed to support the corporate credit market. And there was the secondary market corporate credit facility. And what's nice is that they purchased ETFs initially. They didn't purchase the corporate bonds. They purchased ETFs. They probably did this because of operational ease, but it lends itself to nice identification strategies. So I think, that's really where the paper comes in nicely. So in a nutshell, if the Fed purchases ETF A, then the price of ETF B responds even though B was not purchased. And that price reaction is stronger the more overlap there is between the ETFs, which you can get a handle on because you can see the underlying bonds. Okay, and I think that's the essence of the exercise. It's nice, and so this is where the balance sheet comes back in. The purchase was not known to the market, and they look at a very tight window. So how on earth could there be this reaction of another bond, of another ETF that was not purchased, except through this key player, the authorized participants? I'm going to explain exactly what these guys are, except through this person realizing, oh, my one ETF was purchased. Gee, okay, then I have now space to do something with my other ETF. So that's the identification strategy, is that it was the purchases were not known to the market, very tight window. That's why this is a paper about the balance sheets constraints of those authorized participants, according to the authors. Then there's a second set of results I will not get into, is they are a little bit of an afterthought in this current version of the paper, which is a few years old. So you go at the underlying bonds. The bonds increase in the ETFs that were purchased. Yeah, okay, fine. Also held, if the bonds were held in non-purchased ETFs, that mirrors a little bit the result before. And then also there is the overlap. You can construct it not through the underlying bonds, but through the authorized participants. And so if they were held by the same associated participant, there's a stronger price reaction, and now irrespective of the overlap. And so they kind of build a story around that, but it's a bit too complicated, I think, in my remaining time. So let me do 3 points, quick points, a bit on the ETF ecosystem, a little bit on the program, the main test, and maybe I have time for a fundamental question. So a bit on the ETF ecosystem. So these are the numbers, because just to get a sense of what we're talking about here. So global ETF market, 15 trillion. US ETF market, 11 trillion. US corporate bond ETFs, 0.35 trillion, so smaller. And this is in relation to the US investment grade corporate bond market, which is 6 trillion. Okay, so that's what we're trying to put perspective here on size. So now, where do these APs, these authorized participants, come in? So suppose this is like COVID hits, everybody wants to get rid of the corporate bonds. The AP, they want to get rid of the ETF share. They have ETFs, they want to get rid of the ETF. The AP buys the share, returns it to the issuer. The AP then needs to cancel the share by selling the bonds because the share has been returned. And to do that, the AP needs to sell the bonds, which is going to be costly if everybody wants to sell the bonds. Now, there's a contractual obligation to do that, because the AP's job is to keep the net asset value of the ETF in line with the market price. And so they have the obligation to redeem and issue bonds in relation to the buying and selling of shares in the market. Okay, so that's why these guys are key players in that market. They keep the net asset value in line with the market value. So a little bit like book equity market value of equity. That's their job, to keep it in line. And that went down the drain in COVID. So here you see, this is from a Fed paper by Boyarchenko, that basically the ETF NAV basis, that's the lines, they tank around the time when COVID was really hitting the Western world. And actually, interestingly, more so for the investment grade market than for the non-investment grade market. So not surprisingly, central banks started to worry about that. So a little bit on the program. So this is showing you corporate credit spreads for investment grade in red and non-investment grade in red, and this is from another paper by Gilchrist. First news about COVID in January 20, nothing happens for a few months. 11th of March, it was declared a pandemic. This is the episode with you in the plane. The basis has increased, tanked. The credit spreads go through the roof. March 23rd, the program is announced, together with the PMCCF, the primary market credit, corporate credit facility, which actually never did a single transaction, apparently. And then things calmed down relatively quickly, but this was before any single purchase. Okay, so it's the usual. It's a little bit like the, believe me, it will be enough kind of moment in Europe. The announcement was enough, but the paper then looks at the episode a little bit later when the markets have calmed and there were the actual purchases, first of the ETFs and then of the bonds. So the main test. So that's the setting. Okay, my view would be here like, okay, if I want to be critical, maybe the program is a bit small, and the heavy lifting had been done by the announcement. But nevertheless, it's a very interesting setting. Try to figure out this contagion through similarity of the ETFs that presumably go through the authorized participants because they're the only ones that knew about that intervention in that short interval of time. So what's the test? So the test in the paper looks like that, has like 3 indices. Frankly, I don't like it. I think it's easier that way because it's the same. It's basically saying it's a different diff. What you're comparing? You're comparing bonds. So you're comparing ETFs that have a high overlap with the one that was purchased and the one that did not have a high overlap with the one that's purchased. So you have the return on a ETF that was not purchased, so that's R theta T. Theta stands for is there overlap with the stuff that's been purchased, and T is the time. So the treatment, D is 1. Simply speaking, if there's overlap and the purchase has happened, and then there's a fixed effect for maybe bonds that have an overlap are special, and maybe there's something happening at that time. So that's a classic diff and diff. That's essentially what this boils down to. I think it's much simpler because then kind of tells you, okay, so what do we need to do? Maybe we need to look at parallel trends, which are not in the paper, easy to do. And then I think the real worry is, okay, what else could be lining up in this theta T dimension, right? I mean, bonds with overlap at time T, a lot of things could be happening. Yes, the Fed purchased it, but other things could be happening as well. And this is where their nice identification strategy comes in with a tight window of 30 minutes, right? Because in 30 minutes around a Fed purchase, what else could have happened? But then you don't need a diff and diff, right? If you have a tight window and nothing else could happen, you don't need to model the counterfactual. So I think you need to revisit a little bit what you really think is the best empirical strategy to do what you do, which is very nice, right? I mean, the exercise is very nice, but I think it could be a little bit clearer. And then finally, I have 50 seconds for a fundamental question. Actually, at heart, I'm a theorist, so let me take a little bit of theorist perspective here. Is that are these purchases that the central banks do in this crisis, are they optimal? And what alternatives do we have? Just abstractly, right? I mean, I'm not saying that, there's good reasons why they do the purchases. But so first of all, and this came up a little bit in the panel, for the private market to keep sort of smart cash aside, i.e. money that could buy these very specialized assets, that's socially very costly because, well, what if the crisis never happens? Then you've not invested in something else. You've waited for the moment that never came. And so this, like Gordon Huang, have an old paper where say, okay, then it's good that there are government bailouts in the bad state, because what you can do is you recoup that cost in the good state where you tax the banking system or the other market that you've helped. So the question then is, does that happen in reality? I have a paper with people here at the ECB. Madeleine is sitting in the first row. She's smiling. We need to work more on this. But actually, it's not just that it's socially costly, but just private agents don't internalize the cost and benefits of holding that smart cash. Nobody internalizes really the effect they have on the market in the whole. So what you should do is you should tax those that use too much cash from a social point of view and need to subsidize those that that would supply that cash in the bad states of the world. And in our setting, when you have a banking sector that relies on the non-banks, you should shrink a little bit the size of the banking sector, and you should prop up the non-banking financial sector. And I think we implemented with capital regulation. And finally, why on earth can you not insure against this? I mean, yes, COVID was a big shock, but it took months to realize. Why on earth didn't no one figure out that, well, there's going to be some selling going on, so why am I not placing myself on the other side of that bet? Because I have all the work, again, here with some people at the ECB and Bruno Behe, that if you could ensure that, the fire sale is, yeah, it is a fire sale, but there's nothing that the planner can do better. There's no rule for the government. And then there's other work that kind of tell you why aren't these insurance markets not happening? Why could you not insure against house price decreases? Why can you not insure against pandemics? And that's one argument, is that those people that sell you the protection probably know about the risks than you do. And you essentially then are in a lemons market, and you're getting only for insurance against the risks that you don't need insurance for. Maybe that sounds familiar to all of us in our private lives, and that could be a reason why we need the government to step in if crises happen. Thank you.
Thanks for that. Floor is open for questions. Yes, here in front.
Yep. Thank you. Christoph Kaufmann, ECB. Thanks so much for the super interesting presentation. Thinking a bit beyond your paper and policy implications, so you were focusing very much on the purchases of the ETFs. But you were also mentioning that right after the Fed was starting to purchase directly the corporate bonds. So I was wondering, can you do a comparison between the two types of purchases? Maybe what is more efficient, what brings more bang for the buck? Is there like a policy recommendation for central banks? Should we purchase ETFs or direct purchase of bonds? Thanks.
Oh, thank you.
Great question.
Do you want me to respond right now?
Maybe check if there's other questions.
Let me respond while you're waiting for another question. Yeah, great idea in principle. The problem is that when the Fed started buying corporate bonds, they were still buying ETFs. Yeah, it'd be nice, right, if we could get the exact time, stamp that they bought the ETF versus bought the bonds. We might be able to segregate that out. And I think it is an interesting question. Yeah, and then back, so yeah, I'll ask my co-authors if there's any chance we can get data like that at that point. So obviously the Fed is reticent to release too much of this data for obvious reasons. Florian is a great discussant for sure. I couldn't have a better one. And I just wanted to respond to, of course, when the SMCCF facility was announced, spreads dropped precipitously, much more than they did when the actual ETF purchases were implemented. But what we want to do in this paper is to have a precise identification. And there's all kinds of things happening when the SMCCF is announced. You got the president saying things, you got the Secretary of the Treasury. We wanted to get down to the microsecond and identify very carefully. But that anticipation, may have been reduced the effect, but there was still an effect ex post.
Well, I actually have a question on the identification strategy. It seems that what is crucial for the setup is that market participants don't know what the Fed is buying, as you explained, and also
correct.
But at the same time, you say they're in the market for 300 million a day, and basically it's known that this program exists.
Yes.
So how sure can we be that the traders really don't figure out what is being bought?
Well, I don't think we can be sure of that. I mean, that's one of the things that we've been trying to get a little bit more knowledge, insight of in our conversations with BlackRock, the trade administrator, as well as the Fed. You know, how the Fed constrained BlackRock, and how how BlackRock constrained the AP to not tell anybody, and whether that actually happened. Yeah, maybe there's an incentive. Maybe that's what you're thinking here. Is that there's an incentive if BlackRock buys, $100 million. Wasn't 300 million of one ETF. It was 300 million overall.
Spread over the 5.
Spread all over the place. Yeah, among 16 ETFs. But yeah, if everybody knows that State Street's bond ETF is being purchased by the Fed in the amount of, let's say, $20 million, State Street may have the incentive to reveal this information. That's going to make the bonds that are held by their ETFs lift in price. That very well could be, and it's not. It doesn't conflict with our empirical findings. That may have been what they wanted to do. Maybe that's what the Fed wanted as well.
Yeah. Good. Any more questions? Okay, then we shouldn't eat too much into Divya's paper. So thanks very much, Russ. So Divya, you're up next. We move back to insurance.
Great. Thanks so much to the organizers for including this paper in this very nice conference program. This is joint work with Akshat. We're both at the IMF, and so the usual institutional disclaimer applies. The broad motivation for this paper is actually the same as the broad motivation for this conference, which is that in recent decades, the dramatic growth of non-banks and financial intermediation is a really kind of striking development that raises a very broad question, which is, how is financial intermediation different when the intermediary involved is not a bank? And within that broad space, which is obviously of interest for the whole day, here we're going to zoom in 2 dimensions. We're going to think specifically about life insurers, and we're going to think about how their presence and their footprint shapes the transmission of monetary policy. And to start with, just to say a little bit about why we want to focus on life insurers. So life insurers are an important part of the non-bank financial intermediation space, particularly in the US. And we study life insurers for 3 reasons. The first of which is that they're very big. So they're kind of linchpin investors in corporate bond markets. They account for about 20% of holdings of all US corporate bonds. And so their kind of investment decisions matter for the real economy. Second, we have a clear conceptual understanding of what makes them different from banks. They have very long-term liabilities. And intuitively, that could matter for how they react to monetary policy and therefore transmit monetary policy to the wider economy. And finally, we'll be able to draw on very granular data on their investments to understand exactly how. So the paper proceeds in 2 parts. In the first part of the paper, we highlight that long-term risk-free rates are very important for life insurers' asset allocations. Now, life insurers have kind of uniquely long-term liabilities, sometimes stretching out decades ahead. And there's a sense in which it would be very natural to back these kinds of liabilities by holding long-term safe assets. At the same time, that might be difficult, both because it might be hard to find supply of those long-term assets, that perhaps is relevant in Europe in some cases, and there might be a sense in which the yields on those long-term safe assets are too low. Nevertheless, what we argue in this first part of the paper is that long-term risk-free rates should remain a very important benchmark for life insurers. And concretely, a 10 to 15-year corporate bond for which the level of the yield is lower than on a long-term treasury is should be a very unattractive asset for life insurers. Right? Because they could move to the safer asset and have more duration on their assets and have a higher yield. And so conceptually, we would expect that long-term interest rates should be a key reference price for life insurers in their asset allocation. And in the first part of the paper, we use very granular transaction-level data on all life insurer transactions to show that this does indeed appear to be the case. So from a measurement perspective, we kind of isolate relative demand from insurers relative to all other investors at the bond level. And then importantly, what we show is that yield differentials relative to long-term treasuries are a really important determinant of relative demand from insurers. So kind of how insurers view this kind of debt, privately issued debt, relative to other kinds of institutional investors. And obviously that's quite different from the way that we normally think in fixed income. Then in the second part of the paper, right, so the lesson from the first part of the paper is that we should expect that long-term interest rates are very important for insurers. In the second part of the paper, we then turn to thinking about how insurers' footprints matter for the transmission of monetary policy. And the conceptual chain that we have in mind is the following. So we're going to be interested in conventional monetary policy, and we're going to think about how conventional monetary policy plays through. And so imagine that there's a kind of tightening of conventional monetary policy that increases long-term risk-free rates. And we're going to take for granted largely that this happens, largely drawing on an existing literature with a little bit of a wrinkle there. But suppose that conventional monetary policy increases long-term risk-free rates. Now, what we learned from the first part of the paper is that that should matter for how life insurers approach privately issued debt. It should reduce their demand for privately issued debt, like corporate bonds, relative to other institutional investors. And then finally, because they are such important investors in this asset class, that should also be relevant for quantities. So, risk premia should go up, and in particular, credit risk premia should go up. And what we do in the second part of the paper is we trace this full chain through both quantities and prices. So we do see that when conventional monetary policy increases long-term risk-free rates, that does affect relative demand from insurers relative to other institutional investors, focusing still on primary markets. And then what we'll do is here in this part of the paper, we'll then be able to turn to secondary market data, where we'll have kind of lots of high frequency data, and we'll be able to look at how risk premia evolve for the same bond over time. And then in the second part of the paper, we'll look at the dynamics of risk premia at fairly high frequencies around monetary policy shocks. And we'll have a couple of exercises to show that life insurers are an important part of this transmission chain, that risk premia on corporate bonds react differently, and in particular, they react to the effect of monetary policy on long-term risk-free rates because of the presence of life insurers. So in terms of measurement, we'll get into the details, but we'll try to be sharp in our measurement of risk premia. And importantly, we'll be able to look at in doing that, we'll be able to kind of isolate the price of risk from any variation in the quantity of risk. And then we'll use variation in insurers' footprints within the same bond over time and show that the footprint of insurers appears to change the transmission of monetary policy. And then our final result will be to sharpen, to really kind of pin down identification. We'll introduce a regulatory shift specific to the insurance sector that will allow us to see what happens when insurer footprints change. Just to spend a little bit of time on how we see contributions relative to prior work, the existing literature on the transmission of monetary policy to financial markets has two strands that we want to highlight. So one strand of this literature observes that somewhat surprisingly, long-term risk-free rates also appear to react to conventional monetary policy. Right? So this literature on kind of excess sensitivity largely concluding that what seems to be going on is that term premia seem to be moving around. A separate strand of this literature has observed that credit risk premia also appear to react to conventional monetary policy. And in the literature so far, these impacts of monetary policy have been seen as kind of distinct phenomena. And the way we see the contribution of this paper is as presenting causal evidence that when conventional monetary policy shifts term premia, insurers' reaction to that shifts credit risk premia. So the reason that credit risk premia react is at least in part because of the way that insurers react to how monetary policy shifts term premia. There are a range of additional kind of contributions that I'll highlight as we go along. So I'll be very brief for the purposes of time on the first part of the paper and just give you a little bit of the flavor of the first part of the paper, where again, the idea is that long-term risk-free rates really matter for insurers' asset allocations. And again, from a measurement perspective, we isolate relative demand from insurers relative to other kinds of institutional investors at the bond level in primary markets. And we do that by looking at the bond level at how much of a particular bond issuance purchases from insurers account for. Right? So that gives a sense of relative demand from insurers relative to all other institutional investors. And what both of these figures show is that relative demand from insurers is strongly sensitive to spreads to long-term risk-free rates. So across bonds, across privately issued corporate bonds of different maturities, relative demand from insurers is highly sensitive to spreads to long-term risk-free rates, which obviously is quite different from the way we normally think in fixed income markets. And again, this reflects that long-term risk-free rates are a key benchmark for life insurers. In the paper, we do more. We kind of formally at the bond level relate these spreads to long-term risk-free rates to relative demand from insurers. And one point to highlight there is that kind of the traditional spread that we think about in fixed income to some sort of duration match benchmark offers no additional information about relative demand from insurers. Okay, so turning from that then to the second part of the paper, which I'll focus more on for this presentation, how does the footprint of life insurers matter for transmission of monetary policy? So the starting point for this, again, the conceptual chain that we have in mind is that conventional monetary policy first matters for long-term interest rates. And again, we're largely going to be taking the literature on this for granted, but with one wrinkle that I'll get into now. So we're going to be looking at monetary policy shocks, so we're going to look at monetary policy announcements, and we'll look at how long-term risk-free rates react within a 1-hour window of that announcement. And the wrinkle relative to the existing literature is that we'll account for information effects. So in the spirit of work here at the ECB, we'll kind of look at announcements where stocks and bonds have the opposite correlation so that we can focus on announcements that are more about monetary policy shocks than information shocks. And what these two figures show you is that there is a strong relationship between how short-term interest rates and long-term interest rates move around monetary policy announcements, but only on days where information effects don't dominate. And to our knowledge, so this focuses on the very long end of the yield curve, and in that sense is a little bit different from the existing literature. But to our knowledge, that's a kind of new finding to the literature. This observation has not previously been made as far as we know, and perhaps is a bit helpful to the literature that aims to think about why long-term interest rates react. For our purposes, this is primarily helpful for identification. We're going to focus on the days on the right, where there is a clear relationship between short-term interest rates and long-term interest rates. Then we're going to think about how risk premia react to this impact of monetary policy on long-term risk-free rates. And the object of interest for us, what we want to study is risk premia. And to do that, it is important for us to isolate variation in the price of risk from any variation in the quantity of risk. And so what we'll do is we'll kind of estimate or implement, we'll follow Gilchrist Zakrzak's work in estimating excess bond premia at the bond week level with a couple of improvements. So this is kind of another methodological contribution of the paper along the way. One of these improvements is that we will draw on option-adjusted spreads for all of the bonds that we use, kind of directly option-adjusted at the bond time level, which is relevant because most of these bonds are callable. And we're going to use measures of bond-specific default risk, not issuer-specific default risk. And those can be different when there are claims that vary in seniority, but are claims on the same issuer. So a couple of methodological improvements that we think kind of help in being sure that we're isolating variation, kind of any variation in the quantity of risk away. And then what we want to do is we want to think about, what is the footprint of insurers in shaping the transmission of monetary policy to risk premia? And to do that, we're going to think about the cross-section of bonds. So we're going to think about how, across the cross-section of bonds, risk premia react to how monetary policy affects the yield curve, and in particular, long-term risk-free rates. And we'll have two exercises. The first of these will look at when we'll look at kind of instances where insurers account for a larger portion of the investor base. So we'll kind of look at how monetary policy transmission is different when insurers are a bigger portion of the investor base. And then second, to sharpen identification, we'll draw on a regulatory shift specific to insurers that made them more price sensitive. Now, all of this focuses on prices, so this is kind of all on the price dimension. In the paper, we also present evidence on quantities. So we do see that relative demand from insurers shifts when monetary policy moves long-term risk-free rates around. But beyond telling you that, I won't focus on that much in this short presentation. So just to show you, just to give you a flavor of what these results are with some detail. So here what we're going to be doing is, again, across the cross-section of bonds, we're going to look at how risk premia, so excess bond premia, react to monetary policy and how that depends on how big the insurer footprint is. Right? So our coefficient of interest is this interaction between insurer exposure and our measure of how monetary policy affects long-term risk-free rates. And again, to highlight, this T30 yield, that's the kind of monetary policy-induced component of the shift in long-term risk-free rates. So that's capturing how long-term risk-free rates move within a 1-hour window of monetary policy announcements. And our basic finding is that when insurers account for a larger portion of the investor base, risk premia are more sensitive to the effect of conventional monetary policy shocks on long-term risk-free rates. And to give a more visual sense of that, so this figure uses a very similar, kind of basically the same specification, but here we're splitting out as we look at these figures from your left to your right. As we move to the right of these figures, we're looking at bonds for which insurers account for a larger portion of the investor base. So the insurer footprint is bigger. And what we see as we move from the left to the right is that where insurer footprints are bigger, risk premia are more sensitive to how monetary policy shifts long-term risk-free rates and less sensitive to how monetary policy shifts short-term risk-free rates. And importantly, because we're looking at secondary markets here and we can rely on high-frequency information within the same bond over time, all of this is after including bond fixed effects. Right? So we're looking at variation within the same bond over time. And one of the points that helps with is that if there are clientele effects or if some issuers or some bonds are targeted towards certain types of investors, that's all in the fixed effects. Okay. Now, turning from this exercise to our next exercise, now we're going to introduce a regulatory shock specific to the insurance sector. So we're going to use a shift in risk weight treatment of corporate bonds specific to the life insurance sector that took place in 2021. This, as a kind of methodological contribution along the way, so this is another contribution of the paper. To our knowledge, this regulatory shock has not previously been used in the literature. Now, what happened in this regulatory change was that before the shift, risk weights used to be quite discontinuous for life insurers, and in particular, there was a big jump just going from investment grade to high yield. And what this shift did is that it made risk weights not fully continuous because they were still functions of credit ratings, but it made risk weights somewhat more continuous. And the effect of that was that there were some bonds for which life insurers saw their risk weights go up and they became more price sensitive. And so what our second exercise does is it relies on this variation in a regulatory shock specific to the insurance sector to really kind of pin down that this comes from insurers. So here what we find is that for the bonds that were affected by this regulatory change, so again, think of bonds for which the risk weight went up, after the regulation changed and made insurers more price sensitive, risk premia, risk premia became more sensitive to the effect of monetary policy on long-term risk-free rates. And so we think that this regulatory shock helps in ruling out a number of alternative stories and is also helpful in showing specifically the role of life insurers as opposed to other kinds of non-banks that also have long-term liabilities like pension funds. There are a number of additional results in the paper that I won't obviously fully be able to get into. But one, a set of robustness results that we want to highlight help us get to the fact that the impact of conventional monetary policy shocks on long-term risk-free rates appears quite important. And again, as I said, it's important in doing this to be careful in ruling out information effects. And so the kind of, we saw this in the figures, but the effect of monetary policy shocks on long-term risk-free rates is important to the results. We find weaker results if we look at just how monetary policy affects short-term risk-free rates. And our focus is on conventional monetary policy. So another result that I wanted to mention that actually is not currently in the paper is that the results are robust to dropping announcements that had some sort of QE component. So that helps us kind of bolster the interpretation that this is really about how conventional monetary policy shifts long-term risk-free rates. There are other results in the paper, but I won't get into them here. And so to summarize, our basic message in this paper is that insurers' long-term liabilities, which again is conceptually what makes them different from banks, seem to play quite an important role in shaping the transmission of monetary policy. Right? So why is that? Insurers' long-term liabilities make long-term interest rates an important benchmark in shaping their asset allocations. And this is why risk premia react more to how monetary policy affects long-term risk-free rates when insurers have larger footprints. So more broadly, what this shows is that the effect of monetary policy and monetary policy transmission depends on how monetary policy affects the whole yield curve, including the long end of the yield curve. And this shows that the transmission of monetary policy can be quite heterogeneous and depends on who holds a particular asset. And let me end by saying that, obviously this is part of a broader interest from both policymakers and academics in non-banks, as we've seen in the whole day. I'll stop here and look forward to Fulvia's comments.
Okay, and this question is Fulvia from the New York Fed.
So it is a great pleasure being here today and discussing this very interesting paper. Given my affiliation with the New York Fed, the usual disclaimer applies. So insurance companies represent the third largest financial intermediary both in Europe and in the United States. Yet we have limited knowledge about the insurance sector from a corporate finance perspective, and we know little about the role played by insurance companies in the transmission of monetary policy. So let me first emphasize that this paper represents an important contribution in this direction, as it is one of the very first studies that examines the insurance channel of monetary policy. The authors focus on life insurance companies operating in the United States and examine the transmission of monetary policy through the corporate bond holdings. So just to give you some context, corporate bonds represent the asset class in which life insurers invest the most, accounting for roughly 54% of the invested assets. As the authors show in the paper, life insurers tend to invest in corporate bonds with long maturities to match their long-term liabilities, which are composed by insurance policies and annuities. Nonetheless, life insurers exhibit a negative duration gap for a protracted period of time, starting from the global financial crisis onwards, as documented by this plot presented in the paper, which shows a negative sensitivity of life insurance company stock returns to long-term bond returns. So based on this Thales fact, the authors formulate some hypotheses. They argue that life insurance companies face a trade-off between extending asset duration and receiving lower yields on their investments. That is, insurance companies may expand the duration of the assets by investing in treasuries, because there is a larger supply of treasuries with long-term maturities. But by doing so, they would forego some returns, because yields on mid-term corporate bonds might be higher than yields on long-term treasuries. So in light of that, they argue that when long-term interest rates rise, investing in treasuries becomes relatively more attractive to insurers, since the returns paid on insurance liabilities are sticky. And this means that a contractionary monetary policy may induce a substitution between corporate bond and treasury holdings. So then they test this hypothesis and they present a wide set of interesting findings. First of all, they show that long-term risk-free rates shape life insurance demand for corporate bonds. Importantly, they document that conditional on the credit quality and other bond characteristics, life insurance companies tend to purchase a lower share of newly issued corporate bonds in response to a contractionary monetary policy shock. Then they move from quantities to prices by looking at corporate bond risk premium, and they focus on a specific component of the risk premium, which is not explained by credit risk, liquidity risk, or other bond attributes, which they call excess bond premium. And they show that conditional on bond characteristics, the excess bond premium of a corporate bond increases by a larger extent in response to a contractionary monetary policy shock if insurance holding share of that bond is larger. So this way they can tie corporate bond risk premium to insurers in investments. And then in the last part of the paper, they exploit a regulatory reform that was introduced in 2021 in insurance capital regulation, which essentially increased the capital requirements for a wide set of corporate bonds with a credit rating AA2 and below. And they show that the excess bond premium of corporate bonds becomes more sensitive to a contractionary monetary policy shock after the increase in capital requirements for corporate bonds that was triggered by the regulation. So this is, in a nutshell, the main building blocks and the main findings of the paper. I'm going to focus my discussion on the conceptual framework, starting with the role played by the negative duration gap in driving insurance companies' incentives to invest in treasuries vis-a-vis corporate bond, which is something that Jivan mentioned in his presentation, but is kind of more emphasized in the paper. So I agree with the authors that the pass-through of policy rates into the returns paid on annuities and insurance policies takes time. But a contractionary monetary policy shock reduces the duration of insurance liabilities. So while policy lapses and annuity surrenders are discouraged by some specific feature of insurance contracts, such as withdrawal fee, there is evidence that they do increase when long-term interest rates go up, as documented by Ozzagli and Wang in these two scatter plot of the paper. And so then, higher interest rate paid on new insurance contracts together with higher surrenders and lapse rate on existing contracts may imply a narrowing down on insurance companies' duration, a negative duration gap, which is what I show in this plot, including in a blog post that I published a year ago and that I take the freedom to cite here. So essentially, as the authors do in the paper here, I calculate the sensitivity of insurance companies' stock returns to long-term bond returns using a similar framework. The estimates presented are quite similar to those documented in the paper, but my analysis extends 1 year farther, so it looks at up to 2022 rather than 2021. And it clearly shows that amid the interest rate hikes of 2022, the negative duration gap of life insurance companies narrows significantly to go close to zero. These results, together with other results presented in this blog post, suggest that interest rate hikes may actually trigger a reduction in the duration of insurance liabilities. So I'm saying all of this to make the point that life insurance companies that start with a negative duration gap should have lower incentives rather than higher incentives to invest in securities with a long duration when long-term interest rates go up. And this is consistent with evidence presented by Ozzagli and Wang, which show that life insurers reduce the duration of their corporate bond portfolio when the 10-year Treasury yield increases. And so basically, this makes me argue that when it comes to contractionary monetary policy, the more relevant trade-off may not necessarily be between duration and yields, but rather between yields and cost of capital. And let me explain why. So capital requirements of corporate bonds in the portfolio of life insurers are tied to their credit ratings, whereas capital requirements for treasuries are equal to zero. We know that when long-term interest rates go up, security yields go up, but also the likelihood of default of risky debt increases, potentially inducing insurers to shift their investments towards safer security with a lower cost of capital or a lower likelihood of being downgraded and being charged higher capital requirements in the future. So the exercise presented in the paper, which focuses on the 2021 regulatory reform, goes in this direction. But I would suggest the author to investigate this, if you wish, risk-taking channel of monetary policies more extensively by exploring the heterogeneity in life insurance demand of corporate bonds depending on their credit quality. For example, are life insurance companies less willing to hold corporate bonds at the edge of each bucket of risk-based capital charge when long-term interest rates go up? And by bonds at the edge of each capital charge, I mean, for example, Baa3 rated bonds that are at the investment grade or NIC 2 threshold. And this analysis could also be performed at the insurance company security level beyond the aggregate security level to unveil additional interesting heterogeneities in life insurance monetary policy transmission based on their financial strength or their combination of liabilities. Let me now move to the second comment. When it comes to insurers' risk-taking incentives in response to a contractionary monetary policy, an important related and recent paper is that by Lee 2025. So in a nutshell, Lee argues that when long-term interest rates increase, life insurance companies experience equity gains given their negative duration gap. And this is because the value of their liabilities shrinks by a larger extent than the value of their assets. As a result, life insurers may be better positioned to take on risk and therefore may rebalance their portfolio towards riskier corporate bonds. And consistent with these hypotheses, they find that the pass-through of long-term interest rates into bond yields is weaker for corporate bonds with lower credit quality, and this phenomenon is stronger for bonds held by life insurers, as depicted in this plot, which shows the change in the differential yield between NIC 2 to NIC 6 corporate bonds relative to the safest NIC 1 corporate bonds for the subset of bonds with and without insurance ownership. So both Lee's prediction and results on corporate bond risk premium are in contrast with those presented in this paper. Now, while I'm sympathetic with the idea that insurance companies have lower incentives to take on risk in a context of contractionary monetary policy, both these two channels may be at play, and I think it would be important to reconcile these two views. One potential explanation that came to my mind could have to do with the convexity of capital requirements applied to corporate bonds with different credit ratings, which Divya was showing earlier on. So in a trade-off between yields and the cost of capital, considerations about the latter may be more important for corporate bonds that can experience a larger increase in capital charges if downgraded. And those would be, at least up to 2021, corporate bonds at the edge of the NIC 1 and the NIC 2 designation, which are still part of the investment grade space. Whereas Lee's paper actually focuses on the differential behavior of below grade corporate bonds versus investment grade. So this could be one explanation, but I think it's an issue that is worth investigating. And then let me just add one very last comment, and I will discuss the remaining directly with Divya. So the paper discusses about a substitution between corporate bonds and treasury holdings as long-term interest rates go up. But this is not explicitly tested in the data by looking at the two sets of asset classes jointly. So I think it would be interesting and easy to estimate a specification which explore life insurance portfolio allocation between corporate bonds and treasuries in response to contractionary monetary policy shock. So let me now conclude. This is a very interesting paper, an important contribution to understanding the role played by life insurers in the transmission of monetary policy. I encourage the authors to sharpen the conceptual framework and recommend everyone reading it.
Thanks, Fulvia. So in the interest of time, let's take a few questions. So we have one over here.
Hi, Christian Kubica, ECB. Thanks a lot for the great presentation. I have one question or maybe a comment that is related to some of the theme that we often heard now about bunching together NBFIs. Here, it seems to be a bit about bunching together insurers. So the title suggests it's an insurer channel, but it's really just a life insurer channel. And we have a paper, for example, related paper on monetary policy transmission. We look at non-life insurer, and the effects are exactly the opposite because, of course, the duration gap there is positive and not negative. And going even beyond that, within the life insurance sector, especially in the US, you have huge heterogeneity. Some life insurers are simply becoming mutual funds. And some life insurers are more on the traditional life insurer side with long-term guarantees. And I think that is something that you can very nicely explore. It gives you a very nice cross-sectional identifying variation because your effects seem to be driven by exactly those insurers, or should be driven by those insurers with very long-term liabilities. And also related to that, a comment or question, I was wondering why you choose the 30-year benchmark. First, I think this is a super illiquid market, probably. And second, and more importantly, the average duration of liabilities of insurers is about 15 years. Average duration of assets, fixed income assets in the US is about 8 years. Most people use 10 years as a benchmark. Also, the industry seems to use 10 years. So I was wondering whether your results extend towards those lower, shorter maturities, or there's something special about the 30 years.
Thanks, Christian. Let's collect questions. So up front here.
Thanks a lot. Patrick Montagnier, ECB. It was a fascinating paper, and also your comment by you. Just a few questions. Indeed, between non-life and life, it's not surprising because it's not the same duration, so that's very clearly your paper is focused on life insurance. I have two questions on that. Do you think that you could see a difference between the EU and the US, given the fact that the regulation, and notably the calculation for capital requirements, is completely different in both jurisdictions? I will treat the EU as a single jurisdiction in this case. Because, of course, the way we are treating the capital charge is very, very different, and we have seen that at the AAIA's discussion about the possible ICS. The second question, and the AAIS has issued recently, it was in March, public consultation on the draft paper about the new trend in the life insurance sector. One of them was the more alternative assets, but you have partly treated that. But the other one was not in your comment, and in my view, less assessed and less understood by both supervisors and the market, is what they call the asset-intensive reinsurance. So now the reinsurance in life is no more the classical reinsurance, longevity and mortality. It's more to transfer your asset, both your asset and your liabilities, to a new kind of reinsurers, which are often the subsidiaries of private equity and private funds firms, and you have some big names in this game. And of course, the insurers, life insurers, are no more managing directly their own assets. So it's completely transferred. You have some additional risk in this transfer. I don't want to discuss that. But of course, when talking about monetary policy channel, you could have a kind of lack of sensitivity because you don't see them directly in the balance sheet of insurers nowadays, and it's very, in my view, probably more massive in the US than in the EU.
Okay, thanks, Patrick. I add one more question to your laundry list. So key assumption I understand in your approach is that there are these long-term effects on risk premia or term premia for monetary policy, which of course Jeremy Stein sort of started this literature. So the Jarosinski-Karadi paper you cite, and we know very well on displays, actually looks at that and shows that at least at the 10-year government bond, there is an increase in the term premium, but it's very short-lived. It's just a couple of months or maybe a quarter or something. And I would think, life insurance takes sort of a more long-term perspective when they decide on these asset allocation decisions you have. So I was sort of wondering what's your take on that, or whether you've looked at sort of more persistent effects of things, because more fundamentally, if that effect is there, we should change all the central bank models of monetary policy where we assume away this effect. So, back to you.
Yeah, great. Thanks for all the interest. Let me thank Fulvia for the really nice discussion and say one very quick thing, that relative to the Lee paper, we think that we are much more careful in ruling out anything related to variation in the quantity of risk. And I think that might actually matter for the results potentially more than the conceptual framework. We could discuss this more. On the nice suggestion there, it is actually on our list to do robustness with the 10-year instead of the 30-year. We don't think there's anything special about the 30-year. We've done some things in that direction. I do think that the regulatory framework in Europe is quite different from the US. And actually what life insurance means, consistent with the earlier question, is different from the US and different within Europe. But I do agree with you that regulation could be quite different and could matter, and relates to your question. And Luke, yeah, so I think that's interesting. I guess, for identification reasons, we're doing something that's very short term, right? So one thing to highlight is that the sensitivities of risk premium that we look at are within 1 week of the monetary policy announcement, so they're kind of in the window that you're thinking about. And we do find that kind of the longer term thing that we do find is that this reduction in quantity, so the reduction in relative demand from insurers, that's analysis that we kind of do at the quarterly frequency. So we do find some effect in relative demand at a kind of quarterly frequency. But of course, there's always room for more work. Thanks again.
Good, that's a perfect sentence to end this interesting session on. I do think there's lots of room for more work on, indeed, insurance and the different forms of insurance. But also, as Russ showed us, there's still lots to learn from the previous crisis, as we may get into the next one.
Maybe
with
sooner
more
than
data,
later.
right? We need more data and all that. So we also need more coffee, and that's now for the next 15 minutes. So a round of applause, thanks.
So good afternoon. I would like to welcome you to the last session of this conference, so this afternoon. And the session is on banks and non-banks. That's a fairly generic title, so sounds a little bit like we have put together the remaining papers, but I can assure you they're both interesting papers, and it's about risk pricing and risk transfer, so I think in the end they fit very well together. And I also have to announce that the presenter of the first paper, Max, who is sitting here next to me, unfortunately has to leave after the first part of the session. So don't be surprised if he walks away. So it's not that he is disappointed by the reaction to his papers, but it's rather that he has to catch a train that's leaving early on the main station. So with that, I think we can start immediately, and I would give the floor to Max for the paper, what do lead banks learn from leveraged loan investors?
Yes, thank you very much. It's a great pleasure to be here, and I'm very sad that I have to leave early. So this is joint work with Ralf Meisenzahl and with David Xu, and because Ralf is at the Fed, the standard disclaimer applies. So how do we think about the broad research question here? So one of the core functions of banks is that they screen and monitor. That's to say they produce information about borrowers, right? And we've heard earlier today that banks are being replaced more and more by non-banks, or the lending is done by non-banks. And so you kind of have to wonder whether non-banks are producing any information at all. Do we have like a change in the distribution of information production or not, right? And this is sort of a very broad question. And we ask this in a very, very specific context. We're looking at the market for junk syndicated loans. So syndicated loans, investment grade and non-investment grade. We're looking at the non-investment grade segment, the junk segment. And because these loans often finance things like leveraged buyouts, they're also called leveraged loans. Okay, so we look at the market for leveraged loans. So in this market, we have banks that originate basically to distribute. They arrange a loan, but the participants in the syndicate who end up holding the loan are mostly institutional investors. So these are the non-banks, right? These are collateralized loan obligations, mutual funds, and hedge funds. And echoing some of the discussion from earlier today, these are maybe I mean, there are many different non-banks, right? And these are very specific non-banks, right? In the sense that they are probably more sophisticated than some other non-banks. They trade actively in these loans also in secondary markets. I'm going to be talking about primary markets, but they trade actively in secondary markets. And they devote a lot of time to credit analysis, right? And, but this is a very large market. So, between, let's say, $1 to $2 trillion worth of issuance per year, right? So roughly half of the syndicated loan market. So it's sort of an important market to study in its own right. And so the specific question that we ask is whether these non-bank investors produce information. And so the lead banks, when selling these loans, essentially this is like a security issuance exercise. They conduct a book building exercise, and in this book building exercise, they adjust the pricing on the loan according to demand from these investors, okay? And so the question is there information in these price adjustments? So the way to think about this is maybe like this, okay? So a lead bank will invite a group of investors into a room and say, we think the loan you should buy the loan at the reference rate plus a spread of 400 basis points. And then they ask everyone in the room, at 400 basis points, how much of the loan would you buy? You sum all of this up and you see whether you're selling too much or too little of the loan. If you're selling too much of the loan, you know you can decrease the spread a little bit, maybe to 350 basis points. If you're not selling enough, you need to increase the spread a little bit, maybe to 450 basis points, okay? And so they keep iterating over this until they're happy with the result. And so there's a price adjustment, right? So we go up from 400 basis points to whatever the final spread is, or maybe we go down. These pricing adjustments are called flex. And the question is whether there is the valuation of investors, which is reflected in this flex, whether this has information about the borrowers, right? And so basically here is what we find. So first of all, investors know something that a lead bank does not. Okay, and this drives flex. So investors know their own. I'm going to show you a result, which is called a partial adjustment result here, which I'll explain in a second, which basically shows the investors know what their own valuation is, but the bank does not know what the valuation of investors is. And the bank needs to give incentives to the investors to reveal that information, right? Okay, so they reveal this information, and this is what drives or produces variation in flex, right? The question is, what drives the valuation of investors, though? So it could be that you have a high valuation for the loan because you've had a lot of inflows. Or it could be that you know something about the true default probability of the borrower, and you know that the probability of default of that borrower is lower than the bank thought it was. Okay, so there's two possibilities. And so if it's the second possibility, if these investors have actually produced information about the borrower, some piece of information about the probability of the default that the bank doesn't know, then the flex, the change in the interest rate, should predict default. Okay, and so we find that, and this is a second result, that flex predicts default. This is stronger in deals where investors plausibly have more information. And we can also show that after the deal, banks update their internal estimates of the probability of default in accordance with flex. Okay, so the interest rate went up, borrower is riskier than we thought, the internal PD estimate will go up. Okay, and so these are the three results. And the way that we read these is that investors contribute information about default. So thinking about the distribution of information production, it looks as if some of the information is also coming from these non-bank investors here. And so we think we contribute to, basically we're combining two strands of literature, right? There is a strand of literature that argues that banks have private information, and that causes lots of problems with loan sales, and so maybe banks have to retain, and so on and so on. There's another strand of literature that talks about the book building auctions and the information extracted from investors, although that's usually silent about what drives valuations of investors. Okay, and so what we're trying to do here is we're trying to combine both and show that investors have this information. Right. So I'd like to talk about basically two hypotheses. And the first one is related to showing that investors know something about the valuation that the bank does not. Okay. So if investors know so the alternative hypothesis here is the following. There is symmetric, imperfect information about where the true demand curve is. Okay. So demand could be high, demand could be low. Neither the bank nor the investors know what demand is. You go into this book building auction, and then if demand is high, well, then the bank increases price, decreases the interest rate. If demand is low, then it goes the other way around, right? But what could also be the case is that the investors know their demand, their valuation, but the bank does not. Okay? In this case, the bank must give incentives to the investors to reveal the information. It must make it incentive compatible. So how would it do this? The problem is that the investors always want a higher spread, right? So you have to prevent them from saying, oh, I want a very high spread. So how do you do this? The first is that you propose LIBOR plus 400. If you don't sell all alone at this point, if you increase the spread, the investors must know that you also decrease the quantity that you allocate to them. That's the stick. Right? So that makes it unattractive for them to propose a higher spread. At the same time, when they say that they're happy with 350 basis points when you initially said 400 basis points, right? That's good for them. That's bad for them because they're going to get a lower coupon on the loan. So you need to give them incentives to reveal that information, and you do this by underpricing the loan in these situations. Okay? So that means that there is that's an empirical prediction about the correlation between whether you increase or decrease the interest rates, the flex, and whether you observe underpricing, which is what this hypothesis is and what we're going to test here. And there's also, I guess, another hypothesis about quantities, which we have also tested in a previous paper, right? So this is the first hypothesis that we're going to test. Flex should be negatively associated with underpricing, and when you find that, that is evidence that there's something that the investors know about their valuation that the bank does not. Okay? This, by the way, is not a contribution of our paper. This idea goes back to Kathleen Hanley in 1993. I want to make that very clear, but it's a very important part of the argument, which is why I'm repeating this here. And then, so flex contains information, reflects revelation of information by investors to the bank. And so what is that information, right? Could be about inflows and outflows, or it could be that the investors have a valuation which is based on information that they have about the true probability of default, for example. And if so, Flex should predict default, okay? And so there's some other hypotheses in the paper, which in the interest of time here, I'm going to skip. But basically what we're going to do is we're going to run these kind of regressions where on the left-hand side we have either underpricing or we have a default indicator. On the right-hand side we have Flex, okay? And the hypothesis says something about the coefficients or coefficient of interest there. So the data that we use here comes from a company called Leverage Commentary and Data, and who collect information on the initially proposed interest rate, or spread, which I should have said is called a torque spread, and then the changes in the spread during book building, the Flex, okay, which is like the key component of this. And we combine this with a bunch of other data sources to get additional information on default events, rating changes, which we use in some robustness checks, secondary market returns, which we use for other hypotheses, and then borrower financials, and importantly, the thing about banks' internal estimates of their probability of default comes from the Y14s. And I should say that this is not in the paper yet. Okay, this is a result from last week. Okay, so here is the first result. The first result is that there should be a negative correlation between the spread Flex and underpricing. Underpricing is on the left-hand side here. If the banks are bribing investors to reveal their private information with underpricing, right? So if you lower the spread, that's bad for investors. How do you get them to be okay with lowering the spread? By giving them underpricing in these situations. If that's true, you should have a negative correlation here, and this is what we find, okay? And yeah, so this is similar to results that people have shown in the IPO book building literature for equities. People have done this for bonds, and we also did this for leverage loans in a previous paper already also. Okay, so the way that I read this result is that this means that the investors know their valuation, but the bank does not. Okay, and the bank learns about the valuation of investors via book building, and the information there is contained in the Flex. Okay, so now we can check, well, what is Flex, or what does it predict, or what drives the valuation of investors? And so it seems as if Flex predicts, it doesn't, Flex predicts default. So it seems as if the investors have information about default. So this coefficient here, to interpret this, for an increase in the Flex is measured in basis points here. If the bank increases the interest rate by 100 basis points, then the probability of default of this borrower, the probability that the loan will end up in default is roughly 3.7% higher if I look at the first column here. Okay, and this is relative to a probability of default of around 4% on average, so it doubles the probability of default. Yeah, so it's quite a large coefficient. And you may wonder whether the effect here is mechanical, right? So if I force, okay, so yes. So if we increase the interest rate on a borrower, right, then maybe that borrower simply has more difficulties making those higher interest payments, and this is why they default, right? So there's several ways we attack this. The first is that if an increase in the interest rate is a problem for a borrower, it should not matter whether we're looking at deals that refinancing existing loans or deals that are new money deals, right? In both cases, it should lead to a higher probability of default. However, you could argue that when you're refinancing an existing loan, there isn't much information that investors can contribute, right? Because there's an existing loan, it's trading in secondary markets, and you can see the spread on that loan in the secondary market. So if this is an information effect, we argue, you should see something in new money loans, but not in refinanced loans, and this is what we see here. So that suggests that this is an information effect. There's another test that we do, which I'm not going to talk about here, but we actually compute interest coverage ratios for these loans, right? And we can talk about the counterfactual change in the interest coverage ratio. So what I mean by this is the bank initially proposes an interest rate. If it had stayed at that interest rate, that would imply a certain interest coverage ratio. Then the bank adjusts the interest rate as a final interest rate, and that means that the interest rate coverage is not the one that would have been the ICR for the initially proposed interest rate. It has changed, right? So we can actually compute the changes in the interest rate coverage ratio, and we can control for these. And when we do that, the effect is also still there, right? Okay. Then the third result was that the banks update the internal probability of default estimates. Okay, so again, this is from last week. So let me tell you what we're doing here, and then my discussant can tell me how we should improve this, I guess. So for all the banks that have an internal probability of default estimate before the deal, we take an average. For all the banks that have a probability of default estimate after the deal, we take an average, and we see how that average probability of default estimate changes. Right? The flex is public information. All banks should see this, and we see whether they adjust their probability of default estimates or not. And so what you can see here is what this coefficient means is that, again, for an increase in the spread of 100 basis points, banks on average increase, or this average probability of default increases by 0.3 percentage points. Okay? 100 basis points, a 1% increase in the spread means 0.3% increase in the internal probability of default estimates. You see something similar for the internal loss given default estimates, and you could also do the product of probability of default, loss given default, sort of expected loss, right? Like all of these things go up, okay, as you would expect. And we have some other results in the paper. So we do more sample splits, for example, where we look at deals in which there is credit rating disagreement. So there's an initial credit rating for these deals. What happens when the rating agencies disagree in the rating and when they agree in the rating, right? You would expect that when there's credit rating disagreement, maybe the information that investors can contribute is more valuable. You find stronger effects there and so on. We also look at whether we do sample splits with respect to whether there are pre-existing relationships with a lead bank. You would think that if there's a pre-existing relationship with a lead bank, then maybe the investors, there's not so much information that investors can contribute. Effects are weaker, right? And also we find that effects are stronger when the deal is larger. There's some other results here that I haven't talked about. So the valuation of investors is driven by, partially, we think, by information they have about the true probability of default of the borrower. But we also find some evidence which we think is consistent with saying that sometimes their valuation is driven by things like inflows and outflows. So it's not all information, okay? Yeah, but I'm going to skip that, I think, okay? Let me just conclude. So we think that on the basis of this information, banks and investors each provide distinct, imperfectly correlated signals about borrower quality, okay? And so this points to a situation where information production maybe is more decentralized than we usually think, okay? So it's not only the bank that has a private signal about a probability of default, about borrower quality. Maybe these investors in these syndicated loans also have private information that the bank does not know about the probability of default of borrowers, and we should maybe think about the implications of that, right? Okay, thank you.
Thank you very much. So then we have the discussion by Simon Meyer.
Yeah, thanks so much for giving me the opportunity to discuss this very amazing paper, excellently presented by Max. What do lead banks learn from leveraged loan investors? So the motivation for this paper is essentially the same as for the full conference. Post-GFC, we have seen the rise of non-bank lenders, and I would classify them in two ways. There are non-bank direct lenders, such as private debt funds or business development companies in the US, who directly originate loans to companies. On the other hand, we also have so-called non-bank indirect lenders. This includes these CLOs, and they don't originate loans themselves, but rather buy loan shares of syndicated loans that were originated by banks. The banks originate syndicated loans in particular, then sell the shares of these, or some shares of these loans to non-bank investors, specifically CLOs. Now, we also know from classical theory that banks typically screen and monitor their borrowers and therefore produce information which is valuable but loan sales undermine the incentives to do so. Moreover, in this syndicated loan process, in particular in the process of selling these loans, there is a book building process in the background, which Max has discussed. And during this book building process, essentially the banks quote a talk spread, and they then adjust this spread accordingly to accommodate the demand of the non-banks. This paper then essentially shows that the non-bank lenders' demand is informative about borrower characteristics, thereby suggesting that non-banks, just like banks, are informed, and their demand during book building conveys something that banks do not know. This suggests that non-banks may actually complement banks rather than substitute in information protection, and this paper also suggests that maybe the adverse selection in loan sales is less pronounced than we might think. Let me go quickly over the key findings. So in particular, this paper focuses on leveraged loans. Many of these loans are also often known as term loan Bs, which are syndicated loans that the banks originate and sell. So term loan Bs, as opposed to term loan As, are sold to institutional investors, CLOs, and so on. They sell these loan shares to these non-banks during book building, quote a talk spread, and solicit bids from non-banks. If they cannot sell the loans, then they would adjust the spread, and in particular, if demand is unusually weak, they increase the spread, they flex it upward. A high spread flex then indicates that demand has been unusually weak or weaker than expected by banks. This can be due to several reasons. The paper highlights that this in particular is due to borrower fundamentals. That's the effect they isolate and zoom in. There could be other factors such as non-bank lender factors, their liquidity constraints, capital constraints, or lead bank factors. The key finding of this paper essentially then is that a spread flex, an upward increase in the spread, would be linked to borrower characteristic, in particular non-bank demand, then reflects information about borrower fundamentals. And the conclusion here is that banks learn. So let me essentially give 4 comments. The first comment is essentially the most important one. With this paper, one might have 2 potential concerns. Concern 1 is that non-bank demand might also reflect something else than borrower characteristics, in particular the characteristics of these non-bank lenders, for instance, because they might face a liquidity shock and can demand less. They also do a great job to mitigate this concern. The more pressing concern, in my view, is that the spread flex reflects borrower information. I believe that. But this information might not be something that banks do not know, or at least the effect they document might be confounded by many other things. So the effect that's documented in the paper might not be fully attributable to banks learning. The key adjustment, or the key assumption, or a key identifying assumption would be essentially that the spread adjustments accurately reflect banks learning. In particular, banks would have set a different spread or a correct spread if they had more information. However, the spread adjustment is demand-driven, a little bit mechanical. And if you want to really identify the effects of learning, you would have to control for full bank information. The most compelling evidence, however, I think is that Max presented was really this adjustment of the internal risk estimates. So the concern here is, which I might have, the spread adjustments, and I believe that they are informative about borrower characteristics, and the authors identify this effect. But the effect documented may not be attributable to learning, but to other factors. These factors may very well be correlated with borrower fundamentals, and the authors currently address this concern, in particular with obviously including exhaustive controls and fixed effects, by looking at banks' internal risk assessments, and in particular also the subsample analysis Max has highlighted that mitigates these concerns. In particular, as Max has shown, the effects are stronger when the non-banks are plausibly more informed, and they do something along that dimension. Just to give a bit more background what I mean. So it's not clear. So essentially banks could intentionally quote a low talk spread for low quality borrowers, even if they know their type. So they could just have aggressive pricing strategies. What do the banks actually maximize, or what are they interested in? Well, they sell the loans, so they have relatively low skin in the game. They don't even care that much about the spreads they earn because they don't retain much. They might care more about the origination fees rather than the spreads. So maybe the banks just want to maximize the loaned amount because this could maybe maximize their fees or so on. So they could, in principle, just lower the spreads for the borrower to find it attractive to take a larger loan. That could be something. I mean, it's like a cooked up examples. Maybe the banks might also form a coalition with the borrower firm. I mean, it's like also hypothetical to benefit essentially of the less informed non-banks pretending good quality by quoting a relatively low spread. That's a typo. I mean, these examples are cooked up, but it might be that the spread is confounded by other factors than banks' private information, again, reinforcing the concern that the effects of the information content of this flex spread might not only reflect learning. So is there a way to better identify learning? Comment 2 would be about the broader implications of this learning. So I certainly believe that to some extent, banks learn about borrower fundamentals from non-bank demand. It's just unclear how large this effect is. This was my previous comment. The spread is adjusted, but the effect of this adjustment is kind of mechanical to accommodate demand. What are the broader implications of that? As banks learn from non-banks, do they retain less and sell more of the loans they originate, in particular when banks are more informed? Do banks monitor less because they can learn from demand? Are other loan terms adjusted too? I think this is like constrained by data limitations. So in particular, broader questions could be asked. How does the learning from non-banks affect loan terms or banks' information production? That would be a bigger picture question. And does the learning from non-banks crowd out or substitute banks' information production? So this now I flip essentially the direction of causality. The banks may also learn from non-banks precisely because they sell most of the loan and have no incentives essentially to get informed. What I would encourage the authors, and what would be very interesting, but I also understand that due to data limitations it's possible, would be a measure of bank information production or incentives to do so. I know that would require to merge the data set with the SNCC data set, then you could bring in the lead share, but it would be kind of interesting, but that's probably for future work. So like essentially, then one could essentially conduct the test. Is the learning effect stronger for loans where the banks have less skin in the game and where they plausibly monitor less? That would actually nicely complement the other subsample analysis of the authors where they split essentially the sample by loans where non-banks are plausibly informed or plausibly less informed. So I'm also wondering what type of information does this spread flex essentially convey? I would split it in an ex ante and ex post information. So one could think that the spread flex essentially contains some information that is time invariant or would be known and just the bank hasn't acquired that information. So this refers to fundamentals that would be determined prior to deal initiation. On the other hand, it could be that the spread flex could also reflect some new information that arises during the rather lengthy book building process. So because that doesn't happen in one day, I think that lasts a month or so, and new information could arise in the process. So in particular, does essentially the spread flex reflect some information or some changes in borrower fundamentals that occurred after the deal is initiated? I don't know how to, but disentangling these two would be interesting. And like the last comment is also like a bigger picture comment. The standard view would be that banks know more than non-banks. As Max has motivated, gives rise to adverse selection in loan sales. This paper shows that non-banks are informed too. There are several possibilities. So they know different things. So banks and non-banks information is complementary. The banks know a little bit more than non-banks. Maybe there's also a weak complementary, but there's still that the banks are more informed. We still have adverse selection, or the non-banks are actually here the more informed party, and that's something people would call inverse selection. I don't know how to, but again, disentangling these would be very interesting, and that brings me to the conclusions. Very interesting paper, has very important implications, and I just want to give some comments that maybe hopefully or motivate some follow-up research or additional analysis. Thanks so much, and I look forward to chatting more.
Thank you very much for the nice discussion. So before I give you the opportunity to respond, I would like to also ask for questions from the audience. And if you have a question, I would like to ask you to stand up and say your name so that we know who you are. So you were the first one.
Thank you. Victor Stebanos, the Federal Reserve Board, Washington, D.C. So I'm kind of struggling with the idea that all non-banks are equally capable of producing kind of information. So I find it difficult to sort of imagine that the CLO can come up with something. Like in my understanding, they just sort of work off the rating and don't really do any of own due diligence. So I was wondering whether in your data you actually can differentiate what kind of types of non-banks interested in sort of being part of the syndicate. And then another question is sort of about potential mechanical link between sort of flexing and banks updating their probabilities of default estimates. So sort of wondering whether supervisors have something to do here. If I'm a supervisor and observe that flexing has occurred, I probably would expect my bank to actually revise my PDs accordingly. So it might not be just like information revealing exercise, it might be just supervisory pressure. So I was wondering whether you can rule it out somehow or not. Thank you.
Jean-David Sigaud, ECB Research. Just out of curiosity, it would be good to understand a little bit more the incentives of banks of producing information, including, is there a reputational risk of selling lemons, for example? Thanks.
Any other question? Yeah, please.
Divya Kirthi, International Monetary Fund. So my understanding of flex is that it kind of mostly happens when the banks that are arranging what's going on are surprised. So it's not intended to happen. And so wondering if kind of that impression is wrong somehow. And I wonder if the cross-section of that across banks could help you make some progress with some of the thoughts that the discussant had. So are some banks worse at this process? Are they more likely to flex than others? And then do those banks update their PDs more when they learn from the flexing? So I wonder if something like that could be helpful. And I also shared the discussant's view that maybe the most important part of the flex is not on the price, but is actually on all the other terms. I'm curious to hear your take on that.
So thanks a lot. So now you can respond.
So first of all, thank you, Simon, for a great discussion. This was like very to the point. I'd like to respond to maybe 2.5 of your 4 comments. Okay. So first of all, I think we all agree that there is information in Flex about the demand of investors, right? I don't think anyone would disagree with me on that. So you can think of Flex as alpha plus beta times demand plus epsilon, right? And the way I understand your comments is like, what other stuff is in the epsilon, right? This was your first comment. And so some of the specific examples that you come up with, and this goes to some of the other questions here too, is like what incentives do banks have to flex? I think banks do not have an incentive to try and prevent flex, to come up with a pretty accurate talk spread, initially proposed spread. The reason is that, and this is anecdotal, okay, so this is what bankers are telling me, is that typically the agreement between the issuer and the investment bank doing the underwriting is that the bank has to give up something like 25 basis points of its fee if it wants to flex, right? So it loses fee when they do flex. So they have an incentive for that reason not to flex. Secondly, the way that they describe to me what they're doing, they're saying, okay, on the one hand, we need to make the issuers happy, so we want to have a low interest rate on the loan. On the other hand, we want to make the investors happy. We need to make the investors happy, so we need to have a high interest rate on the loan. So on balance, that means we need to satisfy both sides of the market, otherwise we are out of business, okay? And so this also means that they have an incentive to basically initially make sure that the initial guess is as correct as possible, right? And so some of the things that you suggested might be in the epsilon, I think personally I think are like not plausible, right? But this doesn't mean, of course, that there is no epsilon, right? So there are things in flex which are maybe unrelated to investor demand. Now, relating to your fourth point, there is something that the bank learns in this that it didn't previously know. So there's a piece of information that investors have that the bank doesn't, which is what the investors know about their own demand. And this you can see from this partial adjustment result. Okay? I think there's no other way to interpret this. But that's, again, that doesn't mean that like there isn't potentially something in flex. So the problem is if there's something in the epsilon which correlates with our left-hand side variables, which could be underpricing, by the way, in Kathleen Hanley's regression from 1993, or the default indicator in our case, right? And conditional on our observables, which is not demand, right? And that would be a problem for the interpretation. And so maybe what we should do in the paper is we should be more explicit about the exact assumptions that we're making there, right? The second, then I want to say something about the second comment, because the way that I read this is basically about the efficiency of credit allocation, right? The informational efficiency of credit allocation. And is this arrangement where potentially the investors produce some information or contribute some information, and maybe the bank then does less work and produces less information, is that worse or better than a situation in which only the bank had kept the loan and produced the information, right? I think this is a super interesting question, but I purposely steered away from talking about that because I think we have very little to say about that, right? Because this is a really difficult question. And I'm thinking maybe the way to get at that question would be with some kind of structural model, right? Which structural models are good because you can assume identification, right? So, yeah. All right, to get to some of the other questions. Now I need my glasses, right? So we tried looking at CLOs that have and do not have industry experience. Okay, which we computed in, how many deals have they been in and over the past in that industry, and couldn't find anything. That was a lot of work. Potentially, this is because it's very difficult to know we don't have data on which CLO is involved in a book building. What we have is we have the CLO, but what is in CLOs in the portfolios of CLOs, which is at the end of the quarter is similar to 13Fs, and then you have a problem figuring out whether they bought it in the primary or the secondary market, right? Potentially that is an issue there, yeah. The supervisory pressure to change the probability of default after observing flex, I guess the key question is why would the supervisor force people to update their probability of default after observing flex if there's no information about probability of default in it, right? So reputational risk of selling lemons, I think there is this risk, right? Which is why they want to get why I think, or bankers tell me they want to get the pricing accurate to start with, right? And in some sense, like we're arguing that the flex is a surprise, right? In the sense that it surprises the banks because it contains information that they didn't previously have, yeah? And which banks flex? So we've run some regressions where we try to predict flex. And the R-squares are very, very low, right? Like 5% or less or something like that. So it seems like it's very hard to predict who flexes. But if you split into top underwriters and not top underwriters, like top 3 or something like this, it's actually the top 3 underwriters that flex more. Yeah, you could. One interpretation of this is that the top underwriters get the deals which are harder to value, right? And so they have to rely on investors more. Anyway, thanks.
Thank you very much for a nice presentation. So, and then we can move to the second paper, and we have to say goodbye to Max. So, and the next presentation will be on synthetic, but how much risk transfer, and the presenter is Alex Osberghaus.
Our paper is titled Synthetic, but How Much Risk Transfer? And it's about the booming market of synthetic risk transfers, also called synthetic securitization. And it's actually also my job market paper, just in case there will be a market. So the paper is jointly with Glenn Shippens from the ECB, and because we use ECB data, we have the typical disclaimer. Before telling you what exactly synthetic risk transfers, or SRTs, are, let me motivate by looking at some newspaper articles. Bloomberg writes, if you're unfamiliar with synthetic risk transfers, there's a chance you'll hear all about them when the next financial crisis hits. Matt Levine writes, banks transfer risk to themselves, and in the Financial Times, the IMF warns of round-tripping fears. And what exactly that is, we will talk about in a minute. These are only a few of the many, many articles written on the topic, In fact, if you look at the news mentions of synthetic risk transfer, they really spike in 2024. Now, what is it? In a nutshell, it's a way for banks to transfer the first losses of some loan portfolio to the non-bank financial system while retaining the loans themselves on their books. And banks do that in order to receive capital relief. So let's look at an example. Think of a bank with some loan portfolio. It could be car loans, mortgages, you name it, but because we have fantastic data on corporate loans, why not think of, say, 1 billion euros in corporate loans? And the bank will pool those 1 billion euros, and they will sell the first losses to some non-bank investor. So in this case now, the non-bank investor will compensate the bank for defaults up to 10% in this example here. And then the bank typically retains the senior tranche of the SRT. And for taking on that risk, the non-bank investor is compensated with regular fee payments. So you can think of the non-bank investor as hedge funds, insurance companies, pension funds, but in the euro area context, also the European Investment Bank, for example. The market of SRTs is big, and it's growing. So here we plot, in the space of corporate loans alone, we plot the SRT stock, and it stood in 2018 at 60 billion euros, and now stands at 300 billion euros in 2024. It's also large in relative terms, so most of the big European banks have at least 10% of their corporate loan portfolio synthetically transferred to the non-bank financial sector. In the US, the market is a lot smaller, but growing even faster at 400% in 2024. And I think so we study the SRT market in Europe, in a mature market, and that might anticipate some of the developments that we will see in the US as well. Now, we want to characterize that market and along the way highlight some risks, some potential risks to financial stability. The first one will come from the selection of SRT loans, so the loans that are synthetically transferred. The second one from the monitoring of the firms whose loans are synthetically transferred. And the third one from the interconnectedness of the banks with the non-bank SRT investors. So the primary objective for banks to do SRTs is to receive capital relief. So it makes sense as a starting point to ask, how does that objective of receiving capital relief inform the decision of which loans to synthetically transfer? And we find that all else equal, banks choose capital expensive loans. And as the banks redeploy the freed up capital, they become effectively less capitalized relative to the economic riskiness of their loan portfolio. And I'm going to elaborate and walk you through an argument of how that works. Then on the monitoring, we develop a novel measure of monitoring and find that banks reduce monitoring relative to other banks lending to the same firm. And then finally, on the interconnectedness, we have a few results, but let me just highlight one. On average, 26% of the SRT is financed by the banking sector through credit. So, and that's what the Financial Times and the IMF refer to as round tripping, where some of the money comes from the banking sector and is then invested into the credit risk of the banking sector. I want to highlight that it's not necessarily the SRT issuing bank that also provides the credit, it's rather the banking sector as a whole that provides credit to these SRT investors. Now, what I want to do is quickly spend some time on the literature and contribution and then go through the data and then walk you through these three channels of potential risks to financial stability. So quickly on the contribution, we merged these two strands of literature, one on the capital optimization, where my discussant has contributed to a lot, and the other one on credit risk transfers and financial stability, by proposing a channel through which the selection of SRT loans can potentially contribute to financial stability, financial instability, if it has the objective of capital optimization in mind. Now, and then we contribute to a literature on moral hazard by coming up with a new measure that I'm going to introduce later in the talk. And then finally, there's an emerging literature on bank, non-bank interconnectedness. where we contribute with fantastic loan and investment level data. Now let me talk about the data. And what I want to do is I want to tell you about the ideal data set, and then let's see how close we get to that ideal data set. So in order to study the loan selection and characterize the entire SRT market, we want to have the entire bank loan portfolio at the loan level. We want to know each counterparty. Then we want to know at which time which loan is synthetically transferred, which SRT transaction it is part of, how much of the risk is actually being transferred to the non-bank, and then also the fees that the bank has to pay in order to compensate the non-bank investor. Then we want to know who that non-bank investor is. And of course, in order to understand the interconnectedness of that non-bank investor with the banking sector, we want to know the loan liability structure of these non-bank investors. Here's what we have. So we use Anacredit, the ECB's credit registry, and that gives us the entire corporate loan portfolio. So no mortgages, just the corporate loan portfolio of these banks at the loan level. We know every counterparty that is involved in these loan contracts. We also know, so Anacredit comes at a monthly frequency. We know at which month, which loan is synthetically transferred, which transaction it is part of, how much of the risk is actually being transferred, so the tranching of the SRT. We don't have the fees. So if you have them, we're interested. And then we know who the non-bank investor is for most of these SRTs, and then we know the loan liability structure, because Anacredit also has information on loans to financials, not just non-financial firms. And then obviously that's only to the extent that they're actually funded in the euro area, right? So a third of our non-bank investors are actually American, in which case their funding structure might be outside of our data set. And then in CoreWeb, which is another ECB data set, we have some elements on like the contractual features of the SRT. Okay, this gives us a sample between 2018 and 24, 70 banks that use SRTs, 250 SRTs, 170,000 SRT loans with a notional value of 260 billion euros, and then 90 non-bank investors, of which 65 are the ultimate investors. Sometimes there's a special purpose vehicle in between, in which case we don't know the ultimate investors, but for most of them, we have them. Now, let me tell you about the loan selection, and I'm going to try to argue that through a strategic loan selection, the banks will become effectively less capitalized. And here's the argument. So imagine a bank with just two loans, both 100 euros, and both have the same economic riskiness. So they have a true probability of default of 1%. Now, from a financial stability perspective, it would be ideal if the economic riskiness of the loan is reflected in how much capital the bank has to retain against those loans. In other words, it would be nice if the economic riskiness is equal to the assigned riskiness through risk weights, right? But in reality, it's very often the case that the economic riskiness, so that one true probability of default, is not equal to the assigned riskiness as reflected in the risk weights. In this example, the left-hand side loan has a much lower risk weight, so the assigned riskiness is a lot lower relative to the economic riskiness. And on the right-hand side, that's very capital expensive, where the assigned riskiness is very high relative to the economic riskiness. And now imagine that bank has a Tier 1 capital ratio of 10% and a regulatory leverage ratio of 5%. And now we hypothesize that the bank chooses to do an SRT, and that bank is choosing one of the two loans. And we hypothesize that it's going to use the capital expensive loan, so the right-hand side one. So now temporarily, the Tier 1 capital ratio is going to go up, the leverage ratio is going to stay the same, but it doesn't end here, because so now the SRT freed up capital, but because the bank has some target Tier 1 capital ratio, they're going to redeploy that freed up capital. And now, because they've freed up the capital expensive loan, they can actually do more of the same lending. So effectively, for the same Tier 1 capital ratio, the bank became economically riskier. relative to the assigned riskiness as reflected in the Tier 1 capital ratio. And now it has a lower regulatory leverage ratio of 3%. So what we're going to do is I'm going to show you the first part and then the second part in the data. The problem here with the first part, to argue that they use the capital expensive loans, is that the difference in economic and assigned riskiness is typically unobserved and super-endogenous to the loan characteristics. So what we do is we use a regulatory intervention that increases the assigned riskiness while keeping constant the economic riskiness. And we do that through what's called an SME supporting factor. And that SME supporting factor is supposed to incentivize banks to lend to smaller firms by making the risk weights an increasing function in the firm revenue. So here's what it looks like. So we plot the risk weights on the y-axis and the firm revenue in million euros on the x-axis, and we do that for different bank firm exposures. So for low bank firm exposures, you can see there's going to be a discontinuity in the risk weights at 50 million euros, which you don't have for high bank firm exposures at above 15 million euros. And we're going to exploit that discontinuity to show that it's really the capital expensive loans that are synthetically transferred, all else equal. So we do that. In order to do that, we run a regression of SRT loan on these borrower revenue bins for two different subsamples. One where there's a low bank firm exposures, where there actually is a jump in the risk weights, and the other sample for high bank firm exposures, above 15 million euros, where there's actually no jump in the risk weights. And here's the result. So it is in fact true that a higher risk weight is indeed associated, or it does indeed cause a higher probability of synthetically transferring that loan. So now we show the second part, which is that the capital is being redeployed after the SRT. And to do that, we run some bank variables on an SRT intensity variable that just measures how much SRTs a bank does in a given time period. And what you find is that a higher SRT intensity, as you can see in column 1 and 2, is associated with a higher loan growth and a lower leverage ratio, and no effect on the Tier 1 capital ratio, in line with the capital being encumbered, again, after the SRT. So through these two steps, the economic riskiness of the bank actually increases relative to the assigned riskiness. OK, so now on the moral hazard. And here what we do is we come up with this new measure and show you that after the SRT, the bank will decrease their monitoring efforts of that firm whose loans is synthetically transferred relative to other banks. And basically, our assumption for the monitoring measure is that the actual probability of default fluctuates over time, much like we model it in asset pricing. And then the bank tries to map those fluctuations into their own estimates. And the assumption is that banks that monitor more are better able to capture those fluctuations in the actual probability of default in their own estimates and more timely update their own probability of default estimates. Whereas banks that do not monitor will not update their probability of default estimates in the same manner, in the same timely manner. So we have two measures at the quarterly level. The first one is just whether or not the bank updates its probability of default estimate, and the other one is the standard deviation of the probability of default estimate. We also validate that by showing that updated PDs are actually more informative about actual default 1 year down the line. And so then we use this to run a regression, basically our monitoring measures on whether or not the loan is an SRT loan, and then interacted with the post-SRT dummy, and we use super granular fixed effects, right? So we use, in our results now in column 2 and 4, we use firm times quarter and bank fixed effects to really control for unobserved heterogeneity at both the firm and the bank level. And what you can see is using our measure, there's a decline in monitoring, in those monitoring measures by 15 to 30% in almost stringently controlled specifications in column 2 and 4. Okay, now finally on the bank-non-bank nexus, this interconnectedness of the banking sector with those non-bank SRT investors, right? Is there any interconnectedness when it comes to granting credit by the banks to those non-bank SRT investors? So in results that I'm seeing, I've got a lot of time, so I'm going to spend just a couple of seconds on results that I'm actually not showing here. So we also show that there's a familiarity between the SRT issuing bank and the SRT investor. So in the sense that it's very likely that there's going to be a credit relationship between the SRT issuing bank and the SRT investor. So there seems to be this familiarity between these two players already. Just to state that basically, like there seems to be a bit of an interconnectedness or familiarity. But now on the results that I have here on the slides, just to remind you, this is like what the media has been most worried about, right? Like Reuters writes, banks' hot new trade could burn others for once, while the Financial Times disagrees, or the IMF and warns of these round-tripping fears. Now, who's right? Who actually does get burned is the question here. And what we do is we're going to look at the dynamics of the loan liabilities of these non-bank SRT investors. Because so when they get credit from banks, it doesn't say, like, look, this loan is used for me to buy an SRT, right? That's not in the data. So we have to kind of tease out, like, is this loan used in order to invest in an SRT? And the way we do that is by looking at the loan dynamics at the lending exactly prior to the SRT investment. Okay? Like, does the loan amount go up exactly prior to the SRT investment, where we can plausibly say that this loan is in fact used for the non-bank SRT investor to invest in that SRT. And the way we do that is we run a regression of log that amount outstanding on months to SRT investment and granular fixed effects at the SRT and the calendar month level. And what we find is that there's no effect for all SRTs, or there's a bit of an increase in the log amount outstanding, but it's really not so big. However, you have to know that many of these SRTs are actually not funded, so they're not cash collateralized, so the investors don't even need money. If you look at only the funded ones, there's already a bit of an increase just prior to the SRT investment. And if you look at the funded and large SRT investments, there's really quite a bit of an increase in the amount in the debt amount outstanding of these SRT investors just prior to the SRT investment. And so if we do a bit of a back of the envelope calculation, we find that in the baseline, so that's for the red graph here, we find that 26% of the SRT are funded directly by banks through bank credit. So with that, let me conclude. And let me just mention one thing. So we introduced these three channels, and the takeaway should really be from this paper that the amount of capital relief that these SRTs give for banks should account for some of these channels that we introduced in this paper. Thank you.
Thank you very much. And so the discussion will be by Rainer Haselmann.
So thank you very much for selecting me for this paper, and congratulations to Alex for this very clear presentation. And so my comments are mostly about the paper's empirical tests, but I have to say that this paper I personally found extremely interesting and very, very relevant, because it is a new form of securitization which I was not really aware of, and the magnitudes they are able to illustrate have with this fantastic data set are enormous. So from this perspective, I enjoyed the paper from the first page onwards. And then, of course, there are a lot of tests in empirical tests in the style where my own past research is on and current research is on. So this is something I enjoyed from page number 1 on. And so the paper does the following. It shows a new form of securitization that is different from what we have been known before or before the great financial crisis. And here it is as such, what is different is that the assets do remain on the bank's balance sheets, similar to CDS, but the portfolios are tranched like with traditional securitizations. And the bank is holding usually the senior tranche, the junior tranche is sold. And there's considerable variation. And I thought in the beginning, okay, this is again a US story, but interestingly, this is happening in Europe, it's happening here. It's happening substantially. It varies considerably across different type of banks, across different countries. So I found all of these variations very important. And I actually think that the paper could focus even more on identifying this very important new trend. And I think this alone would be worth a paper. And this contribution, I think, is almost understated in the current version of the paper. So as Alex has shown us, there's incredible data on the micro level. And the empirical tests, for my taste, are very carefully conducted. So I don't have comments about actual significance or how robust your results are, or whether it's, the tests are cleanly conducted. So all of this is fine. What I'm going to discuss is conceptually the empirical test, mostly the first test, and I'm gonna spend some time whether the results can be interpreted in a slightly more positive way. I'm not saying that your interpretation is wrong. I'm just saying that the current results, I think, as you show them, still allow also alternative interpretations, and you can think about tests to either rule them out or not. So let me talk about the first one where you said that capital is freed up about this test. Yeah. So as I said, I think the test is cleanly conducted, but the basic idea here is that you have two banks which are, let's say, identical, and they give loans to SMEs and non-SMEs. And for those loans which are to SMEs, there's a discount. My understanding is that the German saving and Landesbank and cooperative banks were fighting for this in the Basel II negotiation. So that for the same loan, if the firm is smaller, you have a smaller risk weight than if the firm is larger. And so let's say we have two identical banks. They give loans to both of these parties, and they are indicated here by the red and the green colors in this. And Bank A now is doing an SRT. So what happens is that bank is, according to your paper, which I also think is very plausible, is selling selectively those loans which do not get this discount. Means these are loans to larger entities with sales or revenues above 50 million, and they sell this to non-bank investors. So now capital is freeing up, and the bank replaces them with other loans, and it also replaces them with, for example, SME loans. So there's a delta capital that's larger, as if they would have, on average, given all the loans away. And as Alex says, he says, the economic capital, so the risk is increased in a way because they have more capital just for giving these three loans away. If they had the same amount, they could issue 5 loans now because of this SME discount instead of just 3, if you consider loan amounts to be constant, and the capital is staying the same. I have 2 fundamental comments on this. I mean, first of all, let's assume we have a regional bank and a large bank that is specializing on lending to large entities. So if we would make this argument and generalize it, we would basically say that the regional banks in general are all undercapitalized, because, I mean, they can take advantage of the SME discount. I know most are not under IRB approach, but I mean, some Landesbanks take loans from the saving banks. So we would make the argument that these banks are actually undercapitalized. And I have to say I'm not really sure, because the small firms tend to have larger PDs on average than large firms, because they tend to default more often and they might be more idiosyncratic. And so it's not so often that the corporate SME portfolios are such a big problem for financial regulation. So I felt that also for SMEs, it's easier technically to predict probabilities of defaults, because they tend to default more often, so the models tend to be also better. So I was just questioning whether we can generalize this or not. The second point was, and that's more for identification, whether you can really compare those loans. So imagine again, you have this bank that issues the same type of loans, and we know that capital intensity is a major decision device for banks, so it's very important, the decision making. So if there is a firm that's just above and just below the threshold, you will not randomly give the loan to one or the other, but you would always prefer the smaller firm if they are all else equal. This means if you compare firms around the threshold, it's actually the case that the larger firm should be better on non-observables. So if they look similar, the large firm must be more attractive somehow to the bank. So that could be good news if we are now using these loans, and those are the loans which are sold to the system. They might be the better loans. So there might be even a selection that, opposite from the traditional securitization, you now have a tendency to actually sell the larger loans. It could also be that there is a preference for those investors buying it, that they prefer large to SME loans. So I wasn't sure whether this really has to do primarily with the SME discount, or whether it's just the nature of loans that could be more easily securitized. So what I'm trying to say is that maybe the news are not so bad. I mean, with several programs like the CSPP program, Draghi said we want to boost SME lending by banks, and we see a boost by SME lending, which could be a very positive thing. And some of the bad things that had been shown by the papers following the great financial crisis, that there was adverse selection, lax screening, which resulted in higher actual defaults after the crisis, or that there's a systematic breakdown of default models. These things haven't shown yet. I'm not sure if they are not, and I would actually recommend that you could look into these things more directly. They, at the moment, are not really there. So the main issue you're showing is basically a criticism of the Basel II model-based regulation, with giving these discounts for SME loans, which is applied here. And yeah, I criticize this regulation a lot in my research, so I'm not saying you're wrong, but I'm not sure if this is really the major issue with this large-scale, important new form of securitization you show. On moral hazard, I think this this is very interesting. I was thinking about it, and I think this could be an identification concern if the PDs of these larger firms, which are sold off, are just updated less frequently. You could think about it, but I was thinking about something else. I was thinking what you could test is whether actually PD's downgrades are more frequent here, because this is something you could do without having the cost, because you've transferred the risk. So and I know how the validation of the models work. So often the supervisors look at average PDs of the models. So if you would downgrade more often exactly those loans where you don't have to pay hold capital for, sorry, this could be an interesting way where you could do arbitrage and actually then make your models look better and more conservative by actually downgrading precisely those PDs of loans whose risk has been sold and transferred to someone else. I think what you could do is you could do some more research on whether the future performance of these loans is different. If there is less monitoring, the probability that they default more often should probably be there, and you could directly test for this. You could also test for the discriminatory power of the models, whether the models lose their quality of predicting future defaults. So there's a couple of papers which you also cited which have done this. My time is over. The interconnectedness, I find it super interesting. My suggestion is, on this paper, I would really focus on this contribution that you have really identified some very important trend in securitization, which is very large in magnitude. And then I would either focus on one of the, either the interconnectedness, which is super important, or on this monitoring. But then I would try to show consequences of actually how these loans behave differently, or if these PDs mean something different, if the risk has been transferred or not. But great paper, and congratulations. Thank you very much.
Thank you. So again, I would like to give the floor the opportunity to ask questions, and it would be great if you can stand up and say your name. So behind you.
Thank you. Daniel Diekelmann, ECB. I can mirror these comments. I think this is a very interesting trend that you show, and I think it's already a major contribution. I have a rather technical question. So I work with this data set too, and I really share your enthusiasm. And you made the step for showing, for the non-banks, you showed their total debt outstanding. I think that was the last part of your paper. And I wonder, I would like to know a little bit more how you did that. So I guess you reversed engineered it from AnaCredit, but there might be other debts that these non-banks have that are not captured. Thank you.
Lady.
One is related, I think, with the comments by the discussants about the way banks measure risk, whether by using internal ratings vis-a-vis standardized models. I think that you can perhaps explore this contest a little bit because the intensity of usage of internal rating versus standardized models can affect, I think, your results first. Second, speaking about monitoring, one measure that you could perhaps taking into account and loan loss provisioning. So the way banks actually monitor loans and adjust their assessments of expected credit losses through loan loss provisioning. And this is a piece of, say, risk management that it's very important for banks that perhaps, again, can be considered.
Jean-David Sigo, ECB Research. Do you find that on your third point, when the non-bank is receiving a credit to finance the SRTs, and when it's receiving from the same bank, do you find preferable lending terms, so lower interest rate, for example? And that could be, if that's the case, that could be used as a proxy of the fee.
Okay, thanks a lot. So now you have a few minutes to respond.
Yeah, very good. So, Rainer, thanks so much for the great discussion. All points super well taken. Let me just respond to, I guess, linearly by the first question. And so you say that all regional banks, according to our argument, all regional banks would be undercapitalized, right? And you also say that the smaller firms have higher PDs and so on. So the way I like to have this result understood is as the perfect identification. Although, also reading your research, it happens very frequently that the assigned riskiness is not equal to the economic riskiness. And that's going to happen for above, independently of the SME supporting factor. And what we're saying is that very likely the bank will be doing SRTs based on that wedge between the assigned and the economic riskiness irrespectively of the SME supporting factor. But one more regulatory thing, of course, it also, so now there's going to be this new output floor, which is just like a lower bound on the IRBA risk weights vis-a-vis the standardized approach risk weights. And we do say that with synthetic risk transfers, that floor might be actually traded away through SRTs, right? By trying to increase the wedge between the assigned and the economic riskiness. But still, very well point well taken. Then on the comparability of the above and the below 50 million euro threshold, yes, like on unobserved. So we've got like we showed the smoothness of some variables around that threshold. So they don't differ on observables, but they might very well differ on unobservables. And I need to think more about how to address that. And then I agree that for the monitoring measure, it would be nice to show the directional change, I guess, whether it's upgrades or downgrades in the PDs. And also the future performance, that's something we should look at. Although then it might be a bit difficult in terms of identification. And then on the questions, yes, so AnaCredit has information on the loans to these financial institutions. We are working on including other kinds of debt. What's definitely going to be outside of our study is funding that comes from other jurisdictions outside of the euro area. And as I said, like a third of the investors are US-based, and their funding structure in the US is going to be unobserved to us, but might very well matter for the interconnectedness of these. So then on IRBA versus standardized approach, yes, so in the standardized approach, you never have the case almost that the assigned riskiness is equal to the economic riskiness, right? For our loan selection story. And you would expect that they're going to trade based on that wedge. However, SRTs seem to be accessible primarily to large banks. And so 97% of our loans are actually made by our IRBA banks. And then the lending terms, fantastic idea. That's, I think, something that we haven't that we haven't checked yet. So I don't read this like this round tripping. I don't read as necessarily banks coming together, like banks and non-banks coming together and coming up with a plan in order to have lower capital. It's not necessarily just regulatory arbitrage. It's rather that they like to invest in a leveraged manner, and therefore they take on loans. So I don't expect necessarily that the loan terms are going to be especially low, but it's definitely something that we should explore. Yes. Thank you for the good comments.
So thank you very much. So this brings us to the end of the conference. And of course, at the end of the conference, there's a round of thanks. So first, I would like to thank the presenters and the discussants. I would also like to thank you as the audience who stayed here until the very end of this day and contributed to the lively atmosphere by your questions. But of course, the conference is always teamwork, and there are many people in the background who help to make this a success. So first, our team from communications who contribute to the web streaming, our colleagues supplying you with microphones, but also a big thank to all the assistants and all the staff who is involved in this conference, and I think they deserve a round of applause.